Welcome to the 8th Annual DC Fintech Week. Welcome to DC Fintech Week 2024. The program will begin in 5 minutes. Please make your way to the event space. The program will begin in 2 minutes. Please take your seats. The event will begin in 1 minute. The program will now begin.
Ladies and gentlemen, it's fire time. Come on. Let me hear you say it. As we rock like this. Scratch the soul, nice, got it. Here it is twice. Let me hear you say it. Come on. Let me hear you say it.
Please welcome the founder and host of DC Fintech Week, Chris Brummer.
Ladies and gentlemen, it's fire time.
All right, we are now back into day 2.5, almost day 3 of DC Fintech Week. Thank you so much, everyone, for showing up. It's going to be an action-packed day. I just want to give 2 minutes of shout-outs and thanks. You know, getting an event like this, and it's going to be an amazing day, actually, and it'll get pretty busy and pretty full in here. But doing an event like this across the city with so many partners, it's a challenge. I want to thank early on Camilla, standing there very quietly, Zainab, Ahmed as well, Matt Cook. These are people who at 2 o'clock, 3 o'clock in the morning on weekends for the last several months have been working hard to make sure that this event works. I want to thank our colleagues over at the World Bank, because we always do this at the end of the event and not the beginning of the event. And so it's important to thank AWS and Fannie Mae and so many other people who make this event possible. So we're going to kick things off immediately, right into a discussion on regulatory policy. I want to welcome the chairman of the CFTC, Russ Bidham, to the stage right now. And we are going to dive into that agency's work and how it covers an ambit of financial technology. So, Russ Bidham. All right. Yeah. Oh, I guess you can sit here. I'll just here. Okay. Chairman, welcome back. You have made it here so often as a supporter of this event, and we really appreciate it. You've now been in office now for just about 4 years.
Yeah.
Before we sort of hop into the immediate issues that you're working through, maybe a comment or two on really, as you make regulatory policy, what's kind of surprised you, or what's been a kind of a highlight in your chairmanship as you sort of pivot to the issues facing the agency right now?
Chris, first of all, good to be here again. Wonderful conference, as always. I don't know, when I think back about the past 4 years, it's been a lot's going on, right? Like I got into the job and we were on the, call it, back end of COVID, right? And I think for organizations, there was a lot going on. There still is a lot going on, but even just the most basic thing of getting people back to work and how markets were going to react and how did they react to that event. And we obviously saw huge impacts on physical commodity markets, but on interest rates, on credit, on FX, and just the global macroeconomic picture. And then as times moved on, we had Russia invade Ukraine. We're dealing with Middle East issues. Again, huge impacts on commodity markets, bigger macroeconomic issues. And I think one takeaway was the resilience of the financial system. A lot of fiscal policy change, a lot of stimulus, obviously, but a lot of regulatory reaction, both from the market regulators, the prudential regulators, and of course the central banks across the globe. So stabilizing effects, but a lot of coordinated, intentional action by lawmakers, by regulators to address these, what we call once in 100-year crises, but very unique crises that have had huge impacts on all of us as retail consumers, as citizens, social issues, and everything in between. So, the arc of 2008, the financial crisis, Dodd-Frank, and the G7 reforms, and these events that have happened since, I think being in this position, observing all of these events, and this is not to even speak about, which I'm sure we'll talk about, fintech, crypto, a number of cyber events, right? Ion derivatives, which had a direct impact on us, ICBC, to an extent CrowdStrike, which I know is more of a software, but like third-party vendors. So you expect these things to happen in any tenure. This is life. This is the responsibility of the job. But as I start to reflect on the 4 years as we're turning towards 2025, a lot of interesting things. But I would say, one word answer is resilience.
I just even listening to that list, it's
tiring.
It makes me tired. Yeah. But it's very impressive, and it also shows how the agency has grown, and frankly, how the range of issues facing the agency seems to expand. Yeah. Even as its mandate remains the same, the scope of its responsibilities seems to always grow. I don't know if you've noticed, but there are some elections going on around town, which has also brought some attention to your agency, particularly as it pertains to election contracts and prediction markets here in the United States. I think you had a pending rulemaking at the CFTC, but there's been so much that is evolving from Kalshi to Chevron. Maybe could you give us an overview as to sort of where things stand there?
So, and I'll give the 101. I'm sure there's a lot of people in the room who have been following this or understand this or know it, but not a new issue in many respects. Statutory prohibitions on certain types of derivatives contracts, and the ones you speak of, Chris, they're binary options. They're essentially prediction markets, so that you get paid out on the outcome of an event. It could be literally the temperature in Washington today. It could be how much the Federal Reserve may or may not cut rates at a certain time at a next FOMC meeting. But in this particular instance, the subject matter, the underlying commodity, is an election, a political election. The Commission has been pretty consistent over the past 10 years about its position on these markets. We think they're against the law. There's a specific statutory section in the Commodity Exchange Act that bans certain activities: war, assassination, terrorism, gaming, anything that's not in the public interest, and anything that's illegal under state or federal law. So we've taken that position for quite some time, mostly administratively. But about a year ago, we were sued in court by Kalshi. And just about a month ago, and I'm just being rough with my dates here, a district court in D.C. ruled against us and ruled in favor of Kalshi. We subsequently appealed and requested that the D.C. Court of Appeals stay the contract, so essentially prohibit Kalshi from listing the contracts until the court reviews the issues on its merits. The appellate court denied that request for a stay, so now they're going to review the case on its merits, but meanwhile, the contracts have been listed. So actively trading on a number of exchanges right now. I said this actually yesterday. I was in New York at a number of conferences. We're going to respect the decision of the judiciary. We're going to certainly appeal it. That will take time, most likely months. But, my position, standing on that foundation of thinking that this is against the law, I also have raised policy issues about what really this means for us as an agency. And to your point about the sort of expanding scope of our responsibilities, limited resources, and really, I think it's the friction of what the CFTC was meant to do, what these markets are doing, and whether or not Congress wants us to be involved. The very simple top-line argument I've made, and I think seems to resonate with people, is that it pulls us, the CFTC, into the responsibilities of being an election cop. So if there's alleged fraud or manipulation in an election, which unfortunately we've seen those allegations seem to snowball over the past 10 years or so, and if that alleged allegation could then potentially lead to a manipulated price in the markets that we regulate, we would then have to investigate that. And we do, and we'll probably talk about this on the crypto side of the ledger, we do police underlying physical commodity markets in certain circumstances. And this would be an instance where not only we would have to investigate or surveil or examine the markets that we directly regulate, but we'd have to look into the underlying and look into whether or not there was activity, social media, allegations of a voting machine, not working appropriately. So you can imagine the number of scenarios or things or hypotheticals that might happen. And I just think from a policy perspective that is a bit too much for the CFTC as a market regulator to want to be involved in.
That's really interesting. I've said in a number of contexts when people push for any kind of regulation or the lack thereof, I always say, be careful what you wish for, because whether or not you're removing regulation or you're increasing regulation, there are always things that you may not anticipate. And what you're saying is, well, look, even if we then introduce these contracts and, even if the CFTC loses its cases, well, then the result is, well, okay, then now we're going to have to regulate them, right? And if that means that we have to regulate them, there are all these little hoops that we have to jump through, and there's going to be a new regulatory regime that would have to accompany these newly regulated products. So it's a little bit of a, do you really want that or not?
It's just one last thing, Chris. Two things, and I want to address your point about Chevron. One, it really is a matter of where Congress and where the agencies are gravitating to because of technology, right? Yeah. It's access to markets that we have never seen in history, right? It's literally an app on your phone, instantaneous purchase or sale of a financial asset, whether it's an equity, a derivative, or in this case, a binary option. On the Chevron point, I mentioned these few things in our statute that are prohibited: war, assassination, terrorism, very express and very direct and very clear, black and white. Gaming, public interest against state or federal law. And that's where in this new legal dynamic for the sort of legal folks out there, and I've been telling a lot of young law students, you go to law school, I'm sure you know this, you talk to your students as well, it's like you talk about securities law, tax law, state law, those are this corporate law. But administrative law, I mean, that's the new hot thing.
It is. And it used to be the old boring thing.
Yes,
especially as faculty were like, oh, no one wants to do that. Now it's everybody wants to do that.
And being in my shoes, I used to work in the Senate as a counsel. It's a fascinating thing about our government, the way it's set up, the three branches, and the relationship. And now with the Chevron decision, it really puts a very, very heavy onus on executive branch agencies to be very particular about what they do and what they don't do, because as we've seen, it could be challenged pretty easily.
It can be challenged easily, and the implications can end up curtailing the authority of the administrative agency even more than anticipated. I mean, just one last thing, as we pivot to crypto and spot markets, I mean, as I think things through with the binary options and the election contracts, I mean, I suppose that one of the issues where you could get around Chevron is certainly when it comes to the exercise of your anti-fraud authority. I think that's where you were sort of hinting at, is that by exercising that authority and just, if people are fraudulently engaged in something that could manipulate or end up moving those binary contracts or options into a direction that they shouldn't, I suppose, well, there your authority would be less constrained by any kind of Chevron-esque decision making. But let's then move on to crypto. It will be spoken about today. Obviously FIT 21 is still in play. You've got legislation that's still being considered. Can you give us a little bit of an update and maybe first start with the facts on the ground again, as you just did, as it pertains to the regulation of spot markets?
Yeah. So I think my response to that, some good, some bad. I think on the bad side of the ledger, maybe status quo since the time last time we spoke, probably here a year ago. We still don't have authority to regulate spot commodity markets. We still have seen a pretty robust demand for these products from retail and institutional investors. If not, that's only increased. We still are handcuffed. I use this phrase a lot in terms of what we can do. So we can't regulate, register, surveil, examine in the traditional sense. Our fiscal year 24 enforcement numbers should be coming out relatively soon. I think a bit of a decrease from the year before, and that's for no intentional reason. It ebbs and flows, but perhaps a deterrence from what was a very successful year in FY23. I think I've stated this a lot. Almost half of our enforcement docket in the previous enforcement year was crypto. That's gone down a bit, but again, it's random in some respects. So not much has changed on that side. A little bit disappointing, but we're doing our work. We're going to keep our heads down, and we'll do what we can with what we have. I think on the positive side of the ledger is a lot more momentum, and I think we've all observed this. You probably talked about it yesterday and will today. A lot more momentum in Congress, and I think just a much more robust conversation in Washington about legislation around crypto, stablecoins, blockchain technology, and credit to a number of members both on the House side and the Senate side, on the Ag Committee, the Financial Services Committee, and the Banking Committee, who seem to be engaged, seem to want to learn much more than they have in the past, and understand that this is a sustainable asset class that needs regulation. And I think time has also proven over the past 3 or 4 years that the Biden administration has been in place here, that there are gaps in regulation, right? I think there was a little bit of uncertainty around that, but I think there is a realization with the continued demand for these products and the fact that there are holes in the regulation, and we're going to need to fill them. So where that will lead us, you mentioned, I think there's still a possibility that in the lame duck, as the members come back from campaigning after the election, that FIT or otherwise might get wrapped up this year, but I would say low probability. But again, I think the positive thing is a lot of momentum, and whether or not FIT happens this year, I think the momentum going into the next Congress and a new president, a new administration, for sure, on either side, will bode well for digital assets and fintech generally.
Yeah, it is remarkable. When that conversation on the regulation of crypto, when it started, I actually had no gray hairs in my beard, and now I have very many. Now it could just be that time of life, or it could alternatively be that getting things done in Washington has become a lot harder. When you think about how to address crypto markets from the perspective of the CFTC, there's market structure, as you mentioned. There's stablecoin issues. There are questions, obviously relating to where the regulatory perimeter should fall between all the different statutory agencies. But I'll just put that one aside for a moment. But when you think about how to regulate crypto assets from the perspective of the CFTC, and as you've had your conversations with members and the like, what do you think are the top maybe 2 or 3 line items where you think, here's the place to start?
Yeah, it hasn't changed in the sense that it is just traditional market regulation, and it is very distinct, as you point out, from payments, depository instruments, which tends to be more on the stablecoin side. Blockchain and settlement and payments is markets in many respects, but it does raise a lot of interesting issues about what types of infrastructure, payments infrastructure we want our financial system to be built on, because that will require a significant change from where we are today. But on the market side, if I could register and oversee exchanges, brokers, introducing brokers, clearinghouses, custodians, and what does that mean, right? Registration then means information about their compliance programs, about their governance programs, about the individuals who run the company and are involved and in charge of various responsibilities. It's an understanding about their financial resource capacity, what that means in the present day and on a rolling basis. It means our ability to do random examinations and surveil markets. These are, as I'm sure I've said to this event and others, these are the sort of time-tested attributes of a healthy, robust regulatory system. And in some respects, cyber, custody, and payments, I would say, just to name a few, are going to be unique in how we have to address it. DeFi is definitely an interesting layer on this argument that we have to think about, and what role does the regulator have in decentralized finance, where you don't necessarily have an individual executing like a broker on a floor, or even in a club, or an order book like we have now. So a lot of different elements, but I think the structure and the foundation has to be built off of those same fundamentals that have served us well. And I think I've had a lot of really positive conversations with members of Congress to answer your question, let's get this base layer, to use a term that's very common here, down, and then with a little bit of flexibility and discretion to the agency, which kind of goes to Chevron, but I think is extremely important, because markets evolve and markets change. And if we as the agency, the executive branch agency, don't have flexibility, it's actually going to hurt everyone. It's going to hurt Congress, it's going to hurt us, and it's going to hurt the market. With a little bit of flexibility, we can address these outlier marginal issues to say, okay, this is a unique technology, and we have to do things a little bit different on custody or on cyber issues and sort of other matters that are unique to digital assets and fintech.
You are really bringing up one very interesting point, which is, even when you look at the FIT legislation or any kind of legislative package that could clear Congress, how do you make sure, on the one hand, that it's flexible enough for the regulators to do their job, but at the same time it's, I suppose, prescriptive enough to shield them from any kind of Chevron challenge? I mean, it's very fascinating, because I wonder, because administrative law is now the hot new thing, how does administrative law and the evolving nature of administrative law fit, to use a pun, with innovation? That's because technology is always moving, and theoretically the regulator needs to adapt alongside the technology as it's moving forward.
I think that I don't think there's a doubt that you would probably, if you surveyed members of Congress on both sides of the Capitol, they would appreciate and agree that there has to be some level of discretion, right? Because everything changes in our economy, and no matter what, you have these three branches, and you're going to want the executive branch to be able to adapt to changing circumstances. Yes, it feels like, and it seems like, and probably statistically, it is harder to get legislation done today than it ever has in the past, but it's always been hard to get legislation done. It's hard getting consensus among 500 plus members of Congress from different parts of the country who have different interests and different constituents. But in this particular circumstance, I actually think it even, and I've thought about this a lot in the context of Chevron and where we are today and the difficulty of legislation, and then just the velocity of change in financial markets, is that whatever I do and whatever I introduce to the commission or think about in terms of directing the trajectory of the agency, you really have to understand what hand you're dealt and the playing field, right? And the playing field and the hand is really Congress, and it's your constituency.
And the courts.
And yes, 100%. And you just have to sort of say, okay, what's the outcome I want? And walk yourself back from that outcome. And understand and appreciate that the outcome has to be reasonable, it has to be practicable, and it has to be something that you think you can get at least broad consensus on. And if you can't do that, if it's a little bit too marginal on one side or the other, political or otherwise, because it doesn't always have to be a political issue, then you're probably heading in the wrong direction. Because if you can find consensus in the middle, or just among a larger group of constituencies, then I think you can work through the challenges with Chevron and otherwise. Because you're going to have people who say, oh, I don't like that. But if it's a vast majority, then that's when you're going to run into legal challenges. And it's just a waste of time, right?
Yeah, very good. Only a couple of minutes left. AI, pretty big issue. I'm sure you've heard of it. Certainly the CFTC recently put out a request for information on AI. And, I found this pretty interesting since those who are sort of students of history and students of the agency know that, the CFTC has always been very much a technology sort of forward looking agency. What kinds of priorities do you have behind that RFI, and are there any policy developments that we should be expecting?
Yeah, AI has been a part of our markets for years. As you sort of suggested, we have actually some of the most sophisticated market players in the world. And they use derivatives for a number of reasons, speculation and hedging. So we've seen trading really evolve over the past 20 to 30 years, and AI has been a part of it. But, it seems like we're on a new precipice in terms of technology and Gen AI and large language modeling, and we have to think about what that means for us as an agency. So we put out this document. And I'm not going to rush. I've said this, and we're not going to rush into doing anything specific from the get-go. I think, as you said, it's a hot issue. It would be easy to sort of jump on it and want to have policy, but let's get feedback from stakeholders. Let's talk to Congress. Let's see what we're observing. We're a principles-based regulator, and that's very powerful, and it allows us to do a lot within the scope of what our rules are. In some respects, I can make an argument that the principles actually cover AI, right? And that we really don't have to do anything. But perhaps the other side of that argument is there are unique characteristics and distinct issues and risks associated with this new generation of AI that we may have to be a little bit more prescriptive. So the effort is, slow, be very deliberative, get information, do some inside discussions, and perhaps have policy. Everything's on the table. It could be as far as a rule, but as easy as an advisory document, and hopefully get something done by the end of the year.
Russ, it's always been a delight to talk to you.
Thanks.
Really thoughtful, interesting. It's been a delight to have these conversations.
Thanks.
Thanks so much for joining us, man.
Thanks, Chris. Appreciate it.
All right. So we're now going to get ready for our next conversation on stablecoins unshackled. Okay. See you soon.
We have one extra. Excellent, excellent. Welcome, everybody. Good morning, good morning. My name is Robbie Greenfield. I'm the former head of social impact at Consensus, current CEO at Emoja Labs, where we monetize your Bitcoin. And here today, we have probably the best minds in the world to talk about stablecoins. I don't say that short of breath at all. We have the amazing and illustrious Jose Fernandez de Ponte, SVP and Global Manager of Blockchain, Digital Currencies, and Crypto at PayPal. And Yuan, who is the Global Lead at Solana Foundation for Stablecoins and International Markets. And, of course, my man Kai Sheffield, who is Head of Crypto at Visa. Everyone, I really do appreciate your time. And I know that we only have 25 minutes, so we're going to get straight into it if it's okay with you all. Is that okay?
Totally.
Excellent. Yeah. Let's do it. Let's do it. So, over the past 12 months, and this is provided by Kai Sheffield's team at Visa, we have seen $20.5 trillion in stablecoin volume across 147.8 million active unique addresses. And amongst all of that transaction volume, I wanted to start with you, Jose. What are the institutional and retail use cases that you're seeing with USD-pegged stablecoins, and why aren't we seeing many non-USD-pegged stablecoin adoption on-chain?
Sure. Still, most of the volume that you see today for stablecoins tends to happen in crypto trading markets. And part of the second part of your question about why USD is because crypto markets tend to be denominated in US dollars. There is not really a large market of euro to Bitcoin or yen to Bitcoin. So I think that drives a lot of that. I don't think that's going to be what you see in the long term. Because on the other side, the volume that we are seeing that is not for crypto trading is more and more going into payments and more going specifically into business-to-business payments. One of the things that we are seeing is that the value proposition of stablecoin, as per Kai's report with Castle Island and the other folks, tends to be crypto trading, currency substitution, so access to a dollar-denominated instrument, and smaller payments. What we see now is that actually, if you're a company trying to pay other company across borders, across frontiers, or you're trying to repatriate profits, or you're trying to, in general, move money internationally, the advantages in terms of 24/7 settlement, on speed settlement, and programmability translates very, very easily into financial advantages. If you are a CFO of a large corporation and you're saying, okay, let me think about it. I have an instrument now that lets me move money worldwide in seconds, and I can reduce counterparty risk, and I can get a better FX because I don't need to be locked for 24 hours into one FX rate. I think that's where you're going to see more and more the use cases. And on the retail side, I believe you're going to see more cases in which it is fiat on the front and a stablecoin on the back, and you see stablecoins as an infrastructure settlement layer.
Excellent. And I don't want you on. Or actually, Kai, you're about to.
Yeah, I was going to say, I think one of the most interesting things about where stablecoins are today is they're just starting to shift from, if you used a stablecoin a year ago, it was very explicit. You knew you were using a stablecoin. You usually had to seek out a crypto wallet. You had to figure out how to manage a private key. We're starting to see both, major fintechs, existing wallets like PayPal and others, put front-end interfaces on it that just look like another fiat wallet. And so they can use stablecoins on the back end. And then, as Jose mentioned, one of the concepts that we're seeing more and more is this idea of the stablecoin sandwich. It's fiat on the front, stablecoin in the middle, and then fiat on the back. And it's just becoming another cross-border account-to-account payment rail. We're seeing companies doing U.S. to Mexico, either B2B or P2P, where they're starting in dollars. They're using a stablecoin to move the money into the market. And then you have these local exchanges, many of which started as a place for people in Mexico to buy and sell Bitcoin, are now basically becoming FX platforms. Yep. They're enabling you to convert stablecoins into pesos, and then to use local RTP rails to initiate transfers to the last mile. And so we think that stablecoins are kind of very much moving out of the crypto ecosystem of just being a tool for crypto traders into becoming more of a general purpose payment rail that will be increasingly abstracted away and used around a range of different use cases.
Going off of Kai's point, I think a lot of emerging markets have been using stablecoins, especially on Tron for USDT for the last couple of years. It's been growing significantly due to liquidity reasons. The on-off ramps, because most of it comes into the trading venue and it was going through centralized exchanges, majority of which were denominated in dollars and specifically in Tether. But we're seeing that change, shift towards the stablecoin sandwich, and also have more regulated and large players like PayPal coming in. That's allowing businesses, not just individuals and really, really small businesses, to accept stablecoins in a more comfortable way without having to go through the KYC, KYB burden of specifically a trading venue. So now you can go through other fintech or like bank, sometimes even bank-like neobanks that support stablecoins for payments. To your question on why there's been very little non-USD activity, I think one is because if you look at Atlantic Council has a really good dashboard on dollar dominance. So they've been tracking whether stablecoins would increase or decrease that. It's a bit too early to tell, but I would say it actually increases and supports dollar dominance. So that's one. Number two, a lot of the jurisdictions that have seen really high stablecoin adoption have unclear stablecoin regulation, and therefore local fintechs are better off just supporting the existing dollar stablecoins than having their own. Specifically, when I worked in like Turkey or Vietnam, the fintechs there were much more reluctant to support stablecoins than the exchanges. So it's kind of like a chicken and egg problem of stablecoins were being driven to crypto exchanges because that's the only place where players at scale are willing to take stablecoins and have the fiat rails. And on the other hand, the fintechs were reluctant because they didn't want to lose their licenses, or the banks didn't want to lose their licenses. And therefore, you're driving more and more people into this like higher risk, perceived sometimes and sometimes real higher risk platform to interact with the dollar stablecoins. I think in the long run, I agree with Jose that things will change, but most likely it's going to look like dollar dominance will be higher in the stablecoin world than in the fiat world.
In which jurisdictions from you all's experience are starting to introduce those non-USD pegged stablecoins? And just based off of this, stablecoin sandwich flow of funds that you all are describing, are most likely to naturally have a resurgence in the adoption of their currencies on chain?
That you're seeing, so if you look at not only stablecoins, but in general, digital currency, because obviously places like Nigeria have been making significant progress on central bank digital currencies, and obviously China has as well. But if we stay strictly on the stablecoin side, there are small amounts of, for instance, there are a couple of stablecoins that are issued on Singaporean dollars. There are a couple of stablecoins that are issued on euro, but don't have significant traction yet. I actually think that you will see much more traction in euro-denominated stablecoins in terms of the large economic regions going forward. I think the MiCA does a very good job at providing a very clear setting, and there are things in MiCA that the industry would rather see refined, and there are still questions of how the deployment is going to work. But if you look at, there are regions that, different to the US, a place like Europe has a very clear instrument in the regulation that is e-money. It's a very clear definition of what electronic money is. And if you have that, then the proxy for a stablecoin is tokenized e-money, and that's something that is easy to put into one regulatory bucket. I think that gives an advantage for the development of euro-based stablecoins.
Yeah, I think we spent a lot of our time looking at what role will banks ultimately play. And I think it's really interesting that the stablecoin ecosystem today, it's almost entirely non-banks. It's fintechs, and we've just started to see a number of large banks start to step into the space. And so we've had SocGen in Europe. They've got EuroCV, which is a stablecoin euro-backed. We announced that we've partnered with BBVA. We're starting to work with them, helping them issue their own stablecoin. And so as Jose mentioned, I think that there's a clear framework in Europe. You'll see many more euro-denominated stablecoins. We've seen a lot of activity in Brazil. I think that the Central Bank of Brazil has been very much on the forefront of many payment innovations. And so we're seeing there's this top-down push of they're creating a wholesale CBDC that they call Drex as kind of the next generation after PIX. And then you have banks saying, wait a minute, if you have a wholesale CBDC, should I issue a tokenized deposit or a stablecoin that can then sit on top of that, can use the wholesale CBDC to settle? And so we think that we'll start to see banks play a much bigger role in bringing stablecoin-like products to market. And then the question is, if you've got 100 different stablecoins representing many different currencies, how do they interact with each other? And then again, you also have many different blockchains. And so it's not even just many stablecoins, it's many stablecoins on many blockchains. And so I think there's a huge challenge from an interoperability perspective of how do you just create end applications where it doesn't matter which branded stablecoin you have, it doesn't matter which chain, that these things can just work with each other. And I think we've made progress there, but there's still a long way to go to really make it work.
And Anna, I'd love to actually capitalize on this point and ask you, because Solana really has been at the center of the best user experience that most networks can bring when it comes to stablecoins, but also when it comes to just retail and increasingly institutional adoption as well. So for you, given the problem that Kai pointed out, where do you see the future of stablecoin interoperability to whereas all of these systems can interact on a single chain or across multiple chains and maybe settle on an anchor chain in a way that both institutions and retail can deal with and digest?
Yeah, I think there are maybe two orthogonal points to make here. One is that, to be blunt, while I would love cross-chain infrastructure to work, sometimes for Solana, when our block time is milliseconds and somebody else's block time is a couple minutes with block reorgs, it's just not going to work very well unless we're all on the same page for being slow. So my bull case is that high-performance chains will become more interoperable with each other, whereas lower performance chains are maybe great for store value, but really not good for a medium of exchange. On the other side, I think in terms of what could we bring in the future, there is both permission chains and very compliant chains with sometimes ZK privacy built in, oftentimes KYC ML built in, and then there's the open public blockchain. So Solana has taken the stance where Solana itself is a public blockchain. However, code is open sourced. Anyone can roll up and go build their own Solana permission environment. Same, you can go build like Hyperledger, Besu on EVM, and some of the other chains you can use the code. However, when you make that conscious decision as a bank or as a regulator or a central bank, you're making the decision that you want this to be sandboxed in your own ledger. And it's very difficult unless you are willing to interact with the public blockchains in order to be interoperable. So therefore, you're locking liquidity into your own bank or own consortium of banks. Going forward, I think some of the initiatives that the Visa, PayPal have been working on are trying to get banks more or the likes of those companies are getting banks more buy-in to build their own consortiums that are welcoming of other licensed or compliant players. So that's in the more like TradFi space. On the crypto side, we're seeing a lot of issuance as a service or on-chain. Basically, anyone can issue a stablecoin either by partnering with somebody like Paxos or somebody on-chain. And you're seeing those find their own liquidity venues to interact with each other on the public side. So you can build AMMs, which are liquidity pools that are similar to traditionally, I guess, FX markets, the equivalent, because now instead of having $1 that you go to every bank for, now you have 15 different dollars, and those 15 different dollars are not fungible with each other. So you need some central or decentralized point to clear those. And I think both of these will coexist in the future.
And Kai and Jose, you all mentioned, and also Anna, you alluded to it as well, this concept of the stablecoin sandwich when it comes to the flow of funds between fiat currencies, I mean, e-money, stablecoins, as we know them today, or as they're defined across different jurisdictions. Can you all elaborate for the audience, what is the stablecoin sandwich? Just to give clarity as to what that looks like.
So that expression usually refers to experiences, user-facing experiences, where the user, whether it's a consumer or a business, is interacting with fiat, and the perception is, and the reality is that they are seeing fiat, and the settlement in the background is happening in stablecoin. So similar to you use your bank to send a wire transfer to somebody in Europe, you don't need to understand what a correspondent banking system, nostro vostro accounts. You don't need to understand what SWIFT is. All that complexity is abstracted from you. You send a wire, and the wire, after some cost and a few days later, shows up on the other side. So on the stablecoin side, that's a little bit similar. If you think of retail payment use cases, I was in Singapore a few weeks back, and the best experience that I've had in wallet interoperability was when I landed in the Singapore airport. I wanted to call a taxi to go to a hotel. I was using the Southeast Asia wallet that is predominant. There is a company called Grab. But I couldn't connect my US credit card to ask for the taxi, so what I did is I pull up, but they accepted our stablecoin. So I pull up my US PayPal wallet, I send a PUSD on Solana to Grab, it showed up in 10 seconds in Singaporean dollars, I got my taxi and went off. That is the best experience I've seen in wallet interoperability in different jurisdictions. Still, it required that I knew how to pull up a crypto wallet and do non-chain transfers and the like. There is no reason why, with some time and some engineering hours put into it, you can abstract that from the user and just say, hey, you can load your Grab wallet with your US PayPal account. So that I do believe that for mainstream adoption, we will need to remove that complexity. Same thing that you don't need to understand TCP/IP to use your browser. Hopefully you don't need to understand how the Solana proof of history works to interact with stablecoins.
Yeah, just on that point, I think one of the really simple things that has just baffled us looking at stablecoins from a traditional payments perspective is the way that they've worked over time has been they're sent over a public blockchain, but you need to pay a transaction fee in the native token of the public blockchain. So if I send you $100 of USDC, a stablecoin, to a crypto wallet, you can't do anything with that unless you have ETH, unless you have SOL. And so you're asking a mainstream consumer to go and buy a cryptocurrency, even a small amount of it, just to pay the transaction fee to send fiat. It makes no sense. And so I think we're just now starting to get to the point where you've got really talented builders coming in from fintech who've created products that have reached millions of consumers. They're saying, wait a minute, why don't we just subtract that away? Why can't you just send a stablecoin and send fiat without ever having to directly interact with ETH or Sol or even know what a crypto asset is? And so I think we're starting to see the first products that decouple a stablecoin that uses a public blockchain from the underlying crypto asset in the transaction fee for it. I think that's a huge deal. And so we'll see more and more of these experiences that are stablecoin or fiat only. And I think that's really what it's going to take to get it out of just this niche crypto bros using it to mainstream consumers across the world being able to benefit.
As a crypto bro, I'll offer some nuanced takes here. I think many of you here learn how to send emails and do things online. So did I. I was towards the end of the millennial phase. So I think people in the future will most likely learn how to use crypto wallets. So hopefully much easier crypto wallets. Here's why I think it's important. Because there's been a lot of so-called stablecoin sandwich apps and those crypto apps that abstract away the key difference between crypto self-custody and knowing what stablecoins you own versus a fintech app that's licensed. So you're starting to see a bunch of these apps that are taking a very risky approach where they may not be licensed. They're showing you have USD. On the back end, they have USDC or maybe even TUSD. Who knows what it is? And you don't know. And USDC, or probably not USDC, but some other USD depegs, or they get scrutinized. Consumer still doesn't know. And in order to abstract away gas at this current point, I hope in the future it'll be better. A lot of times the product designer has to opt into a custodied version of the wallet. So in that case, they can help manage your balances, they can help pay for your gas and all that. But then that means your assets are no longer yours. And why would you use that when you can use a trusted entity like PayPal to custody your assets, and they're very much being observed by regulators and been around for much longer. So I think the trade-offs here are there are a lot of nuances where if you go for this and you're not protecting your consumers, or maybe don't have the best intention at heart, it could really hurt people's perception of stablecoin sandwiches in the long run, because it is a great tool. Stablecoins, we pay a lot of our grantees or people in the industry, we pay each other in stablecoins all the time, and people are all around the world. It's super fast. However, you also have these people that maybe were told hey, I'll pay you on this app, and then this app 3 months later disappears, and that's just not a great experience. So hopefully in the future we have more, both on the regulated side to protect consumers, but also let us crypto bros continue to experiment with what are some of the innovations that we can build on top of stablecoins and on an open blockchain.
And it's a very insightful point that you all are making, because I have noticed that increasingly as we want to make one unified experience both for institutions and also retail, there are some segments between the open source blockchains that most of these transactions are facilitated on, to the institutions that are known and respected, like the PayPals and the Visas, that people are going to facilitate those transactions. And then in between that, you have different jurisdictional, definitions as to what these assets are, and also how these systems can integrate so that you can abstract things like, native transaction fees on different blocks. So getting to our last question, where do you think the biggest fractures are between issuers, legislators, and dApp creators or applications that are, persisting, this fragmentation or this fragmented experience that institutions and retailers are experiencing today?
So I can get us started there. I think that there is a fundamental aspect of it, which is the distinction between the business of payments and the business of banking. So stablecoins are a really, really good instrument for payments. And that's the reason the PayPal got involved into them in the first place. We are not ideologues. We don't have laser eyes. We obviously sympathize with the ecosystem, but we're in this because I've been in payments for the best part of the last 22 years, and this is the first time that I've seen technology that can move money in a safe way 26 times cheaper than an ACH. So if that technology exists, that technology will be adopted and would be responsible as a payment actor not to have a horse in that race. But a lot of the conversation, especially in the US, is a conversation about banking, not payments. So if you look at the tokenization of different stores of value, you have stablecoins, which in my mind are tokenizing money, are tokenized PayPal balance. And then there are going to be tokenized deposits, and that's commercial bank money that gets tokenized, and then there are going to be CBDCs, which are tokenized central bank money. Those things are distinct, and they have their different characteristics. Stablecoins are a really good instrument for payments, and I'm sure that tokenized deposits, when they exist, are going to be a really good instrument for store of value and interbank settlement. But if you look at the stablecoin side, if stablecoins that are fully fiat collateralized and are in the business of payments, so there is no rehypothecation, there is no fractional reserve. And sometimes the debate happens on two axes, and is whether supervision should be at the federal or state level, and whether it should be payments or banking-like. Our opinion is that stablecoins are a really, really fit instrument for payments, and that's where we believe that you're going to see the best advantage.
I think one of the challenges right now is like the term stablecoin, it's a concept. There are many different products that are created that have many different designs and many different levels of risk. And so I think we've had this challenge over the past few years where anyone has been able to create a product that they call a stablecoin. And if you could compare two products that are marketed to consumers as stablecoins, they could be entirely different around, is there a fiat asset behind it? If so, where are those reserves held? What audits or attestations are done? And so I think it's a really challenging environment for consumers, if you're being offered a stablecoin, to have to go under the hood and due diligence on the issuer and where they're holding the money. So I think being able to have common frameworks and rules around, if you're issuing a stablecoin, here's the base level requirements that consumers should expect. Or if it's not, you can't call it a stablecoin. And so I think just the term itself has created a lot of confusion. And if we want to get to that world where we can abstract it away more, create better experiences, I think you have to have more standards around what a stablecoin is, instead of anyone can create one and call it a stablecoin, but who knows what's actually behind it.
Yeah, I think the industry has started to distinguish or self-regulate, where stablecoins are considered generally tokenized narrow banking products, whereas synthetic money or internet bond or synthetic dollar or whatever are asset referenced tokens that try to peg close to the dollar or euro or whatever else that they are, but oftentimes are, I wouldn't go as far as algorithmic, because by now I think we're past the time of being algorithmic, but we're are oftentimes backed by, let's say, CLOs or trade finance, or maybe even ETH and Bitcoin or delta neutral positions, and those are simply not considered to be or should not be considered for daily average consumer use cases. Those are for the crypto bros that want to trade or want to use it for other use cases. So having that distinction would really help. And then from a regulation perspective, allowing this maybe sandboxed, but maybe like supported environment for builders and dApps to experiment in both worlds would be super helpful, because if you axe the entire other innovation part, stablecoins would never have existed in the first place. It came out 10 plus years ago as an experiment that if a US banker 10 plus years ago saw it, would probably have axed it. So in order to get to where we are, it meant that there were players that had to push the boundaries. And in order to get to where we want to be, I think that's something we would like your support as well.
Well, Jose, Anna, Kai, thank you so much for your time. And everyone, this is our stablecoin panel.
Thank you.
So ultimately, we are still an academic institution in terms of our academic moorings, and we like data. And just to put that last conversation in perspective, we're having Robert Lay from PitchBook to give us some information on the latest of stablecoin and crypto markets. Robert is a tradition. Pretty much every year for the last, when we were still in the basement, this guy would come through and give us the latest data. So I'll listen to Robert, and we'll figure out where we are in crypto.
Thanks a lot, Chris. Hello, everyone. My name is Robert Lay. I'm a research analyst at PitchBook covering crypto for the venture capital and private markets. And for the short presentation this morning, we're going to continue the conversation we just had on stablecoins by adding a little bit of context and data to stablecoins, and then we'll look at crypto investment activity and then what we can expect looking forward. So for the state of stablecoins, today, stablecoins are, what we can see is that the total supply of circulating stablecoins have continued to increase over the past few years despite depressed crypto trading, regulatory challenges, and uncertain economic environments. And you can see that today we have roughly $170 billion of stablecoins in circulation. And we expect that figure to continue to go up to surpass the previous all-time high sometime early next year. And as you can see, the previous all-time high occurred in the spring of 2022 when there's roughly $190 billion of stablecoins in circulation. And that happened right before the algorithmic stablecoin Terra collapsed. And if we look at stablecoin transaction volumes, you see an interesting trend. In 2023, stablecoin transaction volumes exceeded some of the traditional payment systems like MasterCard. And even if you adjust for a lot of the inorganic crypto trading that's done by bots, stablecoin transaction volumes still exceeded that of PayPal's. So it really shows that there are broader financial use cases for stablecoins outside of crypto-native use cases. And if we look at the US dollar pegged stablecoins, you can see that the US dollar denominated stablecoins dominate the market. There's almost 99% of all stablecoins in the market are USD denominated. So we really view this as a positive for the US dollar. It really shows that it's an anchor currency, and having US dollars on chain as the dominant currency really provides that it is the global reserve currency, not just off chain, but also on chain as well. And as we can see, Tether leads the market with over $120 billion in circulating supply, with Circle following second with roughly $35 billion. Over the past year, we've seen some new stablecoins come to market that have gained significant traction as well. PayPal, for example, is one. Athena is another that we've seen their circulating supply has increased significantly. And every single month, we hear new stablecoins coming to market. So we expect the universe of total stablecoins to continue increasing. We heard that in the last panel, right? Banks are getting into it, traditional financial institutions are getting into it. So we really expect all the universe of stablecoins to really continue to expand in the coming years. And stablecoins, when they first came to market, the primary use case and adoption was primarily for crypto trading. But one of the more exciting developments over the past couple of years is the proliferation of non-crypto use cases for crypto, especially in emerging markets. And so for in regions where there is unstable national currencies or unstable economies, we really see stablecoins step in as a means to be able to access transactions and be able to freely transact without going through traditional banking systems. And so we've been seeing stablecoins used for remittances, for cross-border payments, to pay for goods, to receive and send salaries, and a lot of the times as a means to indirectly hold the US dollar. And so to give you a little bit more of a specific example, last week I was speaking to a blockchain platform in LATAM that were helping importers pay their suppliers using stablecoins. And the reason that they do this is because a lot of the times it's faster and cheaper than going through traditional banks. And sometimes it's actually their only option because their banks do not hold any US dollars for them to be able to pay their suppliers. And so we see a lot of real-world use cases for stablecoins, and especially in environments where the traditional financial system has not been able to effectively serve their customers. And so we're going to shift a little bit and just look at the broader crypto markets and see how much investment dollars have been going into the crypto space. And as we can see, 2024 is not going to be a blockbuster year for venture capital investments in crypto, but we can see that investments have still remained relatively resilient. We do believe that this year the amount of venture capital invested dollars will surpass last year's $9.8 billion that was invested into crypto startups, but obviously is much less than the 2021 and 2022 peak years. But still, we think that there is appetite for crypto startups. Investors are still deploying money, even though many of the generalist venture capital investors have moved on to other areas like AI and health tech. The crypto native venture capital investors have remained committed to this space. And if we look at the quarterly figures for investments, Q1 and Q2 were really relatively strong quarters for investing in crypto. A lot of this was driven by the recovery of the crypto markets in 2023. We saw Bitcoin, it's up about 3x since the beginning of last year. And then also at the beginning of this year, the approval of the spot Bitcoin ETFs in the US really drove positive investor sentiment into the crypto space. So you saw a relatively strong first half for investments. But notably, if you look at Q3, there's a downturn. So it really shows that investor sentiment in crypto is still fairly fickle and tenuous. And if we dive a little bit deeper, we want to see where have investors been deploying their capital. And it's really been spread across three core areas: fundamental blockchains, infrastructure and dev tools, and Web3. And so this is actually different from what we've seen in the last cycle, where there's a lot of concentration of capital into one or two core areas. Specifically, last cycle was all into centralized exchanges, so crypto exchanges, NFT exchanges. This cycle, we're seeing a little bit more of a diversification. For us, it's more of a positive view, because investors are seeing innovation across the entire crypto ecosystem and not just one area or two areas. And so what can we expect for the next year? And what we're seeing is that traditional financial institutions are going to continue to increase their participation in the stablecoin markets. We saw over the past year, S&P came out with their stablecoin ratings, which we believe will provide more transparency and trust into the stablecoin markets. Many of the large asset managers like BlackRock, Franklin Templeton, and Fidelity have all came out with tokenized money market funds. And what we see is that these tokenized money market funds and the related tokens have the ability to compete directly with the stablecoin issuers of today. And the reason is because those tokenized funds are built on public blockchains. And so the asset managers can choose to unlock utility of those tokens over time for them to have very similar use cases as stablecoins. And for example, Franklin Templeton, they have a tokenized money market fund with the related Benji token. And earlier this year, they announced that you can enable the peer-to-peer transfer of that Benji tokens. And we expect Franklin Templeton to unlock more utility for Benji, and eventually it's going to look very similar to a stablecoin. And so having and I guess the last one is Visa. We heard just in the last panel, they're building a VTAP platform to enable banks the ability to issue and manage stablecoins on public blockchains. And that is expected to go live next year. And so we do expect banks to come on board to start issuing stablecoins on public blockchains. And so we really think having traditional financial institutions coming into the stablecoin space will really increase its adoption and accelerate its mainstream use. And last, we think that as investments continue to come into the stablecoin space, we do believe that it could be a key indicator for a stronger crypto market to come. We just heard earlier this year, Circle signaled its intent to go public by confidentially filing its S1. And this is also a good barometer to see how the public equities markets view stablecoin businesses. And then just a few days ago, we heard that Stripe announced that it's going to acquire stablecoin platform Bridge for $1.1 billion, which represents one of the largest deals ever in the crypto space. And so these investments, if they close, really could indicate that there is investor confidence in stablecoin businesses and that they're seen as having high market value. And if that is the case, we do expect to see more investments go into stablecoin issuers, into stablecoin service providers, and into infrastructure. And so thank you for your time. I'm really excited to see what's next for stablecoin businesses and crypto for next year. And if you have any questions, my name is Robert Lee. Feel free to come up and talk to me around the conference.
Okay, so we're going to try a massive social experiment right now. A couple of, I usually wait to provide a little bit of rules of the road for this particular conference. There is, as you can imagine, a lot of demand that has grown for this conference over the year, and we've tried very hard to be able to get as many people into the space to be able to listen as they can. Now, we're about to take a break. And now, why is Chris actually going through this period? Because several things have to happen in this break and throughout the day. Number one, if you are seated, you got to take your bags with you. There is no, if you're in law school, no adverse possession of your seats. That does not exist for this conference. Number two, when you return to your seats, because our breaks are relatively short and people are like, man, it's intense. I'm like, I'm a law professor. Of course it's intense. I'm trying to give everybody an MBA in a day, right, in fintech. So when you come back to your seats, you must sit in the middle of the rows so that other people can then move to the side of the rows because, again, the demand is larger than the supply. And otherwise, I have to become Cranky Chris and Cranky Law Professor and say, hello, you in the front row, and I'll start asking you questions. So you have to go and sit, again, in the middle of the seat. Thirdly, you will notice this has gone extraordinarily well because we've had, frankly, all of you are very well-behaved Washington, D.C. people or the feds or somebody. So when you get back and when the event starts back up, I guarantee you that if you are whispering kind of, I don't want to be like, going to New York in the quiet car. This is like quiet car. And there's always someone who thinks that they're not quiet in the quiet car. Don't be that annoying person. Right, your voice can carry, and we have a lot of important conversations today being streamed over Bloomberg and CNBC and all these other kinds of places. So when you come back, shh. No. All right, so with that, we're going to have a quick break. We're getting some more policymakers for another conversation. And again, let's focus on the mission of getting back, middle of seats, no taking your stuff with you. We have refreshments, coffee, and the like. Thanks so much.
The program will resume in 5 minutes. The event will resume shortly. Please welcome back to the stage the founder of DC Fintech Week, Chris Brummer.
All right. Thank you, everybody. We are going to now have that approach of the social experiment. Everyone in the back room, particularly for the coffee, and people talking to reporters, and people doing deals or writing legislation or arresting people, whomever you may be doing right now, you have to quiet down for our next session. Quiet down for our next session. Excellent. It is a real pleasure to have some of the world's experts who come here every year to talk about fintech, and this particular session on the past and future of tokenizing real-world assets is set to be a special one. It's also more special when you have your former law school colleague, who is now a big-time lawyer, to lead this session. But I'm going to call Yvette and her panel to the stage to really get into the nuts and bolts as to what tokenization is and what is a real-world asset. So welcome back to our next session, and I'll welcome the folks to the stage.
Welcome, everyone. We're going to talk about real-world asset tokenization, past, present, and future. Thanks for being here, and thank you, everyone, for joining. My name is Yvette Valdez. I'm a partner at Latham & Watkins, and I'm joined here today with Commissioner Peirce, David Nunes, who is CEO of Six Digital Exchange, Per von Zelowitz, who is the director of New York Innovation Center of the Federal Reserve Bank of New York, and Danelle Dixon, who is CEO and Executive Director of Stellar Development Foundation. So I really think this conversation is a bit of an evolution of some of the discussion we had yesterday. Acting comptroller of the currency was, I thought his statement was really interesting yesterday when he effectively said, you know, tokenization of real-world assets is not really about crypto. Right? It's about creating frictionless financial markets and effectively integrating distributed ledger technology into our financial markets. And I think that's true, but there's still certainly some challenges to think through and things that we're going to talk through. So to set the stage, tokenization of traditional financial markets really has the potential, I think, of revolutionizing how we do business. It's indeed already gaining momentum. We'll talk about that specifically with David and Per. And I would posit the tokenized real-world assets have the potential to stimulate lasting widespread adoption on a global scale. Interestingly enough, while radio, television, and email took 30 years to generate mass adoption, a report by the Bank of America Global Research last year expects tokenization of real-world assets to transform financial and non-financial infrastructure and public and private financial markets over the next 5 to 15 years. Thought leaders are predicting that tokenized assets will make up 10% of the GDP by the end of the decade, and that total market value of tokenized assets across all industries will exceed $10 trillion by 2030. So how are we going to get there? So Commissioner Peirce, I'd like to start with you. You know, as I just mentioned, this really isn't about crypto, but I think for all the lawyers in the room as well, you know, the question is, what is really our regulatory path forward? How do we have a clear path, and do you think that putting our financial markets on DLT is going to face the same challenges that we have right now with crypto in the United States, and how do we regulate around these markets?
Well, thanks, and it's great to be here. I do want to give you my disclaimer, which is my views are my own views as a commissioner, not necessarily those of the SEC or my fellow commissioners. And I think when I think about this problem, I think you framed it really nicely, right? It's that this is really something different than a lot of the crypto world that we've been talking about to date. But I think the problem is you still have the same regulators, and you have regulators who are looking at it as being crypto, as being an aspect of crypto. And this has been one of the things for me that has been the most frustrating about watching our approach in the United States to regulating crypto, we have precluded interesting experiments in using the DLT as a way to displace existing infrastructure in the financial services space, because people have not felt a welcoming attitude from regulators in trying to experiment with those kinds of things. And so they've done that in other jurisdictions instead of here in the U.S. But I think if we could get past that and we could start to think, wow, this could really transform the way things are done, it could eliminate some of the frictions that we're concerned about in this space, then I think we could allow small-scale experiments. That's something that I've advocated, that we have some sort of a sandbox structure where people can come in and say, hey, this is the experiment I'm trying to try. I want to try, and here are the conditions that I want to use. And it sort of would force the issue at the SEC. Instead of having to come in for a no action letter, or an exemptive order. This would say, no, we're going to try this, and we'll tell you how it works out. Here are the conditions. And the goal then would be to get to more permanent relief. So I think something like that in the area of tokenization could be helpful. Now, a lot of real world asset tokenization is not going to be within the SEC's remit at all, is my guess. So yeah, if you take a bond or a stock and you tokenize it, that's certainly within our remit. Our rules already are there. You just have to apply them to this new form. And so to the extent our rules are technology neutral, they should be able to accommodate those kinds of things. Again, you may need to make some adjustments, but we have the authority to do that. I've been complaining for a long time about the fact that we haven't updated our transfer agent rules, but this could be an opportunity for us to update them with a real understanding of why it's important to be technology neutral, so that we could really allow the blockchain to be the record as opposed to having to have some off-chain record. So I think there are a lot of things for us to think about, but we have to be willing to think.
Just one follow-up to that. As a regulator, when we sort of see this dialectic, and Chris actually stole my question, but I'm still going to ask Commissioner Peirce, when we have sort of this technology and it's evolving at a rapid rate, how do we square trying to be nimble against sort of the reduced discretion that we now have given the return of the Chevron doctrine? It's a balancing act. What are sort of the principles that the regulators really need to come to the table in order to properly regulate this space?
I mean, I think it's really just trying to appreciate the fact that this technology can help us as regulators. It can make our jobs easier. It can address some of the issues that we've seen. With respect to the elimination of Chevron, I mean, that certainly is a landmark moment, but the SEC has always known that it's going to go into court and it's going to face questions, and so we should be coming with our strongest game in terms of what our statutory authority is. And so I think even if Chevron were in place, we should be asking those questions. Are we staying within our jurisdictional bounds? And that's something that in recent years we've been straying outside of. And I think especially in this area, it's really important that we stay in our lane, that we make sure that we're not stopping people from doing things that are tokenizing when it's tokenizing something that just isn't in our space. We can stay out, and that's someone else's issue to deal with.
Thank you. Let's turn a little bit to a bit of the past, but we're going to at the same time look into the future. The World Bank priced the first Swiss franc digital bond, which will settle using Swiss francs wholesale CBDC provided by the Swiss National Bank. The 7-year Swiss franc $200 million digital bond, it wasn't dollar, it's Swiss franc, is the largest World Bank Swiss franc bond issuance since 2009 using distributed ledger technology, which will support the financing of the World Bank's sustainable development activities. The issuance, which was on SIX Digital Exchange, SDX, follows the World Bank's recent digital issuance on Euroclear's digital financial market infrastructure. So if we turn to David Nunes and we look a little bit to the future of what I think we're going to see here in the U.S., certainly, as predicted in the next 5 to 15 years. we see a regime that is already shaping and is already incorporated into an integrated tokenized capital markets. SIX Digital Exchange, SDX, is the world's first fully regulated stock exchange and central securities depository, which is effectively doing tokenized digital issuances in the capital markets. So what you've done is a little bit like looking in the future for the U.S. Can you talk to us about the experience to date, the successes, some of the challenges that you see? And in particular, I want to sort of look under the hood and address the utilization of wholesale CBDC and its importance, and your views on that, and sort of the integration as well on stablecoin into these issuances, and effectively how that infrastructure works.
Well, thank you very much, and thank you very much indeed for having me. Yes, I think that to Commissioner Pearce's point, so Switzerland is an example of what you can do when you have an environment that can support innovation and exploration in this particular space. So, as you mentioned, SIX Digital Exchange is the world's first financial market infrastructure to be granted a license to operate a CSD and an exchange built on blockchain technology. That was back in 2021. And that was possible because I think we have in Switzerland a regulator which has clarity around our digital assets regulation, and also is an effective regulator as well when it comes to applying those regulations. It has a track record of having a sort of deep understanding of digital assets more broadly as well, and has supported the Crypto Valley and the innovation that represents. So that's given us a capacity within Switzerland to actually build blockchain solutions, whether it's on the fully regulated side, which SIX Group, which is what SIX Digital Exchange is part of, the FMI for Switzerland, has been exploring since 2018 when they first embarked on the SDX project. What the challenge we've had is, first of all, well, we had a regulator which supported this innovation. We then got a licensed blockchain, which then enabled market participants to then carry out activities on that blockchain with relation to digital asset securities, based securities. We have the ability on that blockchain to do the issuance and the trading, settlement and custody of digital securities in a fully regulated environment. But that enabled us to bring on board quite a sizable number of banks onto that network. The challenge we've had that we experienced after the first issuance and the subsequent issuances we had was that the cash leg aspect of having cash on chain was somewhat was a major constraint to scaling. So the first thing is get regulation in place that enables this innovation to happen in the first place. The second issue is getting participation, but then that participation is going to require a riskless settlement asset. And we looked at various different ways that you could achieve that with cash on chain, and the most optimal manner that we, having explored bankruptcy remote vehicles and trigger mechanisms and other technology solutions that can achieve something similar. It was a wholesale CBDC, and that's specifically a wholesale, not a retail. There's no interest in Switzerland around a retail CBDC that was required for scaling. Because if we have to hold tokens as a market participant on our balance sheet to enable transactions to occur on a regulated blockchain, if they're anything other than a riskless settlement asset, that incurs a balance sheet charge. So the more activity, the higher the capital charge associated with that, and therefore you immediately have a scaling issue when it comes to participation. So we've been working with the SNB, which I think is a very innovative, forward-looking central bank, possibly the most of all Western developed economies, and on various CBDC experimentation for a number of years now, cross-border as well as within Switzerland. And in December of last year, we carried out the first transactions in wholesale CBDC on a production environment. So by June of this year, by the end of that phase of a project called Helvetia, phase 3, we settled 750 million francs worth of bonds that have been issued by the city of Zurich, the city of Basel, the UBS, city of Lugano, and ultimately also the World Bank, which $750 million, which added up to around 1.5 billion francs worth of bonds we've issued in total on the platform so far. We also saw the Swiss National Bank conducting the first ever monetary policy operations on a regulated blockchain. So they issued SMB bills, again settling in wholesale CBDC, and that sort of really enabled us to show that we could, from an operational perspective, a technical perspective, in a regulated fashion, safe and so on, actually facilitate these transactions and these different use cases in wholesale CBDC on a regulated blockchain which gave the SNB and our market participants the confidence to then proceed with what's called Helvetia Pilot, which is now a minimum of 2 years of supporting wholesale CBDC for a broader range of use cases on the Six Digital Exchange platform for the issuance, trading, and settlement of securities, digital securities on the platform for at least 2 years with an option to roll that forwards. And that's then enabled us to sort of encourage even more activity on the platform, which then at this point, I think we said we've achieved equivalence in terms of what you can do on this regulated blockchain versus traditional infrastructure, and has now enabled us to start deploying more blockchain-specific solutions, ones that actually use the sort of intrinsic qualities of the blockchain to actually facilitate totally new sort of financial innovation. And that's around the fractionalization of assets, it's immobilization of collateral, tokenization of non-traditional assets, and so on. So I think this is all building up to the point we're at now, where we can sort of step into the next generation of financial market infrastructure, which will support innovation for the Swiss Financial Center for the years to come.
Let me raise, I mean, all of this is fascinating, and it brings me sort of with my legal and regulatory hat on, brings me to the question that gets asked so much here in the U.S., which is analogized across all of the issues that we think about when we think about digital assets and Web3, is sort of putting the financial markets on notice for hacks, cybersecurity risks, technology risks. All of that seems quite heightened when we are integrating this type of technology. Is it a myth? Are there lessons learned on technology risk assessments that, we need to be aware of, that we need to sort of legislate or regulate around, that is unique to potentially the analog systems that we still function on? Or is it even better, right? We've heard commenters certainly say that actually the risks posed are then solved by the technology itself. Like, what are your thoughts on that? And anybody on the panel, frankly, who would like to address that?
I'll briefly go in that it was obviously required that we address those concerns with the regulator before they granted the license. Given their experience in public chain, they have a lot of insight into where the risks actually are. So we had to sort of indicate how we were going to address those particular risks. I think one of the obvious aspects of Six Digital Exchange is that we run a private permissioned ledger, which enables us to have complete sort of governance around the perimeter of the technology. We are in discussions with the regulator about how we can extend operations onto public chain, but in a way that's obviously safe and secure, and it does indeed. We end up having those issues or questions around how do we actually facilitate those operations in a way that doesn't actually in any way add risk to our primary requirement of being a CSD. So that brings into focus sort of where does settlement finality happen. That definitely happens on technology that we have as a CSD have to operate and own the risk perimeter, the governance perimeter around that. So I can see that we are enabling ourselves to extend into public chain space, which I think is what you're kind of getting at, but in a way that I think again is safe and secure, and doing it in a step-by-step fashion.
Thanks. Per, why don't we sort of follow to you, right? On the heels of what we heard from David, the U.S. banking system has actually been actively engaged, rolled up their sleeves, and participating in Project Agora and also the RSN POC. Can you walk us through your work in those two projects to date and what the U.S. has, really been looking at from the Federal Reserve Bank point of view?
Absolutely, very happy to, and it's a pleasure to be here with you all today. Appreciate the opportunity. And I'll start with my disclaimer also, which is any of my comments reflect my own opinions and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. And the New York Innovation Center at the New York Fed, where I work, has a mission of generating insights that inform central bank-related opportunities that ultimately can lead to innovations that may enhance the functioning of the global financial system. So all of our work is really anchored in that sort of mission. And the type of work that we do is also based on a model of collaboration. So we have a team at the New York Fed. We work extensively with colleagues across the entire Federal Reserve System, so try to identify these subject matter experts that provide us with the depth of expertise in the areas that we're focused on to ensure that we're doing the smartest work possible. But also, we work extensively with other colleagues outside of the Federal Reserve System. Primarily, we have a strategic partnership with the Bank for International Settlements, Innovation Hub. We work with the private sector, with technology vendors, consulting firms, banks and non-bank financial institutions. And that also provides us with the breadth of capabilities that we need to actually do the work that we're conducting. So this model of collaboration is really a critical component of how we do our work. And the practical work that we're doing, and you referenced two of our current projects, Agora and the Regulated Settlement Network. Those are two that are currently underway. And there's a body of research that's really led us to this point with Agora and RSN. We started with a project called Project Cedar a couple of years ago, and there's a progression through all of our projects that's led us to the point where we are now. Project Cedar focused on understanding, can tokenization deliver certain benefits relative to foreign exchange capabilities, and there was a phase 2 of Project Cedar that we conducted in collaboration with the Monetary Authority of Singapore, which focused more on interoperability, another critical aspect to test if tokenization is really going to work at scale. We then worked on a project called the Regulated Liability Network, or RLN, which added additional assets to different use cases that we were focused on, and also added complexity around cross-border and payments-oriented use cases that we believe are high-value use cases to focus on. And it's really that progression that's now led us to Agora and the Regulated Settlement Network projects. RSN has expanded the focus on different sorts of digital assets that might benefit from tokenization. It's also added complexity relative to the interoperability problem that exists that we're trying to understand how we might solve for that. And Agora is an example of a project that's global in its scope. We're working with 6 other central banks and 41 private sector organizations in that project. That really provides us with an incredible opportunity to learn from many of the users and customers of these new types of products and services. So there's been this clear path through all of our research that's led to this point of complexity with the projects that we're testing today. And one thing that I would emphasize is that all of our work is focused just on research and experimentation. So we're not building production systems with the work that we're doing, but we're conducting research that ideally might inform what production systems, if they come to market, might contain. So we're very excited about the work that we're involved with currently. Some of the key areas that I referenced earlier that we believe are critical to understand relative to the progression of tokenization include interoperability, so understanding how these different systems will communicate with each other. If we can't figure that out, this isn't going to work. That's also based on a hypothesis that we have that the future will really be heterogeneous. There won't be one ledger to rule them all. There won't be a single system that ultimately provides products and services within a tokenized domain to the financial system. But there'll be different ledgers. There'll be different infrastructures that are available to different consumers, different industry actors, different banks that are specific to the use cases that they're focused on, to their risk profile, to the jurisdiction that they represent, and those sorts of things. So if the world is going to be heterogeneous, interoperability is one of the things that needs to be solved for to figure that out. And as we think really towards the future and what the future might look like and the role of the New York Innovation Center and central banks for the future, there are a few things that we have in mind. One is that traditionally central banks have played an important role relative to innovation in financial markets, and they've done that together with collaboration with industry. So it'll be interesting to see how that evolves in the future within the tokenized domain. That collaboration, again, is a critical component of our working model, and I think will be an important success factor if tokenization really is going to evolve and develop at scale. So I'll stop there.
Thank you, Per. It's fascinating. We have just a couple of minutes left, and I really want to end on a really high note. We've heard all about the great work that the banks and the private sector exchanges are doing, but I want to take a minute to highlight what Stellar Foundation is doing. They have been assisting with the movement of humanitarian aid for the UNHCR and in connection with MoneyGram as well. One statistic, Danelle, that you shared was that you've sent over $4 million in aid to Ukraine and various refugee camps and has saved $12 million in operational efficiencies. Tell us about the great work at Stellar Foundation and how these rails make movement of aid, incredibly possible to reach sort of the underbanked and those that just don't have access.
Yeah, thank you. It's so great to be here. These are my opinions and the opinions of the Stellar Development Foundation. So we are really focused on tokenization, and tokenization has been such an important piece. What we're in the UNHCR case, that's tokenization of fiat. So USDC is the asset that's leveraged. There's tons of interoperability here because it's interoperability with traditional financial infrastructure like MoneyGram, so that the recipient can receive a text message from the UN saying you are eligible to receive aid, and then they to download the wallet. They download the wallet. The aid is in the wallet. So the aid gets to them in less than 3 minutes of the whole process. And then they can choose, do I want to put it in my bank account? Do I want to cash out at the local MoneyGram? What do I want to do with it? And that gives them not just the opportunity to receive this aid, but a lot of autonomy and independence to what they do with it. There's security. There's a lot of different pieces that come along with it. So it's just a great example of tokenization working cross-border and making it so that lots of folks can actually participate in this. And the UNHCR has expanded their efforts outside of Ukraine, and it's just been wonderful to work with them. They did this project. We started in February, right after the war in Ukraine began, and they launched by December of that year. So that was remarkable in terms of speed. But I also want to talk about tokenization that's happening with the blessing of the regulators domestically, and that's the Franklin Templeton has issued a money market fund on Stellar. And it's the largest money market fund, and the SEC has been working with them since 2019 to make this happen. So we do see a lot of there's also bonds that are on Stellar issued by Wisdom Tree. So tokenization is it's alive, it's working in the United States. We see lots of interest in it. So I kind of love what we've done working with the regulatory bodies to make this come together. I want to see more. I want to see more clarity. We want to see more ease of use here. But it's pretty remarkable, and I see that it's the present, but it's the future. We see this as becoming something that we're going to see tokenized bank deposits. There's going to be a lot of really cool things to be able to make things like aid and just traditional financial infrastructure work more smoothly from an interoperability standpoint as well. You can't do one without the other. We need it all to work together. And I'm 1,000% in agreement that you don't have one distributed ledger technology although everybody should check out Stellar, because it's pretty great, but they all should work together and there should be an interoperability layer.
Thank you. Thank you, everyone. Thank you very much to the panel.
This is a real pleasure. Again, I think it's one of the first times where I get to introduce two panels referencing people I went to law school with. So, long time friends. It is just such a pleasure and an honor to have Superintendent Harris here with us to continue the regulatory dialogue on all things fintech. It has now been, which is remarkable, 3 years since you took the helm of the Department of Financial Services. We're in Washington. Everyone is very well aware of the importance of New York as a financial center, the importance of the regulatory regime. You guys are sometimes, very often, moving both in ways in which individual regulators here can't, given the breadth of your mandate. The speed with which you act is impressive. Maybe we can, though, look at those 3 years, a quick retrospective. I asked Chairman Benham as well the same question. What do you see as some of the most important accomplishments that you've been able to introduce, and also lessons learned from running such an important institution?
Well, first let me say, while there's a lot of CLS in the House, there's maybe only one law school colleague that got all the outlines from the 3L when she was the 1L. So here we are, 20 years later. So thanks for those.
No problem. I'm sure that's been enabled everything.
So it's been 3 years, as you said. For those that don't know, the Department of Financial Services, we oversee banks, credit unions, insurance from PNC, life and health. We're really the only prudential regulator of cryptocurrency in the country with crypto-specific authority. Mortgage lending, student lending, pharmacy benefit managers, sort of you name it, we regulate it. It's been, as you said, three years, and we've really been able to do some incredible stuff. I think on the one hand, we've really been rebuilding the department. So I've hired about 500 people in my 3 years there, promoted another almost 500 people.
That is remarkable.
We've gotten about $600 million in restitution, so not penalties, but restitution for New Yorkers. In that time, we've issued about 43 regulations. We've done 93 pieces of guidance across our entire remit. We're doing a technology makeover. So we've really done some incredible stuff. Among the regulations we've put forward, we changed the methodology for check cashing fees in New York and made it much less predatory and more fair for those who use check cashing services. We've just issued for comment a health equity reg that would require our health insurers to collect demographic information on their insured so that we can see how different communities are utilizing their health benefits and use that data to determine what other policy interventions might make sense. We've just passed paid sick time for prenatal visits in New York. We just made insulin free for all New Yorkers recently. So we've really been quite busy.
Yeah.
And we've created a crypto team. It's now the largest crypto team, I think, anywhere in the world, with 60 people who are devoted to virtual currency all day, every day, and brought some of the biggest crypto enforcement actions in the country, including getting over $2 billion back to consumers earlier this year in an enforcement action against Gemini Earn.
Well, and again, we're talking a little bit about administrative law. What I think for a Washington, D.C. audience is important to keep in mind when you hear about that breadth of authority is that in your states, you do have so much power and responsibility over a broad swath of activities that you don't necessarily see in the federal regime, which can be very deep and national in scope, but very siloed, whereas your scope is inherently very interdisciplinary. And when I hear things like data sort of popping up, it wouldn't be a fintech conference and without a little bit of a discussion about AI and data. AI being obviously an application of data. How have you approached both philosophically and practically AI? Is it a story of this time it's different, something is new? What do you see as the pros and cons, the risks and the opportunities?
Yeah, I think there are lots of risks and lots of opportunities, but I think as we approach any sort of novel technology, whether it's AI, whether it's been virtual currency, is really, and I think this is unique to state regulators, how do we balance protecting consumers and markets with also creating a thriving business market and a thriving economy? So we do also have that economic development mandate as part of our mission. So when we think about AI, we've taken a couple of approaches. One is we try not to boil the ocean, right? It's so big, it's so complex, it's so fast-moving. So we've issued guidance for our insurance companies around AI and pricing and underwriting. We deliberately left out claims management, customer service, all these other use cases for AI, and really tackled the pricing and underwriting. And to your point, I think took a little bit of old frameworks that still make sense and apply to AI and new technologies, but then layered on those additional risks or considerations that come with new technology. So we said very clearly, anti-discrimination frameworks still apply. Just because you have a new fast-moving tech doesn't mean those frameworks fall by the wayside. Third-party vendor management, right? It is not sufficient if you have an AI company that's developing your algorithms or your applications to say, we're not responsible. We as the insurance company are not responsible for discriminatory outcomes because it was a vendor that, that wrote the algorithm. And we said, look, third-party vendor management is a tried and true regulatory framework, and it still applies here. So we did that with insurance and underwriting and pricing. Just last week, we issued guidance on AI and cybersecurity, both the enhanced threats from cyber actors in their use of AI, the increased sophistication of social engineering attacks, but also best practices for how institutions should be leveraging AI in defense of their systems. And then the last thing I'll say is we are also internally using AI in our supervision, because you mentioned the breadth of the things we cover. So how do we use AI to think about our supervision and to bring together insights from the different areas? So one thing we're doing, we're partnering with the State University of New York and their new initiative around AI and quantum computing, and saying, how do we take our insurance data, our mortgage data, and climate data, and overlay those things on top of one another and think about climate risk for insurers, for banks? How do we think about climate redlining when we think about fair lending and knowing that LMI communities are disproportionately impacted by climate change? How do we put all that data together and then leverage AI to help us be better supervisors given the breadth of what we regulate?
Yeah, so I'm hearing certainly the reg tech, the soup tech, the soup tech, I guess more so on the supervisory end. I'm seeing, and it's really interesting. So, certainly you're attacking, I guess, some of the mission critical areas. I mean, when you get to pricing, underwriting, you're getting to sort of core aspects of the financial system. In that boiling the ocean, just because is really interesting. Are you? Is it like that's what we view as sort of the base layer? Like, you gotta make sure that new applications of technologies are not exacerbating discrimination or not sort of facilitating fraud, and then you get into more sort of technically or sort of specific areas. I mean, because you had mentioned claims and the like. Is there a reason, or is there an order of how a supervisor goes about looking at these?
Well, we really thought about the ordering in terms of what do we see our companies doing and what are they most interested in. So when we talk to our regulated insurance companies, for instance, they were sort of more eager for guidance on the pricing and underwriting side. And I think, too, this goes to the bevy of tools we have at our disposal, right? You can write rules. You can supervise and examine institutions. We also really like to leverage guidance, right? Because it's a way to act more quickly, stay abreast of risks and developments in the space, but give our regulated entities a set of tools and a framework. And even though for guidance is not subject to administrative law procedures, we always put out our guidance for notice and comment, because we know this is a complicated area. We want input from academics, from industry, from legislators, right, so that we are getting as close to right as possible, but maintaining a framework that's flexible enough and nimble enough to evolve with the space. So I think very quickly you'll see things on claims, you'll see guidance from us on AI and banking, on AI and climate, but I think it's really important for us to take those narrow slices and be able to go deep. I think the other thing we've done is we really tried to provide guidance on how we expected testing to go. So we heard a lot from the insurance industry, well, how are we supposed to test for discriminatory outcomes? And discriminatory sort of in the bad sense, not in the sense of insurance is by nature a product around discrimination, right, and underwriting risks. And we said, look, here are the statistical methodologies that we know work in terms of testing for discrimination in outcomes. And so we were able to provide that guidance and be very practical in the tools that we provide to our regulated entities.
Yeah, I think my hot take, to the extent I ever have hot takes, is that, that the role of the state regulators, you had mentioned, administrative law, and earlier we said, administrative law is now the hot topic for law professors. It used to be the sort of the backwater. But, the role for the state regulators will be incredibly important as sort of the purview at the federal level or changes and evolves in the face of Chevron. And it's going to be very interesting to see how things evolve and the leadership that the states take. Again, it's sort of in there a little bit, but, there certainly have been more than a couple of cyber attacks as well. Cybersecurity is a big issue, both on the AI end, obviously, as we move slowly but surely towards crypto-related topics. I mean, what are you guys doing to ensure that, the regulation meets the requirements that, again, more technologically sophisticated platforms and are operating in?
Yeah, absolutely. So DFS had some of the first cybersecurity regulations for financial services way back in 2017, which seems like a lifetime ago. Just last December, we amended the regulation because it needed to be updated to take account for things like ransomware, which we weren't really talking about in 2017, but of course we've now since been talking about that for a number of years, but we needed the regulation to take account of that. We also, because of the diversity of institutions we regulate, revisited our tailoring structure in that cybersecurity reg. And then we really did a lot more work on governance and the role of executives, the role of the board, the role of the CISO to lay out best practices and requirements for our regulated entities. So I think that update was sorely needed. We went through many rounds of comment, but then we also did trainings for our regulated entities. So we felt like it wasn't enough just to issue a reg and let everybody figure it out. We did dozens of trainings. We had thousands of individuals attend the trainings just so we could talk through what those requirements meant in practice, and then again leveraged guidance to add additional meat to the bones to talk about AI and cybersecurity in particular. And that guidance doesn't add new requirements to the reg, but what it does is says, here's how you apply the framework laid out in the regulation with AI, and just provide that additional guidance and meat on the bones for our regulated entities.
Again, and it's really interesting. I mean, ultimately, you're talking about keeping, you've had the theme already, sort of how do you keep the agency up to date? The rules ultimately have to meet the speed of technology, which is inherently challenging to say the least, getting the information that you need, and then to sort of, to craft rules that are both responsive but also effective. How do you go about keeping an agency, now that you've built it up, how do you keep an agency modern?
Yeah, well, we've done a lot of work on hiring, and we have an incredibly diverse staff. So I've got folks from federal regulators, from international regulators, people from industry, people from academia. We really leverage our advisory boards. We inherited some when I came into the space, but we've added new advisory boards, made sure those were appropriately diverse in every sense of the word, and we really govern ourselves using a principle of engagement. I encourage the team all the time. We should be talking to industry, talking to academics, talking to legislators, and we spend a lot of time down here in D.C. We regulate 120 foreign and wholesale banks and 15 GSIBs, so we're often interacting with the FCA and the MAS and the EU regulators, but making sure we are constantly engaging in conversation and making sure that we're not resting on our laurels thinking that just because New York, we know everything. We are the financial capital, but we don't know everything. And so it's really important that we stay engaged and data-driven in all the work that we do.
I mean, we were going to have like Alicia Keys and Jay-Z music.
Jay-Z, I was hoping we were going
to go through that. But when you think about the big regulatory developments, obviously crypto is a big one. Your New York state of mind is certainly one that has informed a lot of the regulatory decision-making and the processes. How have you sort of approached your role? What are some of your expectations in the future when it comes to that space?
So as I noted, DFS is really the only prudential regulator of cryptocurrency in the country with crypto-specific authority. The regulation for bit licenses went into place in 2015, so we've been at this now for a long time. And as I said, we've built a team of over 60 experts to license, supervise, bring enforcements against crypto companies as necessary. And what we see now is, of course, New York has become the model. We hear, and we've been very engaged here in D.C. We're very hopeful that legislation will get through Congress soon so that we have a federal partner in the space. But for us, we really do think about how do you think about the risks that this space presents? So the same BSA AML requirements that apply to our banks apply to our regulated crypto companies. The same cybersecurity requirements that apply to our banks and insurance companies apply to our crypto companies. We have very, very strict capitalization and reserving requirements. We've done guidance on stablecoins, market manipulation, customer service requirements.
Wow.
That might have been the Jay-Z.
We have one of the most responsive AV teams in the world. We actually have a playlist. I do have a playlist.
I didn't get to walk.
We're working. Next year, 2025.
So, but it really has become the model, and you hear people in Congress talking about what they're doing in Congress is based off of New York. In Illinois and California, those frameworks are based off of what we've done in New York. The same is true for MiCA. and what they've done in the UK. So, you know, we're really at the forefront here.
So just to follow up on that, I mean, certainly you have plenty of developments around the world. You mentioned MiCA, which is the European Union's approaches towards crypto. You travel extensively around the world. You see different kinds of frameworks being envisioned in literally for stablecoins in Japan, or if you go to the UAE and what do those global developments mean for you as a regulator in New York?
I mean, it's wonderful, I think, for us to see people taking what we've done in New York and modeling their own frameworks after it. And I think one of the most gratifying things for me is when some of those regulators come to talk about an entity with us and they say, we know if it's met New York standards, it's good for our standards. So to have New York become the good housekeeping seal of approval for this, I think, is really important. And I think, you know, often people talk about states and regulating this area, and they say, well, if it's left to the states, it'll be a race to the bottom. And what we've seen is the opposite. We have the most rigorous standards anywhere in the world, and at the same time, we've seen disproportionate investment in New York regulated virtual asset companies. So you don't see sort of this race to the bottom because we have these rigorous standards, but because it is the good housekeeping seal, you see the development of these companies happening in New York, the investment coming there, and I think it's a really great proof point.
Yeah, you know, one of our constant themes, and you know, and you've sort of touched on it a little bit, but I wanted to go a little bit deeper since we have a little bit of time, is this question of delivering outcomes for everyone. I mean, financial inclusion is important. It's not an explicit mandate at the federal level of maybe FHFA, depending on how you look at fair access for maybe the OCC. But you know, how can a regulator, when you look at all the sort of the gambit of financial innovations, and there are many, like, how do you make government deliver?
Yeah.
And what's the mindset that's required?
Yeah. I think so much of it is about practicality. So one of the things we did when I came in is in New York we have what's called a basic banking requirement, meaning all of our regulated banks have to provide free or low cost savings and checking accounts. We said, well, how do we make that easier for banks to do and therefore provide more of these accounts for people? And we did that by saying, if you get Bank On certified, you have automatically satisfied your basic banking account. So we gave the banks multiple pathways to compliance. And so that allowed 23 more institutions to provide free or low-cost accounts. But then we thought, okay, what's the uptake for consumers? We really looked at the data. And then one of the things we realized was, well, even though more institutions are providing these accounts, people don't know. So then we went back to our regulated entities and we said, you have to provide, you have to train your frontline staff so that they know to offer this to people. Again, this is where the rubber meets the road. So you have to train your frontline staff so they can talk to customers about this. And then you have to display that you have this free or low-cost account on your homepage. Right? So don't tuck it in 15 clicks into the site. It's got to be on the homepage. And then we, as DFS, on our own website, provided direct links to all the institutions that had these basic banking accounts. So my team really hates it when I say this because I say it all the time. It really is about running the water through the pipes. How is this rule that we're putting in place actually going to work? How are institutions actually going to implement it? And how are consumers going to know that it's available to them and interact with their institutions appropriately? So I think we think about training, we think about those practical things. You know, we were getting ready to do some work around marketing of different insurance products in AI. And the team had come up with what sounded like a very reasonable requirement around marketing. And I said, how many marketing disclosures did you read in developing this draft? And I got a lot of stares and blinks from my team. And I was like, why don't we all go
and look at the disclosures? And
look at the marketing disclosures, and then let's write the rule, like, based on the data, based on what we see. So I think really having, and it's an advantage, I think, to be a state regulator and be just that much closer to your institutions and your consumers, that you can say, how do we make this as practical and actionable as possible?
You know, as part of our experiences here, we had a dinner with the Bank of Ghana, and one of their central bankers had a very interesting phrase that I'd never really thought of before. And he said, well, you know, as a central bank, we have to have a go-to-market attitude. And and I was like, yeah, that's pretty good. I may, cheat and steal and use it before, but like looking at sort of how both the product gets to the marketplace, but also what you're saying is like, how does the rule get to the marketplace? And to sort of shepherd that process through in order to make it effective. You know, in worlds when you think about AI, when you think about crypto, you know, worlds in which there's uncertainty, you know, so you have the marketing example where, you know, you can say, hey guys, let's go kick the tires to say, look, there are disclosures out here. Let's look to see what's worked, what hasn't worked. You know, when you get to other areas where you're literally regulating in a world where the data and the information is less so, like any tips on what that kind of go-to-market attitude should look like?
I think it goes back to the diversity of the team. I think so often in financial regulation we have this allergy to the revolving door, so to speak. But how do you know, and I myself, I've been in the private sector, I've been in the public sector, but it's that perspective that I can bring, that the team can bring to say, this is how it's going to work, or this is what's happening. And so having a team that comes from the private sector, that comes from academia, that comes from different regulators, so that we can surface all the information and insights we need, all the data we need to make the best possible decision is incredibly important. But if we had only people that had only ever been regulators, or only people that had, you know, just been academics, we wouldn't be able to surface that information in a practical and actionable way. And I don't think we'd have, frankly, the credibility that we have when we go to engage with our regulated entities or our regulated counterparts. So I think that kind of diversity of perspectives is so important in making good policy.
Well, you know, I always say, you know, no one has a monopoly on good or bad ideas. And so you have to sort of throw everyone together in order to get the sort of creative friction to get to good outcomes, whether or not it be in the marketplace or in the regulatory marketplace. Just with one quick minute to go, you kind of hinted at a couple of things that may be in store. You know, any items that we should keep our eye out on coming out of the pipe?
Well, so I mentioned that we've just proposed this health equity reg, so we're going to be working to finalize that over the coming months. I'm really excited about that because so often when people think about health equity, they think about public insurance, right? Medicare and Medicaid. They don't often think about commercial insurers, and I just thought that was such a huge missed opportunity to leverage that data and come up with policy ideas that were going to help in the health equity space. So I'm really excited about getting that finalized. As I said, more to come on AI, probably in the banking space now that we've done stuff in the insurance space. The virtual asset world continues to produce new challenges the gift that keeps on giving when we think about guidance there yet to come. So yeah, I think no shortage of new things to come from us the rest of this year and into next year.
All right. Well, with that, I want to say how proud and
it's all because of the outlines.
It's all because of the outlines. There were some really good law school outlines that came your way. I am proud. I am so happy and delighted and thankful for you stopping by, Superintendent. Let's give her a big round of applause. We're going to take a quick 20-second break, and I'll be right back. So we are going to continue our conversation with really one of the, please take a seat here, with Rohit Chopra, who is one of the country's most important financial regulators and consumer protection advocates, really someone whose both opinions, whose actions and leadership really helps to shape the national regulatory dialogue. Thank you so much, sir, for joining us. So you've been pretty busy, you know, and you've attracted a lot of attention lately with the announcement of 1033. Maybe you can walk us through a little bit this the personal financial data rights rule, what it does, and the backdrop. This is a fintech conference, but it's so critical and it touches on lots of different elements of financial technology.
Well, thanks so much for having me. One of the things that I think we should care so much.
I'm so sorry. Is this microphone working?
No.
Okay, well, you know what?
Yeah? Okay. One of the things about why we care about banking and financial services, I think it's because we want it to be part of people's dreams and people getting ahead. It's really the plumbing of the society. It's a way that people can really take risks, get ahead, and improve their life. So one of the things we've really focused on is what are we going to do to make sure that the digital future of financial services is one that actually gives consumers a little bit more power in the process. We see everywhere in the economy how rather than innovating on creating a better product or service, we see some companies figuring out how to make it tougher to cancel, how to frustrate the process of switching. And so what we have done is we have taken an old authority from 2010 that was just not implemented and really putting it into life. What we've done is essentially give consumers the right to their personal financial data to accelerate switching, to accelerate the creation of new products. We have a backward system in the United States where young people start out life essentially with a bad credit score. They are marked as somebody who cannot really be a good credit risk. But what this rule will do, among many other benefits, is to all of a sudden give them the power to permission their financial transaction data, in some cases other data, to show that they are making money and paying their bills in a seamless and secure way. But Chris, I think one of the things that's probably most important for this audience, all of you probably track innovations and open banking. The cool part about this rule is also what we have done to really advance the ball on financial privacy. And financial privacy, I think all of you who work in financial firms know, you send one of these privacy notices that almost no consumer opts out of, and many financial firms say, this is basically all the stuff we're going to do with your data, including giving it to a lot of non-affiliated parties to monetize. So what we've done is construct, when there is consumer permission data, it's not just sending them a notice saying we're going to exploit everything. There's now a whole new framework to advance data protection when it comes to financial services. So one, we are assuring that companies that are ingesting that financial data, they have to warrant that they are adhering to federal data security standards and will not engage in shoddy security like we saw in the breakdowns at Equifax a few years ago. We are not allowing continued unsecure transfers like we see with so much screen scraping. Essentially, screen scraping is where companies, you hand over your username and password. That's then essentially logged in for you to scrape all sorts of information. The rule works to end that. There is also some reasonable ability for a bank or other company, if they see a warning sign that something doesn't look right, they can block the sharing. They've got to keep a record of it. They have to be fair about it. But this will make sure that it doesn't infect other parts of the system. And I think perhaps most importantly, there's two key elements of this. The rule minimizes the amount of data that is intaked. It's only for the needs of providing that service. There are deletion requirements, ability to revoke ongoing harvesting. that really puts us in a new sphere of protecting financial privacy. And this one is near and dear to my heart. We are not allowing bait and switches. You cannot advertise that you're going to be offering someone a bank account with a high interest rate, but really just mine someone's data only to resell that, exploit it, or even transfer it to a country of concern as part of their statecraft. So we're working hard, Chris, to make sure that this is a major milestone forward, also for protecting data. And I'll tell you, I really worry about how we are advancing this, because there are some companies that don't want to compete. They want to block new entrants from challenging them. And we really have to make sure that our country doesn't fall behind when it comes to innovating for consumers.
It's fascinating. It's so ambitious. It's needed. Please excuse the question more from the securities law professor here than from CFPB expert. But we did have a conversation. When you look at just the importance of these rules. The resources necessary to achieve those outcomes. Do you feel comfortable about the ability of the CFPB to engage on?
Well, it's interesting. It's not going to be open banking is not going to be like flipping on a switch. It's going to build on a lot of private sector infrastructure that has been created. It's going to require ongoing work. We've been really lucky that the CFPB is not a bunch of lawyers with pocket protectors. We have really recruited a lot of technologists, embedded them in our examinations, our rulemaking, our enforcement, and we have really made some success there. That being said, it's going to require a lot of ongoing work, especially as we face a lot of new types of threats about how banks and fintechs sometimes want to misuse data. We know that a lot of firms are looking to use our financial data to engage in surveillance-based pricing. The staff at the CFPB is looking hard at personalized pricing. I don't want a situation where you permission your financial data to get a mortgage refinance, and they know you've been spending money at a certain healthcare facility, and they make inferences and price products and services in different ways. I don't want them knowing that you are purchasing certain types of services, knowing that you may be going to a funeral, and that airlines will then jack up the prices. So that is why we contoured a lot of our thinking on technology, personalized pricing, and data security in this rule.
Well, to continue that line of thought, how would you think consumers want their information to be used? I mean, you're speaking about surveillance capitalism and a surveillance mode that ultimately exploits people. How do you think data ought to be used, and what do you think consumers want?
Well, I think it really depends on the circumstance. In some cases, people will want to use their financial data to get a lower rate on a loan, to get higher interest on their deposits, to get paid without any junk fees early before payday. There's lots of different use cases. Many merchants, retailers, they want to give people cash back and discounts for using pay by bank rather than other options that extract lots of fees and other costs. So I think people want their data used for the purpose that they intended, and they don't want a bait and switch. And that's why we're going to continue also with some additional rulemaking under the Fair Credit Reporting Act to make sure that all these data brokers that are collecting information about us are adhering to some reasonable standards on transparency, accuracy, and more.
You mentioned privacy, which is obviously a big issue. People want their privacy. It's an important value, certainly here in the United States. what do you think are some of the sort of secondary uses of consumer data? You've sort of got into this, and privacy-related harms that rise to the top of your red light list.
Yeah. So look, I don't think this is about privacy from a tinfoil hat lens. I think I respect those with the tinfoil hats, but I think it's more than.
I don't know if I've ever heard that, the tinfoil hat.
You know what I mean.
Yeah.
But I think it's really more about how your data can be exploited to create an asymmetry of power. In other words, knowing something about you, that you are dealing with grief in your life, or that your child is struggling with something, and developing psychographic profiles and targeting to charge people more or bait them into something that they wouldn't otherwise want. When you go in to a store, I don't think you expect that the company knows everything about you. And when you're purchasing something, and it's actually one of the consumer protections I love is the price tag, where you actually know how much it is and that you know you're going to be charged for the same service as someone else. But as we've seen the digital world develop, we know that payments and others is valuable data to harvest. We see both banks and fintechs figuring out monetization schemes for it. And all we want to do is make sure there's some reasonable safeguards. I would add, though, that financial surveillance and also knowing about other aspects of your life is also about statecraft. We know Equifax, Marriott, Anthem, these are totally different. Some of it's credit reporting information. Some of it is your hotel stays. Some of it is your health insurance information. Each and every one of them were allegations that those breaches were affiliated with state actors affiliated with China. That is part of assembling information about all of us, combining it for the purpose of their goals. And I think our rule moves toward minimizing and limiting some of that data so that even if it does fall in the wrong hands, it can't be bad like we see in today's world.
You know, when I listen to you break down sort of the component parts, I still read different commentators who make the argument about innovation, security. If you share information, or if you don't share information, that could stifle or innovation that happens. I mean, how does this rule impact innovation? And as a just completely side note, again, you started your conversation on security and upgrading those security standards, but does that introduce risk from?
Well, under current law, financial firms of all sizes are required to adhere to certain data security. I mean, you know that already. What the rule provides for is that a firm can use the data not just to offer the product, but also to improve the product that they're offering. But the key thing is they can't pretend that they're offering you one thing and really just selling the data to someone else. That will reduce trust in the system and ultimately really change how consumers ultimately feel they can navigate. I really see the key way of driving lots of competition and innovation is really to lower barriers to entry and not allow big incumbents to create moats around their power they currently have. We want consumers and other companies to be able to challenge that status quo and be able to create seamless switching throughout the ecosystem, because ultimately I think that allows those with ideas and sometimes a limited amount of capital to get to market and gain share.
competition is really what you're talking about. You know, how do you introduce competition, fairness for the consumer, competition in the marketplace, and that's an interesting position, you know, to be pushing through after all these years for this particular rule. I mean, you've been certainly critical in the past of Gramm-Leach-Bliley, and again, getting back to the privacy element, those protections. Do you think other kinds of policymakers should look to your rule as inspiration for how consumer financial data is treated? I mean that not just, you know, from the fact that you guys have rules and you're actually introducing these standards, but even as I'm listening to what you're saying, again, from the securities law professor, like you're rethinking disclosures, you're rethinking the communications and the interface between products, obviously as part of your mandate, products and the consumer. What kinds of lessons do you think people should take from this?
Yeah. So, look, I think disclosures play a very powerful role when they work as a warranty, when they really state clearly key terms and the price. One of the problems is that disclosures and other click-through contracts have turned into mush. And instead of being clear about what is happening, instead we see fine print that, number one, no one reads. And two, when you read it, all it says is we'll do whatever the hell we damn please as long as it's legal. And the truth is that doesn't really meaningfully do anything.
Yeah.
In the Gramm-Leach-Bliley privacy notice, it's about 25 years old. I mean, many of us are in financial services. How often do we look through the privacy notice and opt out of anything, even when we know we would probably want to opt out of half of that stuff? So really the framework we need is just some reasonable limitations that we can enforce and that will actually improve the protection of data throughout the system. So I don't know. I think, yes, it's important to have disclosures, but we live in a world where every empirical study suggests that no one reads the fine print. And the way we need to fix that is really just some reasonable safeguards around that. And I think, with the exception of the incumbents who are clinging to the status quo, most of the industry gets that that's the direction we need to go. And there's a broad swath of members of Congress and others who know we need to enshrine some of this into law.
Yeah, I mean, it's interesting. So we've had 2 days worth of conversations on this, and you know, that question of informed consent, I think, is fascinating. Like, how do you make sure that people know what they're buying or know what they're selling? We had some conversations about 1033. I mean, I was surprised that even across the aisle, people seem to be pretty okay with this. And how do you see, sort of going forward, you know, your next steps in terms of implementing the rule and the like?
So one of the things that we got a heavy push for was they wanted the CFPB to micromanage the standards. And to me, I thought that it was important for it to have some technological neutrality and really for the government to kind of not be too involved in that. So what we're doing is the rule has a major role for industry standard setting organizations that set standards that can be royalty-free in many cases, that are available and widely used protocols to connect and ensure the system is interoperable. We've already received some applications from standard setting organizations to be recognized. If we approve those, then companies can rely on those standards to comply with the rule. The key part, though, is those standard setting organizations can't be rigged in favor of one set of parties. We know that the incumbents who control and currently have all of our data, they don't want to share it. because that's less data they can monetize for themselves. But this really makes the consumer really the owner and controller of the data. But obviously, we want those standards, and there's a lot of technological details that will need to get worked out. So that's a very key, important step. Of course, other steps include looking through and creating an open banking architecture in the U.S. that even securities and investments can plug into, that payroll providers can plug into, that even other types of firms moving money can plug into. So we're going to be looking at some specific use cases. I'm particularly interested in how open banking can accelerate more mortgage refinancing. Markets expect rates to go down, and that could open up millions of mortgages that would be in the money to refinance. And we've started to look at that. We've looked at electronic benefits cards, how they could plug in. So there's really a lot to do to make this system very robust. And at the end of the day, one sign of success is that even if consumers don't do anything, if firms know that there's a credible threat that they can vote with their feet, they will get better service and better rates without even having to act.
I'm going to ask one last question, in part because we have an international audience. This is Washington, D.C., and you mentioned the open banking, and obviously open banking, there's a lot going on in the world. Is there any element to this that either complicates your job or makes it easier when you think about what happens in the rest of the world when it comes to data sharing and open banking?
Well, we got lucky because we got to really talk a lot with the Europeans, with the British, with others who created and has some different architectures to it. There's a lot that is similar. There's some key things that are different. One thing that was a common experience in every jurisdiction is the incumbents, the incumbent banks, they want to charge lots and lots of fees. And here's the reason. They want to charge fees often to block competition. And that really comes down to that. And you see all the major jurisdictions, for the most part, have gotten a lot of push to allow a fee engine of harvesting in data sharing. But everyone talks about the goal of those fees is to just chill the whole thing. So we're on the lookout, and I think many jurisdictions are dealing with the same exact thing. I do think that we had another major difference with other jurisdictions. Many of them have more recent privacy laws that cover lots of different sectors of the economy, including banking. Here, we're dealing with some old laws, but also some new authorities. And so we had to craft what we thought was not a copy and paste of some other jurisdiction, but one that really fit the American way of thinking about some of these issues.
Rohit Chopra, Director Chopra, thank you so very much. Super interesting. I learned a lot myself, even though my mic just went up. We'll take a 5-minute break, and then we're going to jump into one last panel. But again, thank you so much. We'll be back in 5 minutes.
The program will resume in 5 minutes. Please return to your seats. The event will resume in 1 minute. Please welcome back to the stage the founder of DC Fintech Week, Chris Brummer.
All right, everybody, thank you so very much. I love this part of the social experiment. Although there are some chairs that are open here in the middle so we can get up and move to the middle. And so we can move to the middle. Yes, I'm a professor. I get to do this thing. I'm very, very tempted to ask anyone who's not there to begin to ask some questions about first-year law school. Okay. Part of what has driven this conference, and I think one reason why it's been a success and it's grown throughout the years, is that, there's a real interest in thinking through how do you drive solutions for the everyday investor, and how do you drive solutions that actually matter to real people. And this is one way in which we're innovating this year, and it's going to be super neat, where we're going to have a conversation about how to make investments and technologies work for the little guy. And, it's neat because we're going to get some people who are at the forefront of this idea and of delivering financial services to retail investors, while also having FINRA to come forward from FINRA Foundation to show us a little bit about who that investor is. What is the changing face of the investor? So I'm really looking forward to this conversation, and I am delighted to welcome our next panel to the stage.
Hi, everyone. My name is Olivia Valdez. I am a senior researcher at the FINRA Foundation, and I'm going to give you all a brief overview of who is the new investor and what do we mean when we talk about the changing face of the retail investor. So, to not bury the lead, we're seeing a lot of new investors. So, over the course from 2020 to 2022, we approximate that there have been at least 30 million new investors joining the market. In a separate study that we did, when we looked at investors overall, these are self-reported investors in stocks, bonds, or other securities, of that sample of 3,000, 21% say that they have been investing 2 years or under. So this is a big number. This is a growing number. And it's not just there's a lot of new investors, but who these investors are is also quite striking, right? So when we talk about the new investors, they are young. 2/3 of them, or almost 2/3, are between the ages of 18 and 34. They're making smaller incomes. Half of them have incomes under $50,000. And relatedly, the total portfolio value is quite small. So when we look at their whole portfolios, about 1/3 of them say that their portfolio value is under $2,000. What else is interesting and new is that a lot of the groups that have been traditionally underrepresented in the market, they're well represented within this new investor population. So for instance, when we talk about Black African American investors, almost half of them are new investors. They've been in the market less than 2 years. Same with Hispanic investors. Of all Hispanic investors, 38% say that they've been in the market less than 2 years. So again, demographically, these are quite different than our more traditional investors. And it's not just demographics that we're talking about. But when we look at the behaviors of new investors, they're investing, they're interested in products that are riskier, they may be more complex, more volatile. For instance, we're seeing 19% of new investors report having made a purchase of margin. We're seeing 27%, almost 30% say that they've traded options. And this number I find particularly striking, 54%. So over half of new investors say that they're invested in crypto. And so I find that one really interesting. So I have a chart on the side so you can really see how many new investors relative to those with more experience are investing in crypto. So it's more new investors, those with under 2 years experience, they're more than 4 times as likely to be invested in crypto. Okay, so beyond what they're invested in, they also differ in terms of where they get their information to inform those investing decisions. So here I have 2 data points laid out, 2 bars, and the blue bar, you can see that a lot of new investors are getting their information from social media, 63%. As experience goes up, those with more experience, much less likely to use social media. And that trend is almost the opposite for what we see of more traditional forms of information. So, for instance, getting information from a financial professional who personally advises you. As experience goes up, we see that number also going up. And, you know, this is just one data point that I pointed out. Yes, they're more likely to use social media, but it's not just social media. Online videos, recommendations from a particular app, friends and family, these are all information sources much more popular with newer investors. And I feel like I'm beating up a little bit on new investors, but that's not really the full story. That data that I was presenting, that's just a moment in time. Right? So when we instead look at the evolution of the new investor, we see some encouraging patterns. So for instance, here's a study we did where we looked at people when they first joined the market in 2020, and we followed up with them 2 years later in 2022 to see what that 2-year gap had done for them. Really, our number one question was, are they still in the markets? Are they still investing? Because during that time was a market downturn. We saw, crypto winter. So were they still investing? Yes. The answer was a resounding yes. 75% of new investors are still in the market, or were still in the market back then. 16% said that they weren't sure. That was a little weird, but potentially maybe they weren't actively investing and they didn't know how to answer that question. But really the selling point here is that most of these new investors, they're not just one-time investors, they're sticking with the markets. What else did we find? Investing knowledge tends to increase. So investing knowledge we have a series of objective questions that we give survey participants, 5 questions. They don't do great on average, not just new investors, but in general. We don't see great performance, but particularly among new investors, we see low performance. So on average, 1.3 of 5 questions correct. We saw that rise over that 2-year period from 1.3 on average to 1.5. May seem kind of small, but it's a 9% increase. And that increase was even higher among those who said back in 2020 that one of their goals for their investments was to actually learn to invest. So you said you wanted to learn to invest. We're actually seeing objective gains in knowledge. And then the third thing that I'll cover in that 2-year span is that even the information sources that investors use, they also change. So over time, we saw that new investors were 38% more likely to say that they use a financial professional for investing information. So in that 2-year period, they were like, okay, maybe this is a valuable place to go. We also saw a decrease in what they called other personal research. This is a survey, so that was up for interpretation, but we did see a decline in the use of that as an information source, 29% decline over that 2-year period. And then the last thing that I want to close today is with crypto, because that 54% is pretty interesting, right? 54% of new investors investing in crypto. What else do we know about crypto? There's 2 things here. Number one of the things that we're seeing is that as many people are joining the markets through the purchase of crypto as by opening a traditional investing account or a brokerage account. So I know that those two numbers here, they look a little bit different, 4.9, 4.2. Statistically speaking, these are identical to each other. People are entering equal rates through crypto purchase than through opening a traditional brokerage account. And the second thing is that crypto appears to be an on-ramp. So among those who were crypto-only investors, they were only invested in crypto, we saw that 36% said that crypto ownership made them more or much more interested in participating in the stock market. So not only is it bringing people in overall, but it's also, based on what they're telling us, also bringing them to other parts of the market. And with that, these are just, some general takeaways. A, there definitely is a new generation of investors. They're younger. They're more people of color are in the markets. They have smaller incomes. Number two, we are seeing that they're investing in riskier assets. They are using different forms of information to inform their investing decisions. And then number three, and importantly, investors, these new investors, they're here to stay. They're here to stay. They're not going anywhere. And encouragingly, they are learning more. They are, learning by doing. And yeah, that's about everything that I have to say on the new investor. Thank you so much.
I guess we'll just kick off. Well, thank you, everyone. Thank you, Olivia, for the very informative presentation. So the little guy, first when Chris reached out and said, hey, I'm going to put you on a panel that, by the way, we're just going to call it the little guy. I wasn't sure if it was payback for the 20 years of friendship that we had or whether it actually had a bit more meaning to it. But what's interesting here, and I think what we're looking forward to hearing about, is the impact of both regulation and technology to the little guy. And who is the little guy? Is it actually your retail investors and the diverse community that's been created, and using all sorts of assets and technology to come to the forefront, and they're becoming a pool of investors that we need to address? Or is it technology, institutional technology, that is now filling the gap to address the incoming class of little guys? But before we really kind of delve in, I will let each of the panelists introduce themselves, and on the little assumption that given they're the little guys, maybe a lot of you are trying to Google, who are all these folks, what is Bitso, and who's public.com. So it's a great opportunity, I think, to meet the panelists, and I'll let each one of them just say a quick word as to who they are, who they represent, and maybe to them, who is the little guy. So, Sami.
I'll start. My name is Sami Manohar. I'm the General Counsel of Public.com. I'm very excited to be here. Public is an online investing platform that serves some of the retail investors that Olivia was talking about. So on Public, anyone in this room can easily open a brokerage account and invest in sort of any number of assets, including stocks, ETFs, crypto, alts, fixed income, high-yield cash sweep, and more. And I'm looking forward to the panel.
Great. Good morning, everyone. My name is Yesha Yadav. I'm a professor of law at Vanderbilt Law School. My research is in securities markets, market structure, and my job is to be a professional cold caller. So just be careful when I get half a chance to do that.
Yesha just snuck good morning in under the wire there. But my name is Dan Zinn. I'm the General Counsel for OTC Markets Group. We provide the facility for about 140 broker-dealers to trade in what is a universe of now 12,000 plus equity securities that are not otherwise traded on the New York Stock Exchange or NASDAQ. So things like Roche and Adidas and Heineken and large internationals, all the way down to much smaller U.S.-based companies. So we sort of see the gamut of investors and new entrants that Olivia was talking about, and help to provide some of that access.
Hello, everyone. My name is Alejandro Juraidini. I'm from Bitso. First of all, I want to thank Chris for the invitation and always this amazing panel to share with you guys. And a little context about Bitso. We're the largest financial services powered by crypto in Latin America. We're a Mexican company. We operate in Brazil, Argentina, Colombia, and Mexico. So very happy to share a couple of our thoughts of what's happening also outside of the U.S.
Perfect. Thank you all. So, Dan, is it still appropriate to call OTC Markets Group the little guy, especially given what you've used and how you've used technology to address the market?
I think little guy is a relative term, right? It's always going to be relative to whether you're talking about investors, retail versus institutional. And in our case, I think it is very fair to call us the little guy in the equity trading platform space. New York Stock Exchange and NASDAQ are very much the big guys in our universe. And so we are the little guy. I think where we can compete and where the playing field levels a little bit through technology is in bringing together even a group of subscribers that are much bigger than us in many ways. Citadel, Virtu, large market makers that are the same firms that are making markets in New York Stock Exchange stocks are connected to us. Our technology platform allows them to really power the trading that happens, right? If they are faster, if they can communicate faster with one another, if they can provide better executions to that retail investor, right? That's how we'll see more flow on our markets. That's how their business grows. So it's really being a little guy and using the power of a network and networking with a group of smaller to much, much larger guys that allows this market to sort of take hold. And so I'll proudly embrace the little guy moniker for at least a little while longer.
Samia, how do you think that differs with, with you guys at public.com?
So at Public, we're serving the quote-unquote little guy, the retail investor that Olivia was speaking about earlier. She sort of described them in terms of sort of being new to the market, learning the ropes. But we're also seeing that the retail investor is very powerful. They're new, but they're also really moving the market. And that really has happened since 2019 and the shift to zero commission. So I have some numbers also, is that net daily inflows into the stock market. After 2008 through, say, 2019, retail investors accounted for between like 500 to 700 million in inflows into the market. And then in 2019, that stepped up meaningfully to 900 million. And so this is on a daily basis. Retail investors are putting 900 million into the market. And then in 2021, of course, with the pandemic and all of that, it grew to 1.5 billion. And it stepped down a bit in 2022, but really it's been consistent at 1.5 billion net daily inflows from retail investors alone, which is a huge, like 3x increase over what it was in 2019. We also see it in terms of trading activity. So before 2019, retail investors, the data's a little bit rough, but retail investors accounted for about 20% of daily trades in the stock market. And today it's around 30 to 35%. Again, we see the steady rise after 2019, which is a huge number considering sort of all the high-frequency trading firms out there like Jump or Citadel and Jane Street, that retail investors are accounting for about a third of all trades every day. That's even more acute, I think, on options. The OCC data, the Options Clearinghouse data, shows that small options contracts between 1 and 10 contracts, the number of trades, and these are sort of retail-favored options contracts, has grown 3x times 2019. So kind of sort of, which Olivia also spoke about how retail investors are embracing more risk. And, really we see all of these trends started to happen in 2019, which is when everyone went zero commission. And sort of on the technology point, it's the technology that made this happen. First, now it's sort of magical to open a brokerage account. You sort of type in your name, last 4 digits, and it opens almost automatically. This used to be paper-based. It used to take a ton of time, but right now Public can sort of check your identity and sort of run the sanctions checks in milliseconds in the background, so it's really easy to open a brokerage account. Also, it's super easy to place a trade. You sort of, in highly liquid stocks, sort of Apple, you can buy 10 shares of Apple, and it happens in milliseconds, where it used to take seconds or even minutes. And then an important innovation was around fractional shares. Public and Robinhood and SoFi and a bunch of other brokers innovated, and with the new databases, we were able to create fractional shares. On Wall Street, everything is denominated in whole shares, but now you can buy a quarter of a share, a tenth of a share, or even a smaller fraction of Apple, and that's thanks to sort of the new technologies that we were able to adopt. And so all of that came online, and it all came together in 2019 when everyone went zero commission, including the incumbent brokerages like E-Trade and Charles Schwab. And you see this huge uptick in retail participation. So the little guy is really leveraging all this technology through brokers like Public and Robinhood and SoFi and the rest of us to be a real force in the market right now.
Okay. So I guess if we take a bit of a shift then, Alejandro, given that aside from you're the only person who's not a lawyer on the panel, I think what I'm quite keen to understand from you, as someone that's on the ground, with Bitso, with the technology that you're building, and before we get into the whole regulation, which I think is, I know Yesha is kind of itching to really jump right into it. Technology, how have you used it, and how has it really impacted Bitso in addressing its market, both from the perspective of what challenges did you face, how did you address it, and how has it really helped you to expand and arguably be, the largest remittance platform that exists in Mexico right now?
Well, that's a super interesting question. I mean, first of all, I like to see it as maybe not the little guys, but maybe the new guys. Why? Because, I mean, even though we have more than 8 million clients, we have over 2,000 businesses, we're still little when we compete with these giants, global giants that come to Mexico, come to Latin America. And it's always going to be difficult to compete with that much capital, with that much manpower, with that much resources. And I think that's where technology gets involved, and that's where we can fight back. And I think that's what's made Bitso so successful. We're a remote company. We have people from more than 35 countries all over the world. I mean, we can leverage using that technology to actually make stuff work. We've tried to focus on the important things, executing quickly. We don't have bureaucracy. I mean, we have other type of pros that have been super helpful for us. And some specific stuff is we're trying to lose all this crypto casino thing everybody usually talks about. And now we're focusing on the use cases, like the important stuff we can start building with crypto. And I think that's, as you were mentioning right now, we process 10% of the remittances from the U.S. to Mexico. That's more than $6 billion a year. And I think those small use cases is what's going to make that crypto adoption continue throughout the world, right? You have specific use cases in Argentina, for example, using stablecoins. It's different from what we all live in the United States, so I mean, it's different problems in each of the countries where we operate. But being the little guys makes it easier to adapt to every situation in the countries where we operate, to have a specific relationship with the regulators where we operate, a specific... it's like we're a local company in every place we operate, right? And I think it's very difficult being a giant and operating from abroad and going and trying to teach the locals what they need. It's easier to actually listening to them. And I think that's been super helpful. And I think one of the things that also helped is one of the pillars at Bitso is financial education. We've been working on that so much. This is super new for everyone. Crypto is new for us as well. I mean, we're working on that. And actually helping authorities, regulators, everybody with financial education has been a super helpful thing throughout the years. I think that's part of the success of how Bitso is working throughout Latin America.
Okay. No, I think it's very helpful, and I completely relate to it. I mean, we're at WeAn basically building, a fintech platform in essence that's in Nigeria, but we're looking at Pan-Africa. And for us, I think, and it's been mentioned on several panels, what's interesting with the technology is the use case of the technology in emerging markets where, we try to plug in gaps where the banks are not necessarily as efficient, or where we're trying to tap into the unbanked, population and try and pull them into, the financial sector and empower them to both transact, to trade, and to do that as well, not just, at a national or domestic level, but cross-border. And when you look at continental bases such as Latin America, or Africa, that type of technology becomes, quite beneficial and helpful. But the biggest obstacle we face is regulation, both on a domestic level, but also on an international level. And the influence each has on the other. So, Yesha, I mean, what do you think is the appropriate role for regulation? Maybe let's focus first on the U.S. before we kind of, extend and go beyond the borders.
It's a great question, Tamara, and this is my moment to have a complete meltdown at DC Fintech Week, my annual meltdown. I don't even know where to begin, because where we are is just not where we are supposed to be. We have such incredible progress on the retail participation in our stock markets over the last 5 years. We've heard all the statistics. And it's not just having younger people come on board. It's not just having, more retail sort of as a volume, but we're bringing in underrepresented communities into the stock market for the very first time. And that is amazing. That is the dream. That is what we've been trying to do for so long. And our laws way back in 1933 were set up with the retail small guy in mind, because at that time, that is what we had as the dominant force in the markets, but that has changed. But unfortunately, the laws set up today just don't match what the little guy is all about. Let me ask you guys, I said I'd cold calls, I'm just going to do it. Let me ask you guys, how many of you read an S1 page to page, cover to cover, tab it and highlight it? How many of you do that, 150 pages? How many? This is DC. The dorks per square mile is high, okay? This is a room full of freaking lawyers, right? This is what our disclosure model, the entire premise of investor protection, is based on. In addition, are those documents informative? Right? We're all lawyers. We've drafted them. They're not designed necessarily to inform. They're designed to avoid lawsuits. Right? And if you do get sued, you're going to get, as an investor, maybe cents on the dollar if you're lucky. Who's going to actually get paid? It's not going to be the little guy. Right? So all of these different aspects of the law, they don't work. And we need to do a better job, leverage the technology. And what's so interesting, and I'm going to stop ranting in just a tick, is what's amazing about the folks coming into the market. We crap on Gen Z all the time. Oh, they're doing social media, they're doing all this stuff. But the Gen Zs coming in, the Gen Z, whatever, according to one study, they're the ones that actually do reading. They're the ones that trade the most every week, and they're the ones that read the most. Everyone claps for Gen Zs, right? So, but the information sources that they're getting are not keeping up with attention spans, with what they want to consume, with the kind of sources of information they want to consume. So they're going online where the gatekeeping is minimal. Can we please do better? Because without that, we're not going to be able to protect these folks, and then they're going to leave. And that is crap for all of us. So I'm going to stop there. That's not answering the question, but I get to have my meltdown.
I'll come back to you. I apologize. I seem to have touched a nerve there.
Touch the nerve. Don't go there again.
I told Yesha when we were preparing that I was going to be codependent in this rabbit hole of and I'm just here for the meltdown.
Just here for the drama.
So I see you nodding over there, Dan. From your perspective, what do you think of the regulation, at least coming from a platform like yours? Do you feel that it's helped facilitate kind of your growth, or is it still slightly behind, and there's certain points of failure that you think should be addressed?
I think it can be a little bit of both of those things, right? So there are aspects of existing regulation that I do think are helpful. So, for example, all of the disclosure that Yesha was talking about in an S1 or even a 10K or a 10Q, right? For a non-U.S. company, that is a massive endeavor, right? And so for the little guy in the U.S. who have access to all of these multinational corporations, all of these non-U.S. companies that want to trade and access U.S. investment, they can do that through our platform because regulation allows them to take their home country disclosure, make that available in English to U.S. investors, and trade using that as long as they remain current in that disclosure, as opposed to taking your IFRS, your giant audited financials, and reformatting all of that into U.S. GAAP, which is what you'd have to do on an exchange. So there are certainly aspects like that that help companies grow. There are, for U.S. companies, pathways to doing a restricted offering, doing a Reg A, doing a Reg D, and then seeing that develop into a publicly traded market. A platform like ours can support that. There's innovation, things like the grayscale trusts that are now ETFs that traded on our markets for a decade, learning how to engage with investors, figuring out what the right disclosure was, right? So all of those things exist. However, I am fully on board with the rant because there are so many aspects of regulation that need to be modernized. To the extent the rules were written in 1933, or even those that were written in 1983, right? They were done to be effective in that moment. And if you don't address things like stock promotion and certainly technology developments in a timely way, you wind up with people taking advantage of those regulations and holding back where the little guys can innovate using regulation. So I'll just ride off the coattails of Yesh's rant.
Sure. So I guess, Samia, I mean, how do you then create that fluency in the marketplace while, democratizing, the information pool for that retail, customer base that you guys are catering to?
Yeah, I just would like to plus one what both of them said. I think
you have a growing fan club here.
Good. The securities regulations that we have in place, they sort of they're really built around the retail investor that is a widow or orphan, sort of trying to protect the retail investor from all the bad guys out there, which I think was sort of, that goal has been satisfied. We've protected that person from the fraudsters. The regulations are in place, but right now, I think the new retail investor is not the widow or orphan. It's a powerful new force in the market that is really moving the market. You saw in GameStop, but that has continued to this day. And so I think the SEC and other regulators really have to sort of update their thinking and act to empower that person. And so the vibes that we're getting from the SEC and FINRA is like, no, retail investors should not be trading crypto. No, retail investors should not be trading options. And therefore, as a regulated broker-dealer, we need to put in all of these obstacles to prevent people from trading options, from trading crypto. But that just feels like the wrong mindset to me, and that instead we should be adopting sort of more of a disclosure mechanism, so to make sure that the retail investor is equipped with the right information and so can continue to sort of grow in force and benefit from this huge wealth creation engine that is the U.S. stock market.
So, Alejandro, I mean, I think one of the things that some people in the audience may also be quite surprised by is the impact that domestic regulation discussions in the United States, take and how that actually impacts you within your sector in Mexico. I mean, one of the things that we struggled with, for example, in different regions across the African continent is where the regulators, and you're trying to, create the use of technology in order to further enhance platforms, one of the biggest questions you then get is, well, we appreciate the technology is a lot of times coming out from the West, but if they're not fully adopting it, and if crypto is still being used for all these varied reasons, your typical casinos and money laundering, etc., why do you think we should actually help facilitate it if, the origin or the birthplace of a lot of the technology is still behind on the regulation? And so we do find that decisions being made here in Washington actually echo and sound out much louder in jurisdictions where the technology probably is best used, because you don't have remittances coming in here the way the inflow here is not the same as the outflow. Have you felt a similar impact, in dealing in kind of Mexico from your perspective?
I completely agree. I mean, that's an interesting question. One of the decisions we had to take, and I think it was one of the best decisions Bitso has to take many years ago, was going the completely regulated and supervised way in all the countries where we operate, like Mexico, Argentina, Colombia. We've always looked to have a fintech license, a specific financial license in all the countries where we operate, because one of the biggest things is giving the end user local ramps, right? So taking that decision of being completely regulated, I mean, it costs money, it costs time, it costs lawyers, we sacrificed a lot of stuff to do that. And at the beginning, I think it wasn't so valued by the customers. After recent stuff that happens these past years, I think they're finally starting to look back and say, wow, I'm happy they did it that way because my money's safe, right? So one of the things we usually see in Latin America is we're usually chasing the U.S. in terms of regulation. We usually follow what the U.S. does, right? So because, I'm not going to say nothing's happening because it has been slow. I think countries in Latin America are starting to do their own fintech bills, crypto bills, and stuff like that. And I think the impact of the U.S. actually getting the lead, like it normally does, I mean, it's third world countries and we usually follow what's happening, would make this market 10 times, 100 times bigger. Because giving clarity to the investors, to the users, it's a deal breaker. I mean, when Mexico passed the fintech bill in 2017, the discussion started in 2017, by 2-3 years, we had the biggest foreign investment. The VCs were all over the place. Why? Because you gave clarity to them, to their money. So I think if the U.S. would take the lead again, it would just be a complete super growth in all of the region as America, right? Both continents. And we would be super glad to do that, super happy to help. I know these next 15 days are super important here in the United States. I hope it's all for the best, and I hope we can get some good crypto news soon.
I think picking up on that, and I know we're running out of time, but so Yesha, I know that yesterday evening we had kind of a bit of an informal discussion where people talked about certain developed economies in permanent declines, whether it's because of their technology or their politics. We know that there's been a drastic shift in jurisdictions that deal with crypto assets, where there is this kind of exodus heading to the Middle East, where Dubai now wants to be, over the next century, I think it was Simon yesterday who had mentioned that, become basically the new financial hub. And they're doing that by both enhancing technology and regulation. So I'll kind of let you kind of comment on that. And is it too late for what Alejandro is saying is, for the U.S. to play catch up, or the U.S. being always kind of one of the largest and biggest, economies, they could always catch up quite quickly given the innovation and the talent pool. And after that, if each one of you guys, given there's a lot of lawyers and regulators, if just in one sentence, and I know for lawyers it's quite difficult, but just in one sentence,
it's easy for it.
What do you have people's ears here, what would you like to see done differently by the regulators, especially that we're going in, to potentially new government in the next 3 weeks? So I'll let Yesha answer the first question, and then we'll pick it up within the second.
Look, there's no doubt, Tamara, everything that we've heard today, that we are behind, right? We're badly behind in terms of where we are in setting up a regulatory framework for crypto, for stablecoins, for other kinds of crypto assets here. We're definitely playing back foot, and that's hard for us to deal with because post-financial crisis, we have been the leaders in post-financial crisis reform, undoubtedly, exporting our financial standards globally. But it's not too late. Right? This is not too late. We are here. We have the most incredible talent from the regulatory standpoint, from the industry standpoint. We have all the networks to kind of generate the capital that's needed to pour into these industries as and when we do get that clarity. And we will get there. There's no doubt. We already see hints of that now. And hopefully in 2025, we'll see that supercharged. And when that happens, I see that international dialogue recommencing. Our standards hopefully starting to at least have mutual recognition, if not at least try to create some kind of convergence to allow for that level playing field of high standards and exportability of capital and technology. We've done that so well in the past. We will get there again. We're definitely behind the curve right now, but I don't think it's going to be for long. There's so much talent here. There's so much motivation. Clearly the dynamic is in that direction. So I think it's just a matter of time.
Okay. So Alejandro, I'll bring it down from one sentence to 2 or 3 words.
Oh, I'm sorry.
What would you, go ahead.
Super important that we lived in Latin America is that the best thing is that these discussions don't grab a political party or color. The thing that helped in Latin America was we got everybody involved. It was not a political decision. It was getting everybody involved when they saw the technology, the benefits of the technology. Let's not keep it on right or wrong or this side or that side. That's the thing that helped for us in Latin America, and I think that helps us as well as over here.
Okay.
All right, I'm a lawyer and a rule follower, so I'll give you 3 words.
Fine.
Modernization and clarity.
Okay. Yesha?
I've said enough.
Samia, go ahead.
We're very optimistic about AI, so I'd love the regulators to learn the lessons about crypto and embrace AI in investing.
Perfect. All right. Well, thank you. We're way over time, but thank you very much.
It looks like everybody already knows it's lunchtime. The only thing I'm asking is that because we do have our guests from around the world streaming, that we follow the good rules of etiquette. Have fun, be as loud as you want until you get back. Okay, thank you so much. Bye.
The program will resume in 5 minutes. The event will resume shortly. Please welcome back to the stage the founder of DC Fintech Week, Chris Brummer.
You guys are a wonderful, wonderful group. Everyone has followed instructions. I feel this is like the third grade, everyone's held a hand. Everyone is, in the middle of your seats. We are really looking forward to a packed agenda, as many of you know. We're going to start off with Chairman Chris Giancarlo. Many of you know him as a former thought leader, innovator in his own right, one of the pivotal decision makers over at the CFTC. But I actually know him as one of the people you guys should say thanks to for DC Fintech Week. He was, frankly, the first person to sort of say, hey, Washington, D.C. needs a safe space to talk about financial technology because who knows, it could get politicized or something. And I said, that's a pretty good idea. So it was with a little bit of nudging and prodding that this event was born from some conversations, and the chairman was one of those pivotal people. So he's come through so many times for this conference as a colleague and friend, and it is my pleasure to welcome him to the stage.
Wow, it's so great to be back and so great to see so many friendly and familiar faces. And yeah, it's one thing to have a good idea. It's another thing to execute it and turn that idea into what is really one of the landmark events in not just the United States or Washington's conference calendar, but really in the global conference calendar for all things having to do with the future of digital markets, digital finance, and all that it stands for. So it's a tremendous pleasure to be here, and I'm delighted and I'm grateful to Chris Brummer and his staff. He's got a great team for this opportunity to be with you. And thanks to the panel members who in a few minutes will discuss the importance of disclosure and transparency in creating deep, efficient digital financial markets. But I'm going to address that by starting with a little bit of history of transparency in traditional markets, because there's a number of very important parallels. From the creation of the first U.S. stock market under Wall Street's famed butternut tree that evolved into the New York Stock Exchange, and in the 19th and 20th centuries, the development of other regional and then national stock markets, information about securities offerings was most often random, incomplete, and very often inaccurate. Whatever degree of disclosure that was provided was often puffery, leading investors frequently misled and in the dark. And in the wake of the stock market crash of 1929, lack of adequate and material disclosure was identified and targeted for redress by the Senate Banking Committee under a great Italian-American lawyer and judge, Ferdinand Pecoro. And after the Pecoro investigation, Congress passed the Securities Acts of 1933 and 34, creating the conceptual foundation of American securities disclosure and transparency. And that framework is really simple. One, securities issuers must disclose to investors all information that a reasonable investor would consider materially important in making an investment decision. That there's legal liability for both issuers and sellers of securities for failure to provide that disclosure. And there's registration of the offer and sale of securities by the issuers to assure accountability for their legal obligations as securities issuers. It's a fairly straightforward framework built on the goal of reducing informational asymmetries between issuers and investors. The framework, as applied across U.S. and trading markets with a range of appropriate variations and adjustments for unique conditions in everything from municipal securities to government bonds to corporate debt. Reduction of informational asymmetries is even accomplished in U.S. commodity derivative markets where there is no central issuer or centralized spot commodity markets. Instead, transparency or reduction of asymmetrical informational asymmetries is provided through the broad supply of market information by third-party data vendors, independent market analysts, and benchmark index providers. And the success of this approach is proven by the unparalleled depth and breadth of U.S. commodity derivative markets. And the CFTC polices this process effectively, as evidenced by the CFTC's global leadership in prosecuting manipulation of the critical LIBOR benchmark that for decades underpinned U.S. debt markets. Thus, and here's the point, reduction of informational asymmetries through various means, not just one, but various means, is a bedrock principle of U.S. market regulation. It stems from the idea that transparency begets trust, trust begets participation, participation leads to liquidity, and liquidity begets strong capital markets and economic growth. And that framework propelled the U.S. securities and derivative markets to become the world's deepest and most liquid and the center of global finance. Now, over time, other developed economies took notice and adopted this same framework. In 2007, for example, the European Union introduced the Markets and Financial Instruments Directive into its markets regulatory framework. Known as MiFID, and subsequently MiFID II, incorporate principles such as reduction of informational asymmetries pioneered by the United States. So why did I go through this little history? Because as global finance transitions from recording value on isolated commercial balance sheets to global networks of tokenized assets, we have to again explore how to reduce information asymmetries through material disclosure and transparency. But we must do so without resorting to a one-size-fits-all methodology. U.S. regulators, again, have the opportunity to contribute to this exploration by crafting disclosure and transparency frameworks that are appropriate for digital assets and blockchains rather than analog ones. This is an opportunity to apply the proven approach of reducing information asymmetry, but to use it in a new digital age. Sadly, the U.S. official sector has declined so far to seize this opportunity. Instead, our economic competitors, the European Union, is providing leadership through its Markets in Crypto Assets Regulation, or MiCA. Now, as you may know, MiCA aims to create a regulatory framework for digital assets in the European Union built on transparency and disclosure. And it requires sponsors of certain types of digital assets to prepare a white paper containing mandatory enclosures such as information about the project, information on the rights and obligations attached to the digital assets, information on the underlying technology, and no surprise, information on the risks in owning those digital assets. And, where appropriate, information about the issuer, offerer, or person seeking admission to trading. As we saw in that previous century, which I described to you, with traditional financial markets, the first regulatory mover can set the tone for the conversation and be poised to assert global influence. And when it comes to digital asset disclosure, EU regulators, not US ones, have now created the environment in which digital asset disclosure will be formulated. They are to be commended and respected for doing so. And thus, I urge U.S. market regulators to quickly get in the game. You may recall that in 2017, I led the CFTC to greenlight regulated Bitcoin futures. It was the first comprehensive regulatory regime of any major economy for digital assets. At the time, some of our overseas regulatory friends were not pleased with our actions here in Washington. Yet, 7 years later, U.S. Bitcoin futures markets are deep, they're liquid, they're transparent, and most importantly, they are effectively regulated by the CFTC against fraud and manipulation. The daily volume of CME Bitcoin futures, 7 years after their founding, is now a staggering $4 billion each day. CFTC Bitcoin futures markets are clear proof that regulators here and regulators abroad can successfully engage with digital assets for the benefit of capital markets and investors. And overseas regulators have taken notice, and they seek to emulate America's early lead. Yet, since that successful engagement with crypto 7 years ago, U.S. regulatory innovation for digital assets has stalled. Much of what we now have is a series of inapt and hidebound applications of analog age requirements and paper-based information systems. Take one example. SEC disclosure requirements that focus on centralized issuers. That worked fine in last century's analog world. But in the unfolding 21st century, centralized issuers may not even exist with certain key digital assets and digital networks. Regulators need to avoid putting form over substance. The absence of a central issuer should not be a barrier to progress. The core principle was, the core principle is, and the core principle will be a matter of reducing information asymmetries. So we must explore new ways to accomplish this in a new digital future. And we also need to update our thinking, and this is something that Chris Brummer has impressed upon me. We need to update our thinking about who is the consumer of all this transparency. Increasingly, stakeholders in crypto are not just the investors. They may be users of the crypto, they may be users of the blockchain, they may be developers on the blockchain, third-party developers, not just the developer entrepreneurs that initially sponsor the framework. More than ever, young people will need material information. It's not just for retirees anymore. Appropriate material transparency will be necessary increasingly for open source systems and technologies, as well as AI inputs and outputs. All right, well, all this new thinking about transparency requires two things. It requires commitment and it requires determination. And it needs a degree of regulatory response that is rarely generated when an innovation is being politically disparaged. Fortunately, we've got an intrepid and innovative private sector available to help. Right now, we see crypto-focused research firms employ market analysts to engage and publish digital asset research and analysis. We see centralized trading platforms maintaining digital asset-specific web pages to educate consumers and customers that include sections describing the digital asset, the team of people who worked on it, descriptions of the protocol, etc. And we see founders and development teams publishing white papers and roadmaps detailing the technical background of their products and plans for continued innovation. And we see community engagements on X and Discord and Telegram and other social networks discussing project updates, including both positive and negative updates. And I might say we have the Work Up Blueprint, founded by our very own Chris Brummer, helping digital asset promoters comply with emerging disclosure and transparency requirements worldwide. So I tip my hat to the private sector and its efforts to develop best practices around disclosure and transparency and fundamentally reducing information asymmetries in the emerging world to come. In the absence of a fit-for-purpose U.S. regulatory framework, the private sector is leading the way. But frankly, my friends, it's past time for U.S. regulators to get in the game and work together with industry and the private sector and assert traditional American leadership in financial market regulation. Let's bring together the public and private sectors to ensure that our markets, whether they're TradFi or DeFi, whether they are crypto or digital assets, blockchain, remain competitive, transparent, and importantly, influential in the world of digital asset networks to come. Thank you all for listening, and I look forward to our further conversation. Thank you.
So my task was to ask a couple of questions. I did not know he was going to. Thank you very much for that shout out. You know, when you think about transparency and innovation, you know, one thing that I've heard a lot over the years is that, you know, when you have the rapid pace of technology, you know, it's a necessity. It's essential that you also innovate in terms of how companies communicate, either with one another or with regulators. You're also introducing this concept of competition, right? Which I find interesting. And you know, I adore
the New Deal laws, right? I mean, in terms of the history of it, it's just truly fascinating because you can sometimes see history repeating itself from time to time. When you think of PCORA, the PCORA Commission, what does that competition look like for you again, and how does it play itself out in something as weird as transparency?
Yeah, you know, look, regions and countries and economies have competed since the dawn of time, and they will continue to do that. Competition, I think, is innate to the human character and the human nature. There's a professor, Bradford at Columbia, who's written a book called The Brussels Effect. And she describes how the European Union has used rulemaking as a way to compete in the world for business. So if you're an outside firm doing business in Europe, you've got to comply with their rules. And if the other jurisdictions don't have rules in place, you'll just adopt those European rules worldwide. What she also talks about is sometimes those rules don't apply to smaller European players who are given a chance to grow to compete with their American companies that come in. So clearly rulemaking can be a competitive engine. And quite frankly, we do the same here, not just externally, but internally. California adopts emission standards that the rest of the country must adopt, even if their states aren't necessarily on board with the thinking behind it. So regulation has been used for competition for a long time. I think the key for us as we develop digital networks is to keep that within bounds, within reason. We are not all the same economies, right? The United States, the depth and breadth of American securities and commodity markets is unparalleled anywhere. With great respect to the European Union, it's a big economy, but its capital markets are a fraction of the size of the U.S., and the rest of the world is different. And we also bring different issues to bear. You know, regulation encapsulates certain visions of society. What's important to be disclosed? What is material here may not be material there. So we've got to thread this balance that we always do as regulators of finding what is a minimum global standards, but then leaving room for each country to develop their laws that reflect their societal demands and not necessarily take other societal demands at face value.
Well, you know, I really appreciate these comments, and you know, and I look forward to our next panel, because even when you think about, you're talking about materiality, like what does it mean to be material if something is already accessible on a public blockchain? But you have to be sophisticated enough to understand it. But what then does sophistication mean, right? These are kinds of issues that it seems like every generation has to sort of revisit.
And you know what? My biggest urging here, Chris, is we got to just get in the game. I mean, all these issues are to be addressed, but if we're not even at the table, and right now the United States is not at the global leadership table of developing these standards, which means that we'll eventually have to adopt the standards of others, which may be great, but they may be missing some things that we would expect in the United States. So we should be there. We should influence them. They should influence us. There should be that kind of give and take. But if we're not in the game,
then you're not in the game.
If we're not a rule maker, we're going to be a rule taker.
Chairman, as always, such a pleasure. Thank you so much. We're going to have our next panel. Come on board.
Thank you.
We should be dancing onto the stage with that music.
So I guess it's our turn. We're going to totally break from the script and not talk about operationalizing. No, I'm just kidding. We couldn't have gotten a better introduction in terms of what this panel is going to dig deep on than Chair Giancarlo's comments just now. Before we turn to the panel's sort of hot takes on that, and then we quickly segue into exactly what brings us all together, I just wanted to thank you all for coming back after lunch. It was very kind of you. We really do appreciate it. No, we're thrilled to have you here. I'm Sarah Weed. I'm co-chair of the Global FinTech and Digital Assets practice at Gibson Dunn. And today, my sort of claim to fame is that I get to sit here and have sort of the best seat in the House as we hear from really authorities on the topic of operationalizing transparency and emerging technologies. If you're wondering what that is, it's what we're all doing here right now. But I'm going to kick it over first to Paul. What do you think? You know, how do we think about that markets lens? How do we think about what it means as we drill down on sort of operationalizing for technologies themselves.
Well, thank you, Sarah, and thank you all for having us. I can't help but reflect on Chair Giancarlo's remarks and appreciate, number one, that of course it would be a chair named Giancarlo who give full credit to the great Italian-American Judge Pecora for inspiring the federal securities laws. So kudos to Chris for that historical recognition. I also have to just observe that history does matter, and I think Chair Giancarlo is right to point us backwards as we think about what lies ahead in terms of understanding the fundamental purpose of the disclosure regime that we've all lived with under the federal securities laws for decades and decades. And I am particularly struck, Sarah, by the call for a fit-for-purpose regime that acknowledges, indeed embraces, that when the current federal securities regime was adopted through the 33 and 34 Acts in particular, there was a focus on, indeed an insistence that they be fit for purpose and that they not exclude important actors and important elements of the securities regime as it existed at that time, and thinking about where liability ought to lie, how disclosure ought to be assured, and how markets ought to be protected. I think many of us in the digital assets or cryptocurrency industry would ask for nothing more but nothing less than that as we think about what a fit-for-purpose regime for digital assets could look like in the decades that lie ahead.
Perfect. And so I expect that our thoughts about that history is going to really show up as we break down this topic for you. Olivia, but let's start at the beginning. Why does transparency really matter?
Yeah, I think also that was the perfect entry because it matters to have trust and accountability, especially as you're adopting new technologies. So as we look at transparency, it's understanding very clearly where's the sources of your data, what are the model versions that you're using, how do you understand really the model design? That's important. So you understand risk, but you also understand where there might be opportunities where things are changing. And that's also where explainability, and this is what we're seeing particularly as you look at the scale of these large language models, it is the biggest challenge that we're working to tackle right now, is making sure that you have clear explainability and understanding the model outcomes and recommendations and why. What is the reasoning? Because in the adoption of these new technologies, it's not in place of the human, but the human needs to understand why the model is making those recommendations to then understand whether or not you can trust, whether or not you can act on that. It's really been a key pillar as we're looking at in Amazon and how to support this space as it continues to grow and really understanding model fit for purpose and the fact that you're going to have small language models, large language models. But as you're adopting that in an enterprise, you need to have that framework around governance, control, transparency, and you really need to make sure that you have the ability to be able to drill down to understand the why. I would also just refer to Chair Giancarlo's comments about understanding data anomalies. That is really critical, and that's also an area where we see is one of the driving use cases in just understanding where is that needle in the haystack, and let's focus there as opposed to churning and understanding and comparing to be able to identify those anomalies. Have those identified for you so you can focus there.
Perfect. Yeah, so there's a lot there, right? Embedded sort of in that thesis, though, that it matters on sort of all these axes, on all these levels, is sort of that question of who does it matter for? And we heard earlier today that transparency and clarity can change sort of the appetite of investment. We heard about sort of the influx of money and energy into Mexico with the benefit of more transparency and more clarity. We also heard how sort of on the consumer experience side, how the relationship of users really changes their relationship to products and services, and their participation in markets can really, really change as we think about their access to disclosures that work for them and that level of transparency. Lee, who do you think benefits most? It's sort of an impossible question, but you're up to the task.
So first, I thought Chris's remarks were spot on. The only thing I would add to what Chris said and to what Paul and Olivia said is we are really living in a global world right now, and the idea that the particulars of U.S. regulation or the particulars of European regulation are going to create sort of some global standards is probably basically right. And that means that we need to elbow our way to the table, as Chris put it, as opposed to sit around and wait for regulators to be the quote-unquote first movers. I would make a distinction, actually, between disclosures and transparency. I think they are related concepts, but they are different. Disclosures, I sort of think of that as what is regulatorily required, versus transparency, which I think of as a much broader thing. And the other thing I'll say, and then I will actually answer your question, Sarah, is we talk about this as if it's always about investing in digital assets, and we forget that we are actually using digital assets. We're not just investing in digital assets. So, for example, on the Avalanche protocol, which my company works on, you can be a validator. You can operate a validator node and secure the network. You are using the AVAX token for that purpose. The same thing is true on Ethereum with Ether and many other proof-of-stake protocols. Switch over to digital collectibles. You use digital collectibles in lots of different ways. People associate them with their Twitter handle, et cetera, et cetera. So when it comes to the question of who, the answer is everybody. And the only other thing I'll say is everybody's different, right? Like, Olivia sounds like she can do really good technical analysis on the technology that I am completely incapable of doing. Kudos to you, Olivia. I'm just a dumb lawyer. So really, we need to think about disclosures and transparencies as sort of these tiered things, because different people will want to use the disclosures and transparencies for different purposes. And if we don't appropriately accommodate that with our transparency, that's when we'll have some negative impacts.
It's a great level set, right? So transparency is sort of, it could be so many different things, right? Which is one of the challenges I think we had in breaking that down in 30 minutes. I think some of us instinctively go to the place of explainability or disclosures. We go to that transaction level relationship, in terms of, is the provider of the service being sufficiently transparent about the nature of the offering, about the nature of the risk, about the nature of the opportunity? Is that actually happening? And then on the other hand, we think about transparency through the prism of enterprises, right? Are enterprises themselves being clear in terms of how they are digesting data, using data, relating to others relative to data, and in commerce and otherwise, right? And then there's sort of this extra axis, because we don't want to leave out regulators, very important. Former regulator, it makes it funnier when I say that. That's where we have this opportunity to think about transparency relative to regulators, not just the expectations of regulators, we'll talk about that some, but also in terms of regulators in their communication and engagement, both with the cohort that is, the regulated community as well as consumers of these products. But Paul, how do regulations change how we think about transparency, whether on that micro level or on that macro level?
Well, I think regulations matter a great deal. It's one of the reasons why I've been begging for rules and regulation for digital assets for, well, now years. I think that you raise a very important point, Sarah, that consumers, for example, have one set of needs and one set of expectations that drive a certain outcome when it comes to disclosures, transparency, how we want to label it, that are critically important. But we shouldn't forget the regulators themselves. I do think that the ability and really the responsibility of regulators to understand what's happening in the markets that they oversee is critically important. And particularly in new markets involving digital assets and technologies akin to digital assets, you have an opportunity that is unparalleled for true real-time oversight and understanding that I think will lead to better outcomes, more efficient markets, but also just a greater sense of fairness. And dare I even use the word empathy as to what's happening in markets in real time that will just, I think, look very different from the world that we operate in today and have historically, where by design, indeed perhaps by necessity, it's been entirely backwards looking.
So Paul, I want to push on that thread a little bit.
Push away.
How do we how much is this transparency or the opacity, the flip side, that we might be encountering or perceive or encountering relative to engagement between industry and regulators a function of a trust problem? Is it an information problem? Is it a trust problem? Is it both?
Yes. Yes to all of that. I mean, there's no question there is, I think, an information asymmetry, to borrow a phrase from Chair Giancarlo's remarks. But I do think fundamentally we are at a low point when it comes to trust. I don't think I'm breaking any news here in saying that the last 3.5 years have been marked by nothing, if not a complete absence or lack of trust. And to be fair, going in both directions. I think when you have labels cast about that an entire industry of developers, builders, many of whom, by the way, are Americans, let's not forget this when we're talking about American regulators, cast entirely as a Wild West, for example. It's kind of hard to have trust. It's kind of hard to have trust when that entire community is told on the one hand that we have no regulatory authorities applicable to this space, and therefore legislation is required, only to face an unrelenting campaign of litigation over legislation or any regulation whatsoever that has blanketed the space and continues unabated up until the present day. So is there a trust gap? Yeah, for sure. And to be fair, I did say, and I fully acknowledge, the trust gap applies in both directions. The fact of the matter is the industry has not equated itself in the best possible way over the course of those same 3.5 years when it comes to policing its own actions and taking serious steps in many cases to address rampant fraud and abuse. But it's time we move past that. We can all wallow in this lack of trust for another 3.5 years, or we can get about the business of writing sensible rules that hold the right people accountable and give the regulators the tools they need to do their job. I think it's still possible for us to do that. It's not too late, but it's time that we get going on that.
Yeah, I build on that point, if I may. So good afternoon, everyone. My name is Brian, and I lead a research center in Cambridge called the Cambridge Center for Alternative Finance. Over the last decade, we have had the privilege of collaborating with 5,000 fintechs around the world, but also 250 central banks, security regulators, capital markets authorities, Ministry of Finance around the world too. I think the key takeaway from me, from Chair remarks earlier, is innovators need to compete on financial innovation. Regulators need to compete on policy, regulatory, supervisory, and infrastructure innovation. It has to come from both sides. When we talk about regulation, we need to talk about regulatory innovation, which in essence means regulators themselves need to innovate in order to regulate. Right? They need to create that safe zone and safe space. When fintechs approach regulators, they don't have to bring a legal counsel. Yep. Right? Look examples of the FCA. They devised regulatory sandbox 10 years ago. They developed a permanent digital sandbox last year. They launched a digital securities sandbox together with the Bank of England to look into tokenization this year. They just unveiled the AI lab, which will launch in Q1 next year, right? So that sort of innovation mentality, the shift in mindset, changing culture is vitally important. And just a quick point, we also need to talk about supervisory innovation, or SupTech, right? Regulators need to employ the same technology they try to regulate. So look at all the examples, we see great increasing adoption of the SupTech solutions around supervisory authorities, central banks around the world. For example, the AI-powered chatbot developed by our colleagues for Central Bank of Philippines. That was 7 years ago, now being replicated, diffused around the world in 30 agencies. So when we talk about innovation, we need to talk about innovation in the marketplace, but perhaps more importantly, innovation in the public sector.
So what I love,
Sarah, I apologize. I just want to interject briefly. It's not all financial instruments, okay? I know this is DC Fintech Week, and so I probably just said something that wasn't kosher. But it's not all financial instruments. The financial regulators are certainly important, but they are not the only important regulators. And the idea that digital collectibles are financial instruments is nonsense. The idea that because I tokenize tickets to the Taylor Swift concert, or Beyonce, whatever your preference is, right, not financial instruments, okay? We have to get out of this mindset that it's all financial instruments, and we have to get out of this mindset that the only regulators who matter are the financial services regulators. They matter, but many other regulators matter because this technology is being used in lots of different ways for lots of different purposes, and we just need to be cognizant of that fact at every turn here. Otherwise, we end up with a situation, as Paul alluded to, with the current administration at the SEC, where they treat everything like it's financial instruments, and it's just not.
So, Lee, I thought we were going to get somewhere in terms of like leaving with action items, but I actually love your point in the sense that it makes clear that it's not about contending with one agency, two agencies, three agencies, 4, 5, 6, add the state system for fun. The point, right, is that there are stakeholders everywhere you look, and each set of stakeholders has a different perspective, right, on maybe what the risks, what the opportunities are. And so some might say that the industry has to think about sort of blocking and tackling their way through. Another way to think about it is we need to create a bigger table. Because if we are going to find sort of solutions that may call for a different kind of conversation, maybe a bigger conversation or a more, a conversation that contemplates, breadth and depth that we haven't really thought about, right? Because sometimes it's easy to get sort of in our bubble and think financial services regulators sort of are all that we have to contend with. But how do we think about creating sort of leveraging opportunities to create transparency? I know we didn't talk necessarily because Lee just took us in a beautiful direction that we're just going to go with.
Sorry.
The question, though, becomes like, how do we think about that opportunity, whether it's figuring out how to capitalize on opportunities to, whether it's create, connection, develop trust, leverage explainability. Like, what do we do? Olivia, I know you've been sort of having lots of conversations of many kinds. Like, what's the lesson there?
Yeah, well, there's certainly, I think the first lesson is the collaboration is important, as well as Brian had shared, just the experimentation and understanding around that. Because while I think that there's broad understanding conceptually, there's not a lot yet that goes beyond some of that experimentation that really moves you to implementation. So kind of bringing us back to how do we operationalize all of this too, is you have to start with something that you're trying to solve for. You have to, by doing that, understand then what are the risks? How do I manage control of access to data? But I think everything really does start with the data as well, and really understanding where there are opportunities to even share that data across regulators, and even bring the private sector into that conversation as well, so that there's a clear understanding of who owns that data, how are we using it, and starting to flesh out some of those issues too. That's one that I think will really advance some of that innovation further, but also drive more of that just organic collaboration in the industry.
And by the way, we could all agree that we want the same level of transparency and disclosure regardless of the nature of the asset. That's not the way the world works now, but we could all agree that that's what we want. And if that's what we want, we should all agree and proceed on that basis. But we have to recognize that that is not the way the world works right now.
So I think there's certainly a lot of things, a lot of directions we can go in now. But my sort of, in thinking about that operationalization piece, is there, where do we create those spaces for experimentation? Is it the sandbox? Is it the demo? Is it the, having the ability to sort of let regulators play with the tech, play with the products, doing that in a really sort of hyper-explanatory way? That's a different kind of transparency. Have you all had any success, or are you thinking about things like in that vein?
I can get us started. We certainly are working with financial regulators, and others to really create those sandbox spaces, but also investing in really the education. And education, not just at the practitioner level, but that education needs to be thought of in terms of compliance, in terms of the examination teams. It's bringing everyone along for the ride so that they have that. And then it's really the prioritization around what use cases are going to have the biggest impact. You know, not everything is created equal. And the use cases that we see coming about, usually it's internally focused first, where people are experimenting. You know, but then it can really expand as you even simulate some of the events that have taken place, like in the U.S., some of the regional bank failures, some of the other events, really just looking at kind of even from a red teaming perspective of how could we have identified and prevented this as opposed to forever being in a reactive mode.
So it sounds like sort of, number one, we're creating sort of shared language around how to talk and think about these things. Number two, we are thinking about opportunities to sort of disarm and close that distance between practitioners on the one hand and regulators on the other, and then forget not consumers, right? How we create sort of a shared set, through those shared objectives. And then four, a win. Like, just sometimes it's just finding the win. And I think we've had a lot of conversations these last few days about opportunities for, you know, for maybe, I'm not going to say an easy win. That's crazy. We don't do easy in this sector. But where do we think there's room for compromise, room for a win? Any thoughts? Leave us on a high note. Come on.
Yeah, just a quick point. The first thing, starting point is we have to be honest. We don't know everything about fintech, right? So we talk about Gen AI a lot in these conferences. We should be talking about agentic AI, right? So now there's a creation of an army of AI agents who can, you know, perceive and learn, act, and reason, right? So if something goes wrong, then who will be accountable, right? That's a question. We don't have answer for that. It requires us to have a collective problem-solving mindset to create that collaborative space, right, where people can experiment and test, collecting empirical data without fear. The education piece is so important. Our center have trained 2,700 senior central bankers, supervisors, policymakers just in the last 4 years. Right? Half of them women, 85% from emerging markets. And there's many creative solutions, sandbox, tech sprint, digital sandbox we can learn from.
Any other rooms for wins? Lee, you got to give me something.
So I think to me, a couple points. One, all kinds of experimentation is happening in real time on chain. The amount of new things that are being built on chain is phenomenal. Mm-hmm. And the nice thing about it is it's already transparent. So if regulators are interested in those things, they can actually go and read the code. They can actually go and watch the transactions happen. They can actually go and have a wallet and use, block explorers and all of this other stuff to see what's going on. So because there is this built-in transparency and this built-in constantly evolving marketplace, I think things are here at everybody's fingertips right now. Chris made a point, Chair Giancarlo, sorry about that. Chair Giancarlo made the point that there are these companies that are evaluating valuation and utilization of tokens, right? Where do they get all that data? It's all on chain. And so we have this massive amount of data that we can use, and everybody should dive into that pool and get wet.
I know one place you're not going to find it, Sarah. It's not going to be in a courtroom. In lawsuits, they're looking back at what happened 3, 4, 5, or 10 years ago. That's the one place I know for sure we're not going to find the early success you're pointing us towards.
So we know where not to look. We know some places we might want to look. Yep. I think we all have some homework to do in terms of thinking about ways we can be forces for good in terms of driving forward that more transparent, more open dialogue. But I hope that we all are leaving a little heartened. There is so much to do. There is so many wins. There are so many wins ahead for us. The more we push collectively, the more we make that happen. So appreciate you all and appreciate our panel. Thank you.
Thank you all.
Okay, we are back for our next session on defining risk and opportunity. You know, it's a question that we've had an enormous amount of interest in. What risk means, what opportunity means, particularly when it comes to delivering financial services for people who need them. And it's a conversation that almost every regulator that we'll have later. We'll have a conversation, obviously, with the Stripe's co-founder and the CEO of the FCA, and others we'll be digging into as well. But I want to start with our two guests, Uli Demisi, former CEO from eToro, and Siki Ballard, who is the CEO of the Beta Financial Services. A couple of simple questions that really go to the heart of many of our conversations, especially the last one on transparency. But first, Uli, see you on TV all the time. Yeah, I see you on CNBC, and see you on Bloomberg doing your thing. But what do you think regulators and policymakers have gotten right and wrong when it comes to this risk and opportunity dynamic in terms of identifying either or both?
Yeah, I think part of it is sort of like looking at which regulators, right? America is a patchwork quilt of regulators, not just federal. I'd say if I looked at the New York regulation, the authorship of the New York regulation when it comes to digital assets, I think that they got the infrastructure of that right, meaning that they are looking at the instrument for what it is and not what it's not. So there's not a debate of whether it's a tit for tat, right? So they look at cyber, they look at custody, so they're looking at the things that are native to digital assets, which I think is great. They got that right. I often would say I wish that New York sort of regulation was actually the federal standard. Where I think they got it wrong is often in the application of things, right? So once it gets, I make the analogy, the Bible is a really interesting book, whether you're religious or not, but in the Dark Ages, the administration and the dissemination of it was terrible. So I think it's not just about designing regulation, it's also how you administer it and the mental framework you have in administering it, and are you doing it in a way that chokes out the sort of the people that are trying to create new business? Or are you doing it in a way to actually catch the bad actors, right? Or to catch the systemic risks? Where I think we got it wrong for the last 3 years, and now that I am a woman of leisure, I can actually say that is, I think we, in many federal spaces, we weaponized regulation. And that weaponization chilled the formation of capital everywhere, whether it's IPOs or raising money, and that's dangerous. And as we see right now, it's dangerous for democracy when you do that. So I think that's where we got it wrong.
Siki, I'll give you the same question. I mean, and maybe you can also tell us a very quick little bit about your journey and how it's informed your views on risk and opportunity.
Sure. Well, my name is Siki Ballard, and in 2020, I attempted to organize a bank, so to acquire a charter and FDIC insurance. Ultimately, that was not a successful effort. To your question, I believe that the regulators are missing the forest for the trees. Since 1840, the United States has experienced 12 systemic banking crises. By comparison, Canada has experienced 0. In Canada, the sole responsibility for chartering banks rests with the central government, the federal government. And every 5 years or so, every bank is up to have their charters renewed, so they have to defend it. In the United States, it's sort of a patchwork of state, federal banks who have grown through acquisition within states and across state lines. But what it has led to is a system that is fundamentally riskier than what we see with our northern neighbors. And I'm so interested in this question because, the incumbents in America are not up for rechartering every so few years. You've got Wells Fargo as an example that's creating accounts that no one ever asked for, charging fees for services that no one ever used, settling with the Justice Department for discriminatory lending practices, and they keep their charter. TD Bank recently was found criminally liable for laundering hundreds and hundreds of millions of dollars. And I think Chinese gangster money. The line employees knew about it all the way up to the senior executives. They knew about it, and they keep their charter. They get a $3 billion fine, which is a slap on the wrist when you made $12 billion in profit last year. Canadian dollars, though. I have this impression that our regulators have not been particularly effective on the risk management side, as is indicated by bank failures and bad actors being allowed to continue operating mostly uninterrupted. And at the same time, one of the chief functions of the financial system is the efficient allocation of capital. And I know from my line of work that that is completely broken. All things being equal, there are certain groups in this country that simply do not have fair access to capital. Same income statement, same balance sheet, same cash flow if you're a woman-owned business, a minority-owned business, an immigrant-owned business, or maybe you operate a business in a rural area that doesn't have great banking coverage, you're going to have a harder time accessing credit. Ultimately, all of this is related to national security. The degree to which our regulators and our politicians figure out the equation of how do we allocate capital as efficiently to the broadest swath of our society, I think that's directly connected to national prosperity. I think it's directly connected to national security.
Yeah, you can sort of get where I'm going from and why this is such an interesting conversation, to have your experience from banking and to get Lule's experience from capital markets, and to get a little bit of a sense as to what the policymakers are doing right and wrong, again, in defining what risk is and how risk is both supervised and what the proper regulatory responses should be. I mean, Lule, when you hear this coming from the banking world, from your former perch over at eToro, does it sound familiar to you or not?
It does. I worked before eToro. I was at Ally Invest, which is part of a chartered bank, and so I know what it's like to work for a bank as an investment shop, and I ran the other way. But ultimately, I think, I actually have a different take on this risk, which is that I think all due respect to our northern neighbors, they're the wrong benchmark. They take on much less risk than America does in general as an economy, as a mental framework. America is a higher risk, higher octane country. And so you can't look at it just in terms of absolute numbers. You have to look at it through the context of the economic infrastructure and the outlook of that country. And so I actually think, although I think it's really important to make sure you have mechanisms to catch systemic risk and other things, for the most part, regulation from a banking process has been outsourced to the banks, in which the compliance departments are like 30 to 40% of the staff. And I actually think that's an antithetical sort of thing, that we don't measure opportunity cost because of that. And the opportunity cost is that the more burdensome regulatory to-dos become, because it's not necessarily correlated with output, right? The less likely the smaller business is going to succeed. The less likely inclusion is going to happen. So I have a different take on this, which is that I actually think we have to look at risk through the lens of what's first, the systemic design of the economy. Our economy, by definition, is a higher risk octane capital markets economy. And so we cannot measure it with Europe versus Canada for that reason.
Well, I wonder, is that the way the system should work versus how and whether or not it's the way the system is working? So we had a conversation yesterday with Vice Chair Travis Hill from the FDIC, and one of the conversations and one of the issues that we brought up was the formation or the absence thereof of new banks in the United States, right? And one of the things that he kind of brought up was, well, that's, to your point, that doesn't sound like there's a lot of risk-taking necessarily going on when it comes to, the formation of new banks. But it does get to your point as to, how do we quantify opportunity costs, or measure systemic risk and preventing systemic risk versus preventing systemic success, right? And how do you figure that out? Siggy, again, just getting back to some of your experiences and your thinking about the system, what is it that you think, and I'll just center in on banking for the moment, but I think in capital markets it's an equally important question. How do you drive that balance? Most of our regulatory agencies do not have a financial inclusion mandate. If you go down to the FDIC, there's no financial inclusion mandate. There's no financial inclusion mandate over at the SEC. So there's no programmatic, systematic sort of inbuilt history of trying to make that kind of comparison. So, from an entrepreneur's standpoint, but also a student of regulatory policy, like where are you seeing the gaps and the pitfalls?
You mentioned earlier that we're seeing very low activity in de novo banks, new banks being chartered, and I view it as the regulators essentially protecting the incumbents, maybe unwittingly. So when I abstract away from that point, I really do believe that the degree to which nations build robust financial systems, banking systems, that expand access to credit and access to financial services to the broadest possible segment of the population, I believe that is directly connected to the prosperity of the nation. How else does the government fund its adventures abroad and its domestic projects at home? It needs that access. And so when we talk about not having a mandate of financial inclusion, I'm connecting those two things. So if the regulators are giving new entrants a hard time, and these are new entrants who are very interested in filling gaps that currently exist in the market, then that to me seems like they're actually they're impeding the robustness of the financial system. If you protect the incumbents from competition, they will continue to charge high fees for things you never asked for. They will continue to engage in criminal behavior. I believe allowing new entrants, chartering new entrants, creates pressure on those incumbents to do better. It creates pressure on those incumbents to fill gaps that existed before that. So in my perspective, I believe that the regulators maybe don't have a full appreciation of the role of banking in a country's trajectory. I don't believe that they have a full appreciation of the role of new entrants in continuing to create a increasingly robust and even sounder financial system than what we currently have today, which is a system that has historically failed 12 times in the last 150 or so years.
Well, I mean, I think you can certainly hear certain themes, I think, that certainly in capital markets. I mean, what are your thoughts and your responses when you think about those pressure points and this idea of maybe in capital markets you may not have the chartering issue per se, although I'm sure some of our friends in the crypto industry would point to lots of similarities. But even when you think about the introduction of new kinds of financial technologies more generally, I mean, we're in eToro and the kinds of investment apps, or when it comes to other kinds of means of sort of touching a broader swath of American life that are new, that can entail risk, but then at the same time can also introduce new kinds of economic opportunity and wealth building. I mean, how do you see the pressure points? Where do you think the regulators are having their problem in terms of, and why do you think regulators are having the problem in terms of making that balance?
Yeah, and I think there are individual regulators that are doing their part and trying to do their part. I do think the fish, as they say, from the head, right? And so I think part of it is I fundamentally believe that inclusion is not possible without economic expansion. It is not possible. Because if you don't have economic expansion, the pie doesn't get big enough for other people to partake in it. So I also, as a business person, measure results, right? We have less banks than we used to. There's been consolidation of power among the larger banks right now since the last 4 years, right? We have less access to capital than we used to. IPOs have been some of the lowest that we've seen since the Great Depression by some count in certain quarters that we've seen. I look at whether inclusion is plausible by how many avenues of capital expansion and capital formation is available for new ideas and new people trying to expand. And by all of those measures, we have failed. And as I said, when that fails, democracies are in danger. So I personally believe that there's an existential crisis that we all have to feel through, which is how do we imagine a future in which regulation is catching the bad guys, for sure, but is not choking growth, is not choking the expansion of capital formation. Because without capital formation, there is no inclusion.
Yeah, I look at sort of I guess, two key areas that you seem to be sort of touching on. Number one is how can we make sure that there's capital formation for the creation of new businesses, small businesses, on the one hand. And then there is this question about how can you make sure, one way or another, and this is, I guess, taking cue from the last panel, how can you make sure that everybody is participating in the financial economy? You know, I've always kind of viewed owning a home as sort of the first step to building wealth, and then I think, you know, you start to climb that ladder after you own a home. How are you participating in the economy? And that's either there's some kind of investments, retirement, otherwise, or starting a business.
Absolutely. So when I say capital formation, I don't mean just in terms of people raising money for their businesses. I mean the ability to own capital, right? So the income gap in America, 60% of it is because of asset gap. Yeah. It's not income gap, right? So it's a misnomer to call it that. It's an asset gap. If you actually equalize people for education, black people are still, by the Fed's numbers, anywhere between 70 to 80% behind. So ultimately, I agree with you that capital is about partaking in ownership as well. I fundamentally believe that ownership changes people's psychology. 60+% of households own in America versus like high teens in Europe, right? I serve as an advisor on the advisory board of a company called INX, which is tokenizing assets. So they're tokenizing securities that are very attractive for people in the U.S. to be able to access in other parts of the world. People want to take in ownership. And ownership creates wealth. Wealth creates equity. It is the definition of it. And so I think we have to figure out, like, what happened to the capital formation mandate of some of our regulators. The mandate was just a cudgel for the last few years. And I think that that's an existential question we should ask ourselves. What happened to the capital formation mandate? And I think we have to look ourselves in the mirror and say, that might be where democracy is in danger.
Interesting. The capital formation mandate, many of our agencies also have a competition mandate as well. The ownership question, it's an interesting one because it's not explicit all the time. So it's not explicit all the time when, in terms of, you know, we are in a political season. No one's necessarily making a play for enabling people to own things.
Can I just add to that? Because I want to make it very explicit. My first home, I'm an Ethiopian immigrant. I grew up in a repressed society, so that's why I love American democracy, right? I came here, my first home. There was no way I would have been able to own my first apartment without the innovation of HELOCs. There's no way. And I understood what a HELOC was. I understood how to do it, and I educated myself. I availed of myself of that. And suddenly, I am a woman who came with nothing in her pocket. My first stock that I bought in college, because a brokerage company could let me open an account. My first crypto asset that I bought because a crypto wallet was able to be available to me. How dare anybody tell me that I cannot get access to that because I'm not born with a trust fund? And so I do believe that's an important thing to remember.
I would say we do have at least one of the candidates for president talking about ownership. So, you know, Harris is talking about home ownership and talking about access to capital for small businesses. I think that this is such an important thread, particularly on the small business side. There are two ways to really generate a lot of wealth in America. It's home ownership and it's enterprise. If you have unequal access to capital to be able to start climbing your way up the real estate ladder, or if you have unequal access to capital to be able to invest in a new factory for your business, it obviously is harder to start accruing wealth over time. When I focus just on the commercial side of things, of small businesses, we have a situation, as I mentioned earlier, all things being equal, certain subgroups have a harder time getting capital. And I think ultimately this is about information asymmetry. So if we can create the level of information and comfort with that level of information about the counterparty that a bank is doing business with, I think that is a really critical component of ensuring that that bank is able to deploy capital to these destinations where they have confidence in the information. We've got a lot of literature about the unbanked and the underbanked, the degree to which they're really plugged into the formal financial sector, whether credit bureaus even track information about them. So if a bank is interested in, say, lending to a small business, a bakery on the corner or a barber shop, what do I know about them? Can I confidently make that loan? I think that creates a really big impediment to people being able to access it and eventually become owners themselves.
Yeah, it seems though that when we talk about ownership and access and information asymmetries, these are all buzzwords that regulators think about, right? These are, in theory, the kinds of words and the kinds of things that Washington, D.C. Should be thinking about. But at the same time, it becomes more complicated as subjects, issues become more complex. Technology and the introduction of new technology is what this conference is about. We've, again, tried to tackle issues of both risk and opportunity. Where do you think financial technology or fintech has risen to the occasion, and where has fintech fallen short? Lule.
Yeah. Well, risen to the occasion is just access, right? I could keep on saying triple times that. Somebody being able to own a stock either through, as I said, a tokenized asset on an INX or the fractional shares on an eToro or so that part, the access part, the greasing of the skids part of being able to access capital and ownership of capital. So I think that part they got right. They also got it right in the sense that everything was about a monopoly of knowledge, and so they demystified knowledge and made it easy to understand through the beauty of design and design thinking, right? So I think they got it right there. Where I think we have to sort of take stock in is a few things. So one is like governance is important. You'll never hear me say governance is unimportant. And sometimes I think people who are in the innovative sector think governance is what slows you down, is what burdens you, and that's not necessarily true. Good governance doesn't have to slow you down and burden you. In fact, it prevents bad things from happening. We believe it in our own lives. Why can't it be in our business, right? So I think governance is important. I also think making sure that ultimately you have a diversity of thought and designers in the room is important. So it's not just one kind of mental framework that's in the room. I also think that collaborating with regulators is important, and I tried to do that at eToro, but ultimately, you know, on the other side has to be a partner as well, right? So collaboration and sort of brainstorming with regulators, because I think most of them are trying to do right by their mandates as well. So I think those are the things that, you know, I don't think, you know, given the personas that were in fintech, were happening quite well. I do think, however, we have gone way to the other side from a pendulum perspective, so that fintechs are not teenagers anymore. They're in their 20 to 30-somethings, and they want a partner on the other side, and the other side's just got a cudgel, right? And I think that's an important sort of pendulum we have to course correct on. And I think design-wise, you said it's getting more and more complex, right? No doubt about it, it's getting more and more complex. But any technologist will tell you, any physicist will tell you that actually the more complex an organism, the more simple and streamlined your approach to it has to be. So just again, the more complex an organism, the more simple and streamlined. You have to go to principles rather than prescriptive rules. And my worry is that we keep on going to prescriptive rules a la Dodd-Frank, 1,000+ pages, versus more principle-based a la 1940s Act, Advisory Act. And I think we have to go back to that mental framework of principle-based model so that we can keep up with the complexity, which is about ever-changing, you know, sort of forms and substance.
I don't have anything to add to how they got it right, but I do have something to add to how they got it wrong. I think so many fintechs want to be unicorns. They want Andreessen Horowitz to invest hundreds of millions into them. And when you think about a VC's model, they're looking for ridiculous returns, you know, 10, 20, 30, whatever X returns. That requirement, I think, is fundamentally incompatible with the types of industries we're looking for change in. VCs aren't going to invest in a bank. You're not going to get 100x returns from a bank. So I just have this impression that the innovation that we're seeing amongst fintechs is not really touching at least the industry that I care most about, banking. It's not touching it in a meaningful way. They might be neobanks. They might be something adjacent to a bank, but they are not going to be a bank itself. And that's important. There's special powers that come along with having that charter. And without those special powers, I think some of the things we're talking about in terms of access and ownership perhaps are a little less direct.
So if you're going to, we only have a minute, but if you're going to suggest one or two things, like literally 2 sentences, for this Washington, D.C. audience in terms of how to course correct, what would they be?
One is, I would say, put out metrics for yourselves that are output-based. So if we are doing everything, but we are reducing capital formation by numbers that you would say are your numbers, then I think you have to revisit your plan, right? And say,
So for the regulators themselves.
yeah, like I think that, expansion has to be one of your KPIs. The second is a mental framework of what I just talked about, right? First principles rather than complexity of prescription of rules in whatever microcosm that you exist in, I think is really important.
Be open to newcomers. It's competition. It'll lower prices for consumers. They'll get better treatment. You'll have a better system. Don't be closed to innovation and newcomers.
All right. Great conversation. Thank you so much to both of you guys. All right. We'll have our next conversation on inclusion and CBDCs with some of the world's top regulators. So, welcome to the stage.
I'm like waiting for somebody to give me like a green light, go. Hello, everybody. We have a panel on the global regulatory landscape from CBDC to crypto, which sounds like so serious. So we have some serious people with a good sense of humor on the stage, and I have been asked to moderate this panel, which I thought being a panelist is always a better thing, except when you realize the moderator has all the power, so I can ask them whatever questions, and they can't leave the stage for 30 minutes, no, 24 minutes and 50 seconds. So we'll start with a question just going down the line here. There has been considerable exploration about the potential for digital assets in retail over the past few years, but less so debate and discussion about wholesale, although many participants believe this is where the biggest opportunity might be. What are your thoughts on wholesale versus retail?
I agree.
All right, excellent. Alessandra. So, Peter, I've known Peter for about almost 15 years in the European Union, and since the moment I met you, Peter, I've been wondering how long it'll take for the EU to fire you because you're a one-sentence answer person, and you don't filibuster unlike the most European officials. Alessandra, he's still here. He hasn't been fired.
Well, I agree with a yes. I think that, there's a lot to be said about the struggle between, applying DLT and look at what, the target services are still there in the Eurosystem and whether we should upgrade them, how the system should work, how we should avoid fragmentalize, the platforms that, the DLT privately owned. There is all that debate going on in the Eurosystem right now, and I think it's very interesting, and also it tells a lot about also the need for Europeans to, I heard it around here this morning to kind of regulate everything. But this is a very topical issue for, cross-border payments. And I think there has to be some form of harmonization, at least in Europe, and that, as a dialogue with outside of the continent.
Yeah, thank you, Alessandra. Craig?
Yes. Yelena, I was married in 1992. And one of my first purchases for the household was a computer. And I was really excited because this computer had the latest technology. As an example, it had a 14.4 kilobit per second dial-up modem, which, was the latest at that time. And so, lightning speed compared to the previous technology. Now, to give you a sense, because I know there are a number of younger individuals in this audience, to give you a sense of the speed of the 1992 dial-up modem, an Adobe file that's 20 to 30 pages with lots of high-resolution pictures is about 10 megabytes in size. It would take modern-day broadband about 1 minute to download it. But with my 1992 dial-up modem, it wouldn't take 1 minute. It would take 1.5 hours. So since 1992, technology has come a long way, and some would liken the traditional financial system to dial-up. And wholesale digital asset business to modern-day broadband because of its ability to effect real-time transactions, its ability to effect a single source of the truth, and you can actually program in it a reduction of counterparty credit risk. Not only that, but a number of issues across various markets can be addressed, whether it's carbon credits, whether it's digital rights management, supply chain management, and it just goes on and on and on. And so there's certainly a lot of promise. We've heard in earlier panels some of the frictions, and yes, they do exist, and they're being resolved, but there's certainly a lot of promise when it comes to wholesale digital assets. And again, if we had to do the comparison, it's more like the modern-day broadband as opposed to dial-up.
Yeah, and I remember those early stage of dial-up were like Marissa Tomei's character in My Cousin Vinny when she stomps down. He says, "My clock is ticking," and the thing still keeps on dialing up. Shalola.
What is dial-up? No, I'm just,
Says the IRS.
Says a much younger person. No, look, I mean, I think ultimately what comes out of this, beyond the tokens and beyond the retail market, is diversification of technology, as many of the panelists have already mentioned, and we see proliferation of this technology in everyday life to, especially when you consider it combined with the march in AI that we're seeing today. I think that's what is limitless, and with that, from a regulatory perspective, comes complications on how to regulate, what to regulate, and when to regulate, which I think is always the million-dollar question. But I think that at the end of the day, beyond the investment in tokens, the wholesale digital assets is where it's at.
Yeah.
If I may, the question which you asked is that we haven't seen anything yet when it comes to digital assets. A lot of focus is on this retail market, and current market valuations are about 2.3 trillion, which is a lot of money. Daily transaction volumes, on a good day, reach about 100 billion. That's a lot of money. But this is very small in comparison to wholesale financial markets. And when they move to the digital DLT-based world, that's when you'll see real action. And Chairman Giancarlo was going on about and applauding the European work on MiCA and so on. But in a way, that's a bit of a sideshow, because that deals with this small, relatively small market, where the real potential lies is in financial instruments and the tokenization of financial instruments. And that will be absolutely massive. I don't know when that's going to happen, but I'm certain it will happen.
And Peter, I'll put you on the spot. Why is it not moving into that direction much more quickly?
Because you need various things in place. You need the buy and the sell side to be confident on this new technology. You need the financial market infrastructures to be mature enough to support this trading. And, very importantly, you need these assets to be acceptable as collateral for money market policy by central banks. So central banks have to be prepared to accept them as collateral, because otherwise no financial investor is interested in them if they can't use them as collateral. And you need cash on ledger, because these transactions have to be settled. And if you can't settle them on the ledger in central bank money, or in large amounts of commercial bank money, or in stable coins, then there's really no point in doing these securities transactions on a ledger. So a number of conditions have to be fulfilled. The question is, what do we get first? Do we first get these markets to develop, and then central banks will start moving central bank money onto the ledger, or do we first need to have central bank money on the ledger so that these markets can grow?
Yeah. And in America, there's a saying, if you build it, they will come. But I feel like Marissa Tomei, my clock is ticking and they haven't come yet. Alessandro, this moves us perfectly to your domain, which is regulation. As a former regulator, there's always risk you look at, the risk in the system and how to manage it, how to regulate it, how to allow the regulated entities to manage it. And there are tools at your regulatory disposal that can be utilized to kind of regulate new technology, even if we don't have necessarily regulations that were made bespoke to that new technology. So how would you say your organization is looking at regulation, the tools you have at hand, what new tools you may need, anything that's giving you pause in terms of moving forward in this brave new world more bravely?
Well, well, first of all, this is like at European level. I'm a member of the supervisory board of the ECB. So, and this has been, coming over the, last, say, 2-3 years very steadily. And the idea of pulling and pushing the blanket, clearly doesn't work anymore. So MiCAR, and DORA have been given some vertical and horizontal kind of regulation that has helped us to devise, a new way to look at the risks that are associated with this new, provision of services, going on platforms, looking at this old, a traditional bank moving on to, a world of digital provision of services, what they do with their legacy, with their IT legacy, how they get together with tech providers, and what kind of concentration we have there in that field, and what kind of problems we have when, these tech providers become so powerful in the banking and financial industry, and how do you go about that? So there are a number of tools that regulation is giving to the European supervisor, but we need to test those, and now with all the, the kind of the early SREP and the stress tests that we do with banks, we'll be factoring in a number of measures. They're a lot, stricter when it comes to issues that are connected to digitalization of the business. But it's really ongoing now, even though we are getting more and more exposures as big banks are moving into the digital world. It's slow, and they have to face competition that comes from other sectors, and they need to hire new people. They don't have the kind of, cultural spectrum of people that can help in moving, towards that direction. And we have to do it too. We have to, in order to understand the risks, that are out there and what to do about them and how to regulate without stifling it. We need to hire people as well, and competence and skills that haven't been traditional in central banking. So that is it's a mirror, it's a looking at each other, kind of thinking, I'm going to be faster than you, and it's a nice kind of ride.
Yeah. So speaking, Craig, faster than you, Bermuda is not just a wonderful tourist destination, but you guys have been ahead of time and ahead of other jurisdictions in a lot of things. This past June, the Bermuda Monetary Authority announced the Joint Digital Asset Memorandum of Understanding with the Financial Services Regulatory Authority of the Abu Dhabi Global Market. The BMA also signed an MOU with the Wyoming Division of Banking in 2021. What is the main purpose of these MOUs, and what mechanisms are being implemented to support effective supervision across jurisdictions?
Sure. Thank you. While I'm a Bermudian, I've been following American football since the early 80s. And I've been a Philadelphia Eagles fan. Now, do we have any Eagles fans here? Okay, all right. I like this crowd. I've been a Philadelphia Eagles fan since the days of the ultimate weapon, Randall Cunningham, as well as the Sackmaster, the Minister of Defense, Reggie White. Now, along with my wife, the last time I was in Philadelphia was solely to watch an Eagles match. And it was a memorable occasion, but probably not what you're thinking. So as we approached the stadium, our senses were seduced by the smoky and sweet aroma of barbecue and the lively music. And as we were soaking up this festive tailgating experience, I was compelled to ask my wife, so do you have the game tickets? And with a look of confusion on her face, she said, no, you have the tickets. No, I don't. I gave them to you. Needless to say, because we didn't communicate prior to leaving for the stadium, the most important job wasn't done. And give you some advice. If you go into a game, the most important job is to bring the tickets.
Or create an NFT.
All right.
There you go.
Not with dial-up technology.
So the same thing can happen when we're talking about cross-border financial services, including cross-border digital asset activity. If regulators don't communicate, then the most important job might not get done. And the most important job when you're thinking about cross-border activity is to ensure that regulatory gaps are addressed. And so there are a number of mechanisms that regulators can use in order to address those gaps. But one of those tools is a memorandum of understanding. So a memorandum of understanding is an agreement between regulators who, in terms of how they will cooperate, how they will communicate, collaborate, etc. And it can cover almost any area. But to give an example within a digital asset context, I'll give maybe four. One would be regulators maybe agreeing to meet on a quarterly basis to discuss digital asset developments in their respective jurisdictions so that they can see trends and be prepared. Another one might be, we just spoke about what are some of the tools that regulators can use. So another one might be regulators sharing supervisory best practice as it relates to digital assets. As an example, we can share SupTech. The BMA could share how we are using generative AI as well as blockchain forensics in our supervisory work in this area. There could be joint on-site examinations, and so if you have a digital asset business that has a presence in multiple jurisdictions, then regulators may agree under this MOU how they will coordinate their efforts in terms of the on-site examination process. And the final one that I will provide is mutual assistance. And so regulators may agree, let's just say if one regulator is investigating a controller of a digital asset business and that controller has a presence in another jurisdiction, then they may come together to share information to further the investigation. And so digital, I would say that MOUs are one of the tools that regulators use to ensure that the most important job gets done.
Yeah, and Charlotte, I want to get to you on something, but before that, given the discussion we just had about the regulatory environment, Peter, what regulatory lessons would you say have been learned by the EU from MiCA, and what tools do you think you could make better based on that experience? What has worked, what hasn't?
I would say keep the lawyers out because they always complicate things. They say, we need to add clarity. And what that means is that we'll just need to add 20 pages to the legislation with all kinds of gobbledygook, which no one understands. So that's the most important lesson. The second is keep it simple. It's not because crypto assets and digital assets and cryptography are complicated that the rules around it have to be complicated. The less you say in the rules, usually the better it is. Stay to basic principles. Don't mislead your consumers. Be fair and open in your disclosures. For example, the MiCA disclosures are all about disclosures being comprehensible, not being comprehensive. Now, this is bad news for the lawyers because the lawyers love writing long disclosure documents, dozens of pages, which no one reads. Well, no, the lawyers read it. Analysts read it. Sometimes. Analysts read it. Sometimes, if they are too junior and you read that stuff. And then litigators read it because when something goes wrong, they'll go in there to see if there's somewhere they can peg some liability onto someone else. But everyday investors don't read it because they don't understand it. What we wanted is a simple document that explains the basics. What technology are you using? Who are you? What are you issuing these tokens for? What are the rights to these tokens? And don't create the impression that this crypto asset is going to be your ticket to a Lamborghini. You know, a lot of these crypto bros, they look at their success as to how quickly they can get a Lamborghini in front of their door. Some got a Lamborghini, but crypto assets are not a good, solid way to get a Lamborghini parked in front of your door. And we made sure that they can't make any representations like that. So keep it simple. Don't mislead. Do good.
And if I may, harmonize those rules. Just make them the same all over the place so that there is no arbitrage going around trying to, sneak in from other doors. I think that that's very, very important as well.
Thank you, Alexandra. So speaking of crypto bros and Lamborghinis, the IRS. So before we get to the Lamborghini question, Shulalet, what modem speed does the IRS operate at? No, kidding, that was a joke question. All right.
Before or after they hired me? I think that's the
I will save you from answering. I do have opinions. I have opinions on things I know nothing about. Let's turn now to a little bit of our interesting, somewhat fragmented United States regulatory framework. And so when we talk about crypto assets, digital assets, stablecoins, et cetera, most often the discussion is about the SEC, CFTC, since I'm a banking regulator, former, FDIC, OCC, FRB, and if I continue, I'll sound like a rapper. So people don't really think about IRS being one of the key players in that space, but then you work on policy that basically sets forth a lot of things that really matter in how these assets will be regulated from the IRS perspective. So what can you share with us?
No, thank you for that. I think at the end of the day, we talk, and rightfully so, a lot about institutions, right? Large numbers of dollars are involved from institutional involvement, and that's absolutely important. But so are the everyday people, the taxpayers that are involved in crypto transactions. So I think by our account, when we looked at it, about 85% of crypto transactions in the United States are done by everyday people. And for a long time, the challenge was, the cart before the horse, right? Like, you're supposed to check a box on your tax return saying you've had crypto transactions, but there's no year-end form that people can submit that shows for them what their gains and losses are, for example. And what we try to do at Treasury and IRS is try to divide up, what was the lowest hanging fruit and what was the biggest need at the moment, the first half of which was the taxpayer's interest. So in June of this year, on June 30th, we released our CFI regs that basically will govern how cost basis is to be tracked, how taxes are to be calculated, and that goes into effect in January. Well, it's transactions of 2025, starting in 2026. Currently, we are working on our DeFi regs, which is a hoot. And if I don't sound like a government bureaucrat, because I've only been at the IRS for 9 months. Before that, I was in private sector and startups. So I have people there watching me very carefully in what I say. So look, I came into the government because when I was in TradFi and then in the crypto world, one of the things that I noticed was, through the best of intentions, the industry and the government were talking by each other. And I think the way I think about it is, in the regulatory world, especially in Treasury and IRS, TradFi still rules the day in how people think. And in my mind, having worked in both worlds, I feel the fundamental difference is that TradFi is made up of, accountants, lawyers, finance people that use technology to create, communications and products, whereas in the crypto world, it's technologists that create financial products. And those are two very different mindsets. I say this because that has to be the spirit with which crypto regulations have also got to be approached. Things like, just because you have, a rule that's finalized today, that it should not be changed for the next 30 years. By the time the rule is finalized, there are 15 iterations of the same product, right, that had nothing to do with the rule, right? So there has to be an acknowledgement that technology moves at an astronomical pace. Regulations will always follow. It will be slower because it needs to be thoughtful. It may not be fully future-proof, but it needs to be thoughtful and address the issues of the day, but be flexible enough to be amended if needed in the future. One of the things, and it's been famous that when we released our proposed regs, we got 44,000 comments, right? Many of them bot-created. However, the law requires us to read all of them, so we did. And therefore, when we release the final CFI regs, the industry, by and large, in the United States, received it quite well, because many of those comments were taken into account, and some of the challenges we deferred to and we're still working on. So I can't speak for the CFTC or any of the other Cs, but at Treasury, what we are trying to do is making sure that, you know, the taxpayers have the tools that they're familiar with to report. I'll give you an example. In the United States, generally getting a year-end form, whether you are, you know, it's an interest or dividend or whatever, is a cultural phenomenon. People are familiar with that. In the absence of that, it creates confusion, and people don't know what to do. So we're looking, you know, we believe in voluntary sort of compliance increases. We believe that the rules that we're writing and the implementation of that will lead to an enhancement of that. And then, you know, the few that don't follow those rules will know the delta. So.
You know, I'm going to go on a limb and say that the people probably did not object to your final rule because they didn't understand the lawyer language that was put in there. So give them a couple of years and a couple of IRS audits, and you'll hear from them. So unfortunately, all good things come to an end. So does this panel. Shulat will be available to take your questions with his watchers about your crypto holdings and the IRS. He has no opinions on the Lamborghini, so for now. But I would like to thank the regulators. This is a panel of all regulators. Good luck with that, by the way. The life is so much better on the other side. I appreciate your wisdom and everything you have shared with the audience here today. And your participation. And we would like to welcome to the stage CNBC's Tanaya Makil and Brad Garlinghouse, who I'm sure undoubtedly will be continuing to provide entertainment for the rest of the day. Please, a round of applause for our participants.
You should have the middle.
Okay. This works. All right. Hello, everybody. My name is Tanaya Makil. I am a crypto reporter at CNBC. We have several, obviously, but my coverage focuses a lot on markets and investing trends, which includes things like payments and stablecoins, which is why I'm very excited to be here with Brad, who is Brad Garlinghouse, the CEO of Ripple. Thank you.
Glad to be here. Thank you for nice to see you in person.
Yeah, so yeah, Ripple, a big point of interest for me. And I don't know who's in this room. I know this conference has been going on a long time, and many people are returning to this, but I have been covering the space for 10 years, so I know that there are always a lot of newcomers here. Ripple has been around for a very long time in crypto industry terms. It is a payments company, very global payments company. Closely tied to the XRP coin, which you can get a little bit into,
sure.
Which is, of course, one of the biggest by market cap. A lot of attention recently because of the SEC's lawsuit against you.
I heard about that.
A partial victory in last year, a partial victory, but kind of a landmark victory for the industry. Are there any updates on that you want to address before we move on to the session?
We won't spend all of our time having been up on this stage in previous years. It's always been a topic. So as Tanaya was referencing, the key part of the case, the SEC sued us, kind of what is XRP, their allegation being that XRP is a security. The judge ruled last summer that XRP, quote, in and of itself is not a security. The SEC announced about right around 2 weeks ago that they're appealing, but what I think is misunderstood is they're not actually appealing that part of the decision. So for us, like the biggest win, and as you described, the landmark part of the win is really the SEC has tried to take the position that a token can in and of itself be a security, and the courts have consistently ruled that that is not the case. And they, in the appeal, what they're really appealing is this idea around programmatic trades, programmatic sales, as to whether or not that represents an investment contract. And the idea being that if it's a programmatic trade, it's anonymous buyer, anonymous seller, that there can't be a contract there. Their contention is there can be. You know, look, as you go up the appellate courts, it gets harder and harder, I think, for the SEC. We're very optimistic about where we stand on this. And again, the good news is no matter what, XRP, the law of the land is XRP is not a security. The one last thing I'll say about this that we were talking about backstage, I think is super frustrating, a little bit, mind-numbing is, so is the SEC going to litigate every token? We have clarity. They've said Bitcoin's not a security. They've been a little nuanced about ETH. I guess now they're saying it's not. First they said it's not, then they said maybe it is. They're going to Wells notice, and now they're saying it's not. XRP, a federal judge has said is not. But everything else is kind of still up for grabs. You even had the head of enforcement from the SEC who left about 2 weeks ago. After he left, contradicted what Gensler is saying and saying, we need legislation. We need clarity. And I think the good news is there appears to be momentum, with the FIT 21 Act passing the House this summer in a bipartisan way. There appears to be some momentum around that. So maybe we'll get that sometime soon.
And then, as you mentioned at the top, of course, earlier this month, the agency did appeal part of that decision. So is there anything, any updates there that we need to know about?
Nothing, that will progress. It'll take, call it a year to kind of go through the system. That I think it'll be interesting. The filing work that they'll have to do kind of comes out in January. By then, of course, we'll know if there's what the presidential election yields. It'll be interesting to see if there's a shift, and they could abandon that appeal. They could continue with it. I think obviously many federal courts have agreed that the SEC's war and kind of Gensler's reign of terror on crypto has been misguided, and I think they've gotten kind of smacked down by several courts with language. In our case, it was quote, and I'm quoting a judge and saying this, that the SEC has failed to follow a faithful allegiance to the law. In another case, they described the SEC as it relates to, this is a grayscale case, they're being arbitrary and capricious. I think many in the industry have asked for many years, we want to follow the rules. We need to have clarity about what the rules are. And the SEC has changed the rules. Their own interpretation of the rules have changed at times. And, anyway, it's frustrating. I've already said many things about this. And I will say many more, I'm sure.
Well, thank you. With that out of the way, do you want to back up a little bit? So, like I said, Ripple has been around a long time. I wonder if you could just reintroduce the company to the people in the room and anyone watching on live stream. I think that people hear Ripple sometimes and make an automatic association with XRP. Can you just reintroduce the company?
Sure.
Say what Ripple does and what its place is in the U.S. fintech industry.
So Ripple's vision from the earliest days, this even predates me, Chris Larson, the co-founder of the company, really articulated this vision for enabling an internet of value, to allow value to move the way information moves today. And so, how do you catalyze that vision? And Ripple started by focusing on the payments industry. And if you kind of dissect the payments industry, you go to where's the highest point of friction. Cross-border payments are the highest point of friction. Cross-border payments today are kind of, largely speaking, built on the SWIFT ecosystem, which is slow, it's expensive. It was architected 50 years ago. The error rate is quite high. And it's kind of like in an age of the internet, why can't we have something better? And so we have been working with banks and financial institutions around the world. 95% of our customers are non-U.S. financial institutions, which is partly a reflection of the U.S. SEC dynamic. But we continue to focus on that kind of infrastructure layer. We had demand from our customers and acquired a company about a year ago in the enterprise custody, and so we count some of the largest banks in the world using our custody technology. But we are not a consumer company. We are an enterprise infrastructure company around kind of all things blockchain, and we intend to kind of stay at that level. As you introduced, XRP is part of our technology stack, and we have always had a kind of a vested interest in catalyzing and investing in and seeing the XRP ecosystem thrive. We think I am definitely not one that I would call a maximalist around crypto. Frankly, I've shared before, I own Bitcoin, I own ETH, I own XRP. I think there's going to be a multi-chain world. XRP is exceptionally good at payments. It's very, very fast on a per transaction basis, and it's very, very low cost on a per transaction basis. It scales much better than some of the other layer one chains.
How does price action in XRP affect your business, if at all?
It turns out it doesn't really. If you do the math, and we have a whole white paper we published on this, but if you look at the volatility of a low volatile asset like a fiat currency, but you hold it for, let's say, 3 or 4 days to settle a SWIFT transaction, it turns out you have more volatility risk in a low volatile asset as compared to an XRP transaction because it's a highly volatile asset, but it's a very, very fast to transact. So it turns out there's less volatility risk. Now, in the traditional fiat world, when you go to a bank to wire money, someone's hedging that currency risk for 3 or 4 days, and you're paying for that currency risk. You're locking in a rate in advance. You don't have to do that in the crypto world because it's so much faster. If the volatility, say, got much, much, much worse, you could have a situation where you could have new participants in the market emerge to kind of sell that product.
So you mentioned just now that most of your business takes place outside of the U.S. You've reintroduced the company. How do you view Ripple's role in helping shape fair fintech regulation here in this market?
You've heard of fair shake. Well, the introduction of the word fair. So Ripple is one of the companies that is behind a super PAC called Fair Shake. It's one of the largest PACs in this election cycle, although we have indicated, and I think the other, Coinbase has been active in Fair Shake as well as Andreessen Horowitz. We're kind of the three anchor. There's been a few other supporters as well. But, I use the word fair. All that we're looking for is a fair shake. There is a lot of misinformation, and frankly, I don't mind saying it. Look, Elizabeth Warren is out there spreading misinformation and lies about crypto. She will tell you that all crypto activity is illicit activity. The facts do not bear that out. And so all we have asked for is a fair shake. I think crypto should be bipartisan, and the Fair Shake Super PAC supports people on the R and D side. It's been important to me. It's not a coincidence I'm wearing a purple tie today. So we have been very active because we haven't had those clear rules of the road, and I think no matter what happens in a few weeks here, we will have a more pro-innovation, pro-crypto Congress that gets elected.
What have your conversations in D.C. been like? Just for, even before election season, how engaged with regulators have you been? You've been around for a long time, so what are those conversations like?
Not that
old. I'm saying Ripple is
original
killer.
Yeah.
Yes.
Killer. I like that. I've made far more trips to D.C. in the past few years than I did in the years before that. And by the way, I look back on that and I regret that. I think we made a mistake by not leaning in earlier, and we're trying to make up for lost time to some degree.
Leaning in how?
Well, part of it is just education, right? It's showing up here. And look, I'll speak freely in a very private audience. It doesn't help that you had Sam Bankman-Fried showing up on Capitol Hill with cargo shorts and, selling something that turned out not to be exactly what was represented. That hurt the whole industry. That hurt Ripple. And so kind of counteracting that and showing up and representing that, look, we are serious people. There's a lot of people in crypto. A lot have been on stage during this event. There's serious people doing serious things, and the market obviously has grown a lot. And so when I show up here, part of it is evangelist, advocate, diplomat, ambassador. I will also comment, and you and I talked about this a little bit backstage, but it's still interesting to me how the U.S. is behind other countries. I spend a significant amount of my time talking to central banks and regulators around the world. And whether we're talking about Japan or the UK or Singapore or the UAE or Switzerland, even Brazil, no, that's not to mean Brazil's bad. It's just including Brazil. The U.S. is a laggard. And for reasons that don't really make sense. And I think it does get back to this kind of misinformation that it's been, I think the Gensler reign of terror, mixed with the Elizabeth Warren, spreading misinformation. It's like crypto's the boogeyman. And it's just not the case. And so I think it's important for the industry to show up at events like this and make sure people understand how these technologies at their core can be used to benefit citizenry, to use to benefit businesses, reducing costs, increasing speed. I truly do believe blockchain is going to rewire lots of parts of the financial ecosystem. Ripple's focused on our piece within that, but I'm excited to see lots of other companies here representing.
So you do business all around the world. You understand the rules of the road in those jurisdictions because they are clear and because you've put in the time. So is there anything that you've learned from abroad that could be applied here?
Oh, sure. Look, let's use the UK. The UK was early in coming up with a kind of a taxonomy of how they defined different tokens. certainly in Japan. I mean, look, I just think the U.S., for whatever reason, this SEC has failed to do the work. Like, you know, I remember early in Gensler's tenure, he went out and hired a whole bunch more litigators. If only he had used those budget dollars to hire some people to codify and write down and work with Congress to legislate, hey, this is new and it is a little bit different. And the Howey test, as much as you can try to twist it into knots or branches of a tree, orange tree, like, it just doesn't quite fit. So that's okay. Let's sit down. Let's write rules. Let's not try to act like, no, we have the rules we need. I mean, Gensler goes and testifies before Congress that we have the rules we need, and you know the crypto community just won't follow them. Well, the good news is the courts don't agree. Now, that's slow, it's frustrating, and back to what I said earlier, do we really want to go litigate every token? And that appears to be how, you know, Gensler's, you know, it's like, hey, maybe it's a power, try to get more power. I don't really get it. It doesn't feel constructive. It doesn't feel like he's working for the U.S. citizens.
All right, so we're closing in on this election here in a couple of weeks. Can you say what exactly is at stake here for crypto? And I talked about this backstage too, but it seems like for an industry that, you know, has always said it's nonpartisan and has evidence of growing bipartisan support in Congress, the vibe seems to be throughout election season increasingly partisan. Very, like, do you agree that Trump would be very, very good for crypto and Harris would be very, very bad for crypto? What exactly is at stake, you know, come November 5th? And is it as dire as it's been made out to be, I guess?
Look, I do believe this is the most important election since I've been in crypto a long time. You've pointed that out a few times. I think this is the most important election we have had. And but I also believe no matter what happens, we're going to have a more pro-crypto, more pro-innovation Congress than we've ever had. I think no matter what happens, we're going to leave behind a failed approach from the Biden administration. It has been an attack, and it isn't just the SEC. You know, look, the OCC is hostile towards crypto. The Treasury is hostile towards crypto. The idea that people say choke point 2.0, and just to define that, you know, that choke point 1.0 was this idea of the banking industry was debanking a industry around payday lending and these things. It wasn't legal, and actually they lost court cases later on, but choke point 2.0 is the crypto industry, and individuals within the crypto industry are being debanked. I personally have been debanked. I got a call not that long ago from, you know, one of the major banking institutions I'd had an account with for 25 years, and they said, you have 5 days to move your money. Why? And they were actually super honest. They're like, look, you are a notable person in crypto, and having notable people with crypto and banking the crypto industry means more scrutiny from federal regulators. So we don't want it. Now, that's not legal, but it's also like, okay, fine. There's other banks that'll bank me. But imagine if you extrapolate that out and more banks. If I actually was cut off the banking system for the sole reason that I'm the CEO of Ripple. That is a hostile administration. And I think no matter what happens in this next election, we will have a reset. We can debate the magnitude of that reset, and there's lots of disagreement about that. Obviously, Trump came out early and very aggressively in a pro-crypto and said he's the crypto president. Kamala and Team Harris have been more nuanced. This week, I think it was this week, they had some of the most constructive things they have said publicly. But look, I do think, you know, Kamala Harris is from Silicon Valley. I think she has generally been pro-technology over the years. She has been relatively quiet on the topic. But I think no matter what happens, we're going to see a reset. We're going to see forward progress, and I'm certainly looking forward to that.
Yeah, so you are wearing a purple tie, so you're not here to make any endorsements?
I did endorse John Deaton yesterday.
Saw that.
I mean, I'd already given money to him, so. But look, Elizabeth Warren, I think, has been the most destructive towards this. I mean, she has a webpage on her campaign that says, "I'm building an anti-crypto army." It's like, okay, I'm against the technology. I've made the joke before, like, why would somebody be against a technology? It's like saying I'm against email, but you're for email. It doesn't make sense. Like, you could say I'm against how crypto is being used, or I'm against something, but like, to be against a technology, like, technologies inherently are just neutral technologies. They can be used in lots of different ways. So I don't get that, and I think that the citizens of Massachusetts deserve better than somebody who, by the way, she won't take meetings with the industry either. Like, at least learn, at least be willing to engage and have a dialogue. So I think we all, as citizens of the United States, deserve better.
And what would you tell whoever becomes the next president would be sort of step one in healing the crypto industry?
You know, I think that the key will be, you know, who are the people they appoint into various places. And again, I don't think you can do worse than Gary Gensler. I think he's that bad for the industry. It's just, I don't think he's playing fair by the rules. I think he's been disingenuous with the industry. I don't know. I can't say enough negative things. But so, look, I think the key indication will be who gets appointed to run the OCC, who gets appointed to run Treasury and some of the key positions in Treasury, who's going to be appointed to run the CFTC and the SEC, and you know, it'll be telling as to what the direction of travel is for the next 4 years. But I'll really emphasize, anybody who doesn't believe no matter what we're going to end up a better place, I think is not paying attention. I also, a guy who I really respect in the crypto industry, Dan Moorhead, one of the things he said to me, he runs a group called Pantera Capital, and if you think I'm old in crypto, like I
don't think you're old in crypto.
He's ancient. He's like, yeah, you can tell him I said that. But you know, one of the things he has said that I really agree with is when we look back on this period of time in the United States as it relates to crypto, it's going to look like a speed bump. The inevitable march of crypto and blockchain technologies is going to continue. And 10 years, when we look back on what how the U.S. got it wrong for years and years and years and why we got it wrong, it's going to be a speed bump. And this industry is going to continue to thrive. I truly think it's inevitable.
It's a nice positive note to end on. We're not ending the session, but I am changing the subject. I want to ask about your stablecoin. Ripple USD launching. Do we have a time? Soon. Good. Why? Why now? It's such a hot topic right now, and it is interesting with, you know, the rate cutting cycle and with the state of regulation in the U.S. and the upcoming election. So why and why now, and what is it designed to do, you know, compared to some of the more dominant ones in the market?
Well, so a couple factors. I mean, one, as you introduced earlier, like at its core, Ripple is a payments company. That's where we started, and we've been using stablecoins in some of our payment flows for years. There was a period of time where we were actually responsible for minting 20% of all USDC. And so we kind of stepped back and looked at that, and we're like, okay, wait a minute. You know, particularly, by the way, when USDC about 18 months ago depegged by about 7 or 8%. And we kind of started to ask ourselves, like, well, wait a minute, you know, should we participate in this market, given I think all of these things are driven by utility, like solving real problems. If it's just speculation, I don't think that's a long-term success story. So we got interested and started paying attention. The two other macro factors I'd point out, I really do believe today the stablecoin market's about $160 or $170 billion. You know, some smart people think that's going to be a lot bigger in 5 or 10 years, you know, measured in trillions. So, you know, say 10 to 20x as large. And so there's a lot of growth there. And so I think that, you know, for us playing at the enterprise level, institutional level, and the payment flows, there's a natural opportunity to do so. And so I think as the market grows, there's an opportunity for us to enter that market. The last thing I'll say, which relates to our previous, I know we left the earlier conversation, but just briefly, yeah, the largest stablecoin out there is Tether. And Tether actually has a really good track record of being a stable coin. I mean, it's pretty, you know, its volatility away from $1 has been better than almost anything. But Tether also has gone out of the way to be offshore, non-U.S., and I think that has made it unfriendly for U.S. regulators. And I think as the market grows, and you have the uncertainty of the largest player having 70%-ish of the market, I think that may shift a little bit, and I think that the market overall is going to grow, and so we felt like there's an opportunity for Ripple to enter that market.
Do you intend to go up against a Tether or a USDC?
Look, I truly mean, I think this is a huge market, and there's going to be lots of competition. It may be that we continue to use USDC or USDT in certain payment flows, but inherently, if we're launching a stablecoin, I mean, I'd be disingenuous to not say, are we going up against them? Yeah. I mean, this is a new stablecoin. and inherently we're competing. But I don't look at it as, I think Tether is not going away. USDC is not going away. And I think, USDC has been quite successful as being transparent and regulated and really trying to be a leading light as a regulated player. And so I think they both will continue to succeed. But again, I think it's a big market, and I think we can take some share and for our use case and focus on that.
How, if at all, does that change your U.S. presence? It'll be dollar-backed. Are you engaging with regulators on this?
Yes.
What does that look like?
So we acquired a company, I can't remember when it closed, but, called Standard Custody, which has a New York NYDFS trust license. We are in the process. We won't go live until we get the green light to do so under the trust license. But we are already operationally ready. We've done, lots of operational testing with a whole bunch of launch partners, including exchanges and market makers. And so we're excited about the early momentum, even though we're not live. But the key, you ask when are we going to go live? We will go live as soon as we work with regulators. We will only do kind of front-footed, compliant, regulatorily appropriate things. There are good rules of the road on this one. So let's follow the rules of the road. And so when we get the green light from the regulators and our kind of license as a licensee, I don't know if I got that right, but we will go live then.
And I asked this before, forgive me if I missed it, but because you are not a consumer-facing company, the use case, stablecoins are exploding right now. So they are mostly used for trading. We are starting to see that other use cases for stablecoins are emerging in popularity. What would the purpose of RLUSD be?
Well, so it goes back to, we're already serving, lots of institutional enterprise clients. Again, I used the data point. We happened to be 20% of all USDC minting for a period of time. And so we kind of felt like, well, wait a minute, like we could play in this market. The thing I also, Operation Choke Point plays into the growth of stablecoins because it's the on-ramps and off-ramps that are a problem for a lot of crypto players. And because the U.S. government has been so hostile and by extension banks have generally been hesitant to bank the crypto industry, you have this problem around on-ramps and off-ramps, and stablecoins serve part of that solution to manage those on-ramps and off-ramps.
I was actually just going to ask, with the closures of Silverbank and Signature last year, how much do you think that's affected this explosion in stablecoin popularity now?
For sure it has impacted. I mean, again, just to put some color on that, so everyone's on the same page, Silvergate was shut down by the government in part because they told them they could only bank, and this is not me making this up. This is in court filings. You can go read about it. They said basically, we won't allow you to have more than 15% of your business be crypto companies. And that basically meant they couldn't be solvent given that they're a mix of customer base, and so they had to shut down. So the U.S. government kind of forced Silvergate as a banking crypto companies to shut down. I believe there will be lawsuits about that before it's all said and done. But, there's no doubt that the fact that you had a pullback from banks that were serving this industry, it fueled demand and an increase in activity around stablecoins. You could see the math around that, some of those things happening. Now, there was also a shift in market share. And again, the ironies of the U.S. government doing things it's just like, you guys got to think through this. So you debank the U.S. industry. So what happens? USDC, which is more regulated, more compliant, its market share goes down. Tether's market share goes up. And Tether, so we're pushing activity offshore. So we're pushing activity to less regulated, less, all the kind of things that the U.S. says they want to protect consumers and what have you, but yet we're doing things that push it offshore. Like, what? Like, this is not smart.
We are coming up on time. So to cap it off, and thank you for all of your insights, your advice to fintech startups at this point in time in this precarious regulatory environment, which you say is only getting better regardless of what happens in the next few weeks, what is your advice to fintech startups?
Incorporate outside the United States. Look, I hate saying that. Look, I'll be honest, you guys. I grew up in Kansas. I'm a pro-U.S. guy. But look, if I'm honestly giving advice to an entrepreneur who wants to meet with me and talk about a fintech crypto-related company, You don't know what the rule. You can hire the best lawyers, the most expensive lawyers, and spend a shit ton of money, and you still don't know whether or not the SEC is going to sue you. And if you go to the UK and incorporate in London, you know what the rules of the road are. You have a welcome, a constructive engagement with the central bank. It's just apples and oranges. I can't. I was just in Japan. We were talking about this. The welcome reception, the warm reception Ripple gets in going to Japan versus, here. It is changing. And look, there's people on both sides of the aisle that see this and understand it and are fighting hard to change it. But I feel resolute. The Biden administration's approach to crypto, when we look back on this, we will realize that we did the United States a disservice in a key technology that we should care about over the long term.
Give it up for Brad Garlinghouse.
Thank you.
Thank you so much.
All right.
Thank you.
It's a pleasure to have yet another perspective from an entrepreneur, builder, and thought leader. John Collison, thank you so much for joining us for DC Fintech Week. This is your first time here, and just behind the curtain, I said, hey, can you believe that only 8 years ago we were in a small little basement? And then he said, oh, I can believe it. You've built, a major company with your brother, major success. I think that we can continue some of the conversation that we had with Brad, but in a little bit of a different direction, right? Often when I talk to my students or when I talk to regulators or people on the Hill, we talk about payments infrastructure. But, when you think about financial technology and how it's been evolving, both sort of the payments word is changing, as is the word infrastructure. So I'm a lawyer, I'm a law professor, how would you start to even define or conceptualize, payments and then infrastructure and then combining it, payments and infrastructure? How's it evolved? What do those terms even mean today?
Yeah, it's interesting, right? Because certainly when we started Stripe and as we were growing up, there was a bit of a sense people were wondering, isn't this a solved problem? Payments, how hard can it be? Like, Stripe is 8,000 people. I think, sometimes people respond with surprise to that of, what do they all do? How hard can it be? And so if you think about, what was the opportunity that Stripe came into, or what is it that Stripe does that's kind of the special sauce? There's like the basics of payments and value exchange and making that easy for people. But I would say there's a few aspects to the business that are maybe not totally as obvious to people that are a very big deal. The first is accessibility and making payments easy to use for anyone who comes along. And so before Stripe started, generally people would go to a bank to get a merchant account or something like this. It wasn't that well set up for internet businesses. They had to go through kind of weeks of onboarding processes that were not kind of useful checks and underwriting. It was just friction. And so a big part of the Stripe value proposition is the fact that you can come along, you can sign up, self-serve, and get a Stripe account, and then we'll let you start using the product right away. That obviously is actually there's a lot of work that goes into making that product experience available on the credit risk underwriting side, on the AML KYC side, building all the AI for fraud detection that we do, things like that. And so I would say kind of access to the payment systems is a really interesting problem that doesn't get talked about that much because people assume that they just work. But how do we make it so that a brand new startup that doesn't have much of a digital footprint online that just got going can get good access to the payment systems while keeping all the bad guys out? That's a very important component of it. And then when you say about the infrastructure side of things, no one had thought of APIs as a product before that. And I think a big part of what Stripe did that was different is, we put code on the homepage. We said the API is the end product that you care about and thought about that as a first-class product. And that's still a lot of how we sell today. Nowadays, even just reliability, the core performance of the API, reliability, latency, things like that, that's what a lot of our enterprise customers care about, and we spend a lot of time on it.
You know, that's so interesting, because I think for the Washington, D.C. kind of audience, in terms of how that answer was going, when you're talking about, okay, you know, you have the API or the AML KYC component to it, you have all these other kinds of checks, you know, we're actually sometimes thinking about that as the infrastructure. And you're actually sort of embedding that concept in the payment itself, right, as part of the payment. And so as I'm listening, and, you know, frankly, when you were sort of walking us through, you know, those initial components to payments, I was kind of sort of waiting there like, so maybe you misunderstood my question, or like, so where's the infrastructure? And instead you're saying, well, look, you know, the way in which we're looking at payments is really broader than even the movement of value. That embedded in that movement of value, there are lots of different components that are already there before you even get to the product side. And I think that for an audience full of people who are sort of conceptualizing, you know, what does an optimal payments system look like, that's a really, it's a quite profoundly interesting notion.
Well, and for me, again, one of the really important tenets of the infrastructure you're building is about access. You know, there's this old saw in banking that, you know, the people that banks are willing to lend to are the people who don't need credit. And, you know, there is a little bit of this issue where large companies that have been established for a long time, they've all got payments figured out. You know, you think of the Amazons of the world or the Airbnbs or the large companies. They have big teams that can focus on this, and people want to go provide services to them. I think the companies that tended to be underserved for a long time was a brand new startup just getting off the ground. They need this revenue engine to actually be able to, you know, get the business up and running, and they would often get rejected for a merchant account, or just the overhead of dealing with it meant they had to start, you know, they couldn't accept international payments or something like that. And so we think kind of the access side of things gets undertold.
That is also, you know, it dovetails in a conversation that we had that I had an hour ago with the former CEO of eToro US, and also someone who's actually failed, but has been a successful entrepreneur, was having problems actually just starting up a bank. And we're talking about the expenses and the difficulty and the challenges of sort of starting a bank. And again, you know, what are the challenges facing entrepreneurs? And one of the things that you're sort of saying is, hey, you know, no one's really, until you guys came along, no one's really sort of deconstructing that journey and attacking some of the pain points. Can I ask just one question of clarification with that? You know, is it that people weren't really willing to kick the tires on rethinking the system, or is it the idea that you're coming along and thinking of your product as an API? That was the big new thing.
I think the payment system as it existed had been very much designed around classic small businesses that were easy to underwrite with a Dun & Bradstreet you know, record and a site visit. Think of your local, you know, coffee shop or bookstore or something like that. And e-commerce businesses were very confusing to the existing payment system. You know, you would sometimes have these more legacy financial firms, and they'd say, you know, well, you know, to a SaaS company, they'd be like, how much inventory do you keep in stock? Can you send us a photo of your inventory? And it's like, hello, we're a software as a service company. Like, that's not a thing here. But it was just a new model that they found hard to reason with. And so I think internet businesses were such a different animal. There were no good solutions in payments specifically for internet businesses.
So, you know, you're in Washington. It's a pretty regulatory world, and you know, when you think about that intersection between, I guess, payments and regulation, I guess I'll just start off with, like, how do you view the state of the world? We're backstage, sort of in the green room, talking about. I couldn't help. I was like, so how much do you travel? And you're like, oh, I travel a bit, which I interpreted as I live on a plane. You know, but when you look at the different kinds of rules and regulations, do you put them in a box? In other words, like, are there certain kinds of categories of different regulatory regimes that, you know, when you're trying to think of and to run a payments company, you kind of have to understand that you're dealing with, and you know, what do boxes look like from the standpoint of an executive circumnavigating the globe?
Right. So, I mean, I spend most of my time living in Silicon Valley, which I think is not generally viewed as a paragon of effective regulatory engagement, I would say. But it's a lot of libertarians in Silicon Valley. But obviously, in the financial world, you end up having these, ideally from kind of early on, pretty deep synergistic relationships with your regulators. As context, we do a lot of business in the United States, but we also do business all around the world. And so we get to kind of compare and contrast all the different regulatory regimes in which we operate. And I think the big trend that we observe is that fintech is big now. You may have noticed.
Every once in a while,
Fintech is a thing. And everywhere around the world, there are very large actors in the financial system that are not banks, that are not kind of your classic financial institutions, and do some piece of the puzzle. And I think the thing that's uncontroversial to say is that many places around the world have come up with specific regulatory constructs that are well suited to this. And so in Europe, we're regulated as an e-money institution by the Central Bank of Ireland. We passport that all across Europe. There's regulatory sandboxes that they've set up in the UK under the FCA and things like that. So there's a lot of kind of nifty constructs created. And so we were quite heartened to see Under Secretary Lang's comments, and I guess Comptroller Sue's comments yesterday, where they're talking about, okay, what is the right federal regulation, what is the right construct for fintechs? Because just fintechs are pretty big now. They're a part of the financial ecosystem that are here to stay. And so we very much welcome that regulatory engagement, and you don't want to be kind of putting a square peg in a round hole.
Yeah, I sort of say, for the most part, I guess California makes it, New York trades it, DC regulates it, and none of them get along. And it really is, how the U.S. system works, and it's a little bit fragmented in terms of how we go to market, both from a regulatory standpoint and from a product.
But I know I interpret that California makes it, DC regulates it as somewhat of a skeptical saying. Whereas again, like even the hardened libertarians think we need lots of good, high quality financial regulation, and so for me it's more about, these things are going to be regulated in some way. We presumably want good, modern, suitable regulation, as opposed to jamming it in something that was invented as a construct many decades ago.
It's interesting. People have had sort of different iterations of what you just said, and sort of fintech is kind of growing up a little bit, and it's starting to reach a certain degree of salience, economic relevance, and maturity, and therefore, with with great power comes great responsibility, or something, and people are understanding that kind of engagement, the regulatory engagement, becomes more important over time. When you go around the world, there are different kinds of approaches where sometimes you can be a little bit more prescriptive. Sometimes you can be a little bit more sort of principles-based. I always look at different industries, whether or not you're talking about AI, whether or not you're talking about payments. You had an earlier conversation about crypto and it's always, I've always tried to think through what is the best way to not fit the square into the round, whatever it is. Payments, it's a little bit odd in the United States. It's largely through each of the 50 states, but then there are some things when you're running through a financial institution where things like the OCC becomes very important in entities. I mean, how, again, when you sort of move from country to country, I mean, do you sort of in your own mind think, okay, this is a little bit more of a prescriptive place, or this is a little bit more of a place where we may want to consider more innovative ideas because of more flexibility? Like how does the regulation come up early in the journey of product development, or is it that you're kind of making the product, and then as things go along, you're trying to figure out okay, where's the best way or place to kind of deploy it?
I actually, look, you tell me if you feel differently. I don't feel like there are actually major philosophical differences in a lot of the financial regulation for this stuff. And that's actually a statement, because it's different in other areas. Take something like AI. Where in Europe there is a lot of worry about potential harms of AI, and there's an explicit strategy of ex-ante regulation before any of the harms can happen. We are going to get ahead of it and limit the size of AI and do all these things to prevent those harms. Whereas the US regulatory framework is much more ex post, and let's see what people are doing with AI. Seems really exciting. And then stuff will happen, and maybe it'll be caught by existing rules in kind of the domain in which it happens, or maybe we'll need to pass some specific rules. But those are two quite different regulatory frameworks. In the case of financial regulation, I feel like everyone has kind of the same pillars. We want to avoid exploitation. We want to avoid people kind of hyping products to low information people. We want to protect banking and keep that as something that banks are the ones doing. We want to have good prudential regulation if anyone is keeping money as an act, something like that. But I feel like the pillars in the US are the same pillars we see in the EU, same pillars we see in Singapore. And then it comes down to implementation questions. And obviously the US has the kind of very large number of financial institutions. The US has the state-federal split that many other countries don't have, and so it's just a much more complex regulatory environment than many of the other countries where we operate. Singapore, they just decide what they're going to do, and they do it. It's easier to govern Singapore in a lot of ways.
Well, now automatically, I'm going to force you, to make the promise of coming back here in a year, because now that, you've moved into the acquisition of Bridge and you're moving into crypto, where, the U.S. response is, when you travel, and I'm sure I travel a fraction as much as you do, but, you do hear from I hear all the time from foreign regulators sort of saying, oh, you Americans, you guys are quite kind of interesting in terms of what you want to do. I'm like, we like to keep things spicy. But maybe you can tell us a bit about that acquisition and sort of what would you like to do with it and how it fits into Stripe's sort of vision.
Yeah, absolutely. So for folks who didn't hear, we acquired a company. We signed a deal. I still have to go through approvals, but we signed a deal to acquire a company called Bridge. They are off building kind of the Stripe of stablecoins, which they're building the stablecoin infrastructure for if you're a company and want to do things with stablecoins. They make it easy for companies to do that, and so they've built all the APIs, all the partnerships with financial partners and everything like that. So it sounds pretty relevant to us. We thought so too, but we have tracked all the crypto stuff very closely from the inception. We held a Bitcoin meetup in 2011 and spent $200 on pizza, and really wish we'd spent the $200 on Bitcoin instead. But
did you use Bitcoin for the pizza?
No, that's the problem. And we would have set up a wallet then. And we've kind of been in and out over the years. But we've been looking for useful products that solve problems for people. Like we're not dogmatic on any of this stuff. I know I feel like there's been all sorts of, crypto has had walks in the woods over time where there was a whole NFT era and things like that. Whereas we look at the stablecoin stuff that's happening now that seems particularly exciting and interesting. And obviously the maybe international perspective we have on it too is we see with Stripe generally, the US has an amazing economy. People want to participate in and around the U.S. economy. With Stripe Atlas, it's our incorporation tool that makes it easy for you to incorporate a Delaware company. And we see lots of foreign founders, people who might be based abroad, that would prefer to do business in the U.S. ecosystem and get kind of American investors for their firm or something like that, than necessarily just rely on their home country. And so for me, stablecoins are part of a trend where the dollar is an incredible currency. I feel, very good about its prospects over the next 30 years. And there's just all this demand out there in the world for good access to the dollar, and I think stablecoins are going to be a part of that.
Yeah, that's fascinating, and it obviously creates lots of headlines when you see a company like Stripe And it makes a lot of sense when you see a company and says, "Hey, I am familiar with what you do. Let's try to onboard you," and the like. You know, I can't help but to sort of think, you know, you're probably younger than many of my students, and yet you've, you know, you're going all around the world and looking and building really important businesses, and yet you've probably been doing this for what, over half your life now? Or?
Yeah, I mean, we've been working on Stripe for 15 years. So I am young, but I do have 15 years experience in the payments industry.
I get it. I'm trying to, like, somewhere there's a 1990s hip hop song underneath this. But, you know, you have been doing this for a while. I mean, is this something that do you ever get tired of, or you sort of think to yourself, maybe you need to go into other
No, I mean,
like
this is our life's work. We just have so much fun with it. And the reason is, you know, we talk about Stripe's mission as being to grow the GDP of the internet. And so the idea we have is that we can cause more internet commerce to actually happen as a result of Stripe existing. And I think the two things that really keep us going are, firstly, we see lots of evidence of that. You know, we talk to businesses around the world, and we get to talk to businesses around the world. You're talking to people on the leading edge of everything that's happening, and they tell us that, you know, in some cases my business wouldn't exist without Stripe, or my business was able to be so much more successful as a result of Stripe. You know, we have this. I was talking to an entrepreneur in France building this company called Photo Room. They're a Gen AI photo editing app. 98% of their sales come from outside of France. And so this is, you know, the kind of business that's only possible in the internet era. You know, they're a small company, but they're a multinational. And just getting to talk to all the entrepreneurs that are doing interesting new things, we find really exciting. And the second thing, of course, is that we're nowhere near done when it comes to growing the internet economy. There's a huge amount of change happening in the finance world right now. When you look around at everything that's happening, whether it be stablecoins, whether it be all the RTPs, things like that, we just think we're pretty early in the journey of the internet economy. So we find that really motivating. And I think if, I don't know, maybe I'd feel differently if we were at the, you know, plateauing part of the S-curve, but we're not.
Well, in terms of that, those drivers of your interest, I mean, let's look a little bit deeper in terms of what's then exciting you. I mean, you've spoken obviously about stablecoins because you just acquired Bridge. Maybe you could speak a little bit more about sort of stablecoins themselves as to what makes them interesting, but also even much broader than that. You know, what kinds of opportunities and areas are exciting you most?
Yeah, I mean, taking them sequentially. On stablecoins, like I said, they feel like we've been trying to solve real problems for businesses all along, and we always look at kind of crypto through that lens. And so we tried Bitcoin as a payment method. Bitcoin just wasn't a good payment method. You know, maybe now with Lightning, things like that, you can kind of make it better, but just like slow, expensive, not solving the problem. Whereas with stablecoins, we see a lot of prosaic corporate cash management and liquidity management uses, where if you're a global corporation and you need to move money around the world, stablecoins actually help you with that problem. And again, there's a lot of prosaic business problems. That's always what we're on the lookout for, that end up being helped along by stablecoins. So that's that. I would say more broadly, payments, I mean, when we got into payments, it had a reputation as a sleepy domain. You know,
not anymore.
Right, exactly. But that's what it was at the time, and now the pace of change has really picked up, even ex-crypto. And so the biggest trend that's happening internationally is all of the real-time payment stuff. You know, there's a lot of talk about FedNow, and I mean, to a lesser extent, RTP, which is already happening in the US, but the US is the laggard in this on a comparative basis, where so many countries around the world have flipped to a real-time payment system being available to their citizens. You know, India kicked it off with UPI, but now we're seeing it in Brazil and Thailand and Singapore and so many countries where we operate. And that's just a very big change versus 10 years ago.
I mean, does this, for your orientation, and again, getting a little back to the global perspective, because we do have so many people from around the world, I mean, and you and I had a brief conversation as to what excites you, you know, from a regulatory standpoint, and then you sort of asked from a GDP sort of standpoint. I mean, to what, when you look at that sort of that point of intersection between GDP growth, population growth, but also sort of payments need, payments infrastructure, are there parts of the world that may be surprising or interesting that the audience would perhaps be interested or surprised to hear from you about? What's exciting and driving you a little bit further?
There's a global trend that is multi-decade where commerce is moving from offline economies to internet economies, and I think many emerging economies are the beneficiaries of this trend, because previously they were only selling to a local audience, and now you can be selling to a global audience. And so what we're basically seeing is, the economists talk about the gravity equation, the idea that the amount of trade a country does with another country falls off with the square of the distance, just like gravity. And that is a weirdly true factor in physical trade, and so Ireland trades much more with the UK than it does with France, and much more with France than it does with Brazil. You get this fall off with distance, and that relationship starts to get deconstructed, that geographic relationship, as things move online. We just think that's a very powerful and healthy force for the global economy, where you get more global competition, more globalization, more benefits in emerging markets. And again, we're starting to see it in all the markets where we do business. We acquired a company called Paystack in Nigeria. They are now larger in terms of their payment volume than the entire Nigerian e-commerce market was when we acquired them. Like the Nigerian e-commerce market has really exploded, and so it's just been fun to see.
I guess, again, just for a final sort of set of questions, and I'm not going to make you into a lawyer or a regulatory lawyer, but, I'll ask you a question that I sometimes get when I travel. It's kind of interesting, to different central banks, which are there certain kinds of features, to tie it all into a bow, certain kinds of features, regulatorily or otherwise, of different kinds of countries' financial systems that make it easier to achieve the kind of access. You're mentioning about payments, you're talking about access. I think this entire conference talks a lot about financial inclusion. Are there kinds of salient features that you've noticed that sort of these successful hotspots tend to have, and what would they be?
I don't know. I feel like anytime someone from industry comes to a conference like this, and they talk about regulation, they talk about regulatory certainty, but that is just the answer, where certain markets do a better job than others. And if you again, the Europeans do a very good job of putting frameworks in place and then updating them as they need to. We benefited a lot from PSD2. I guess everyone here knows what PSD2 is, and they're already off, thinking about PSD3 and what should go into it. But again, they do a good job of proactively seeking out input from industry, understanding the industry landscape, putting something out there, and then not just leaving it forever, but actually updating it based on the realized effects. And that's what we tend to like to see.
This is a great conversation. I know I said it was the last question, but I couldn't help it because you also talked about Silicon Valley, and you are in Silicon Valley, and you had mentioned something about sort of, the engagement of Silicon Valley with Washington, D.C. Any perspective as to not just what Stripe does, but even your neighbors out in the Valley? Do you think people feel that engagement that will increase over time? Obviously there's been a lot of talk about that. I mean, do you think it could be better? Do you think, do you have any big macro ideas about sort of the relationship there?
I don't know, again, like I was referencing, I feel like historically Silicon Valley has been terrible, hilariously bad at regulatory and DC engagement, to the point where it's almost a punchline. There is now at least more engagement, and again, for us it's always been different because we've been regulated from a very...
Well, here in DC we're always out there learning more about technology.
But hopefully it will change, but you guys will all be the judge of that.
Thank you so much. I really appreciate it.
All right, we're going to have a conversation on open source technology up next.
I want to think, when did I leave? I left.
All right. Hi, everyone. I have to say it's a rare occasion to see that many people at the end of the day. So DC Fintech Week is doing something right many years in a row. It's good to see you here. My name is Dea Markova. I work in a political intelligence firm called Forefront Advisors. I'm based in Brussels, so bear with me and my jet lag. This is the last panel between our grand finale, and we're going to be talking about open source technology now, or open source development models. I am coming to this conversation from a perspective of educating myself and curiosity, because now that Europe is kind of at the end of putting together our operational resilience framework for financial services, I've been asking the regulators over there, how about open source, or how about permissionless ledgers? And my impression is that we're at the very early stages of thinking about that, both how to risk manage it or how to use open source technology models to risk manage other cloud or other cybersecurity issues. So no better to help me understand these questions than the panelists we have today. And let me get straight with the first question. Fernando, Eric, can you kind of put us on a level with me and with the audience? What is the level of importance and deployment of open source in financial services today?
Yeah, absolutely. First of all, let me thank you for having me. So this is DC Fintech Week, and I would argue that we wouldn't be here without open source. Why? Because fintech would not be possible without open source. So let me walk you through what happens when you trade stocks using your mobile phone, right? So you might be using Android, like I am. That happens to be Linux, open source. The native app that you're using is probably using libSSL, which is open source. Maybe you're using WebView, which uses a HTML renderer, which is also open source. And then there's some communication going on with servers that go through a Wi-Fi router that is running Linux. And then on the back end, the guys happen to be running servers on AWS. And you know what? AWS hypervisors are open source. The operating system on top is open source. So basically, all of fintech is running on open source software at the infrastructure level. Why is that? If I'm in fintech, I don't want to build a data center. I'm not trying to compete with Google, AWS, or Microsoft. I want to focus on the UX, on the value proposition. So the fact that all this software, all this enabling technology has been commoditized is what enables fintech. And that's why we're here.
And I should say, you're on a slide as with your CBI hat on, but you've also allowed me to introduce you as a Linux OG plumber. So yes. People should know that this is where you have.
I was reminded I've been working on open source for 31 years, so thank you.
You will. I reminded you of that.
Eric?
You know, I think every transaction you do in modern society goes through some open source product. So, you know, Linux, Kubernetes, SSL, and so on and so forth, all open source. And the banks have invested heavily in open source, exchanges, payment rails, all running in open source. And it's added resilience. It's added, there's cost benefits, there's productivity benefits, and so on and so forth. So you can't do anything without open source nowadays.
So, quick follow-up question to the two of you. Is there a trend in the kind of thorny problems that are being addressed through open source systems?
Yeah, well, I mean, one of them, as I just mentioned, is commoditization. Mm-hmm. If you rely on just proprietary software, you're basically beholden to the product roadmap of your vendor. Sometimes the licenses you need to pay, you cannot afford. So they stifle innovation. So we are seeing a move away from such traditional model so that you can focus on the value proposition. So all these enabling components, again, by definition, they get a lot of pressure from all the ecosystem for them to be open source and commoditized. Another trend that we are seeing is that what I mentioned at the beginning of this panel is that the focus was on the infra side for a long time. But we are seeing this open source movement to apply to higher levels up the software stack. So we start with middleware, and now with things like DeFi, blockchain, you name it, we see there are certain what I call finance primitives like payments that are already on chain. And I would argue that all those building blocks, all these primitives, will be commoditized. Because the focus is, as someone who's providing, let's say, brokerage services, is the UX. How do I offer you a product that is attractive, that you want to invest in? Again, I don't want to rebuild or I'm not trying to compete with traditional payment rails or create noster-buster accounts. If there are payment primitives that I can access to programmatically, I would argue that eventually all of that would be open source.
And if I can build upon that, it's not just the software itself. So I'm on the governing board of Finos, which is the FinTech Open Source Foundation, part of the Linux Foundation. And there the banks, it's all the major banks, the Goldmans, the Citis, the JP Morgans, et cetera, all come together to collectively solve problems, the undifferentiated lifting. So, for example, what's an AI governance framework? The banks come together, do it collaboratively, and then the banks can then build upon their intellectual capital, intellectual thought on top of that. There's how do we look at what the risks are associated with, say, running in the cloud? What are those risks? How do we mitigate those risks? What are the compensating controls? How can we test them in an automated way? Banks come together to do things like that. So it's a way where we can collaborate and, solve problems together, and then let banks innovate, for their customers. So it's not just software, but it's also a methodology, a mentality of how we collaborate to solve problems.
I think it makes a lot of sense to listen to an engineer talk about collaborations, but how do you work with your banking customers and members to overcome kind of some of the competitive or maybe biases that get in the way of the kind of the collaborative utopia that you paint out?
Yeah, it's a good question. So, within, obviously, there's competitive reasons where, someone from JP Morgan and someone from Goldman, can't talk in a room together, obviously. But when you come together with, say, the Linux Foundation or with Finos, okay, we read out a set of rules. People know how they can interact with each other, okay? It's all done upstream, meaning that there's a Git repo where we have notes, people are talking, people are contributing source code together. So it's all done together. And then again, they can take it, they can fork it, they can make it their own. They can use it internally, and we really foster not just this collaboration, but also how do you think about consuming open source within your organization? So there's a framework for an OSPO, Open Source Program Office. So that's an accelerant for consuming open source. If you want to think about how do you contribute open source, we've got members who contribute open source as well. And through all this, we did a study recently, 88% of the firms that are Finos members see significant value getting out of open source, productivity improvements.
I would like to give you an example. Again, I will show my age again. 2007-06, I was working for NTT, the Japanese telco, and some of the biggest banks in Japan in the world were our clients. And they were not happy about having to pay crazy license fees to an unnamed enterprise database vendor. So they came to us, can you help us find the right open source database? Back then, we had things like MySQL, PostgreSQL, you name it. But to be honest, right, you will look at it, this feature is missing, this is missing, that is missing. But we found out that a community like PostgreSQL was healthy because they allowed us to scratch our own itch. So we knew that we needed streaming replication. We knew that we needed auto vacuum. And we got assurances from the community that if we implemented all those features in-house with the help of all these other banks, they would take our code and maintain it for us like forever. So all these features we actually implemented. It took us 2 years. It was not cheap. So my CFO was not impressed. But if you look at
But it matched your needs.
There you go. But actually, he ended up saving $200 million for entity and our clients just in 5 years. So that is the power of open source. Why do we need to pay this much to this vendor? If this is something that should be commoditized, it's just an enabler. So let's do it together and take it from there. So I think that's, for me, that's when it clicked, right? Actually, I can make a living out of this.
It clicks at the bottom line. It often does. Shiva, let's talk about DeFi and permissionless ledgers. So open source has been on a journey into financial services over tens of years, into acceptance and understanding from financial services regulators. Can you make a parallel with the journey that DeFi, permissionless ledgers in particular, disintermediated provision of anything is on, and are there any lessons to be learned?
Well, I think the lessons are really what Eric and Fernando have been talking about, which is this is not just about publishing your code and calling it a day. It's about creating an environment, an ecosystem where collaboration, there's governance of that collaboration. It's not just you hope that people are going to somehow back into effective collaboration. Let me tell you that absolutely never happens. It's really about creating the incentive structures for people to understand, why are we in this together? Why is this an important topic? Why is this an important area? I think DeFi is very early. I think it's very, very, very early, particularly by comparison. So I would say of course there are lessons, but it's all about what are the kinds of problems or risks or collective action issues that you have that you want to try to address together, right? And so I think in areas like, well, with what Finos does, in areas like the financial services, there are some defined problems, some defined risk areas. I think you're already seeing a lot of this in cybersecurity, for example. You're seeing quite a bit of collaborative modeling that's coming up, not just in DeFi, but I think in the crypto ecosystem in general, around cybersecurity and thinking through what might these issues be, how might we work together to solve or to create standards around them. But I think it's really important just to ground in what my colleagues have said, which is it's not enough. You can't OSS wash. You can't just release your code and call it a day. You have to have a plan that incentivizes people to come together and articulate what the reasons are. And like I say, I think it's very early in that ecosystem, but I think that there is a lot of collaboration already happening. It's a small ecosystem, relatively speaking, so the players pretty much know each other already, and there's a lot of incentive to get it right, particularly because, as you say, the eye of the regulator is pretty early to that space, and there is attention being paid before, I think, it's had a chance to develop into maturity the way that some of the other fintech applications, other spaces have done.
I think your point about a community is critically important. That's what really defines a successful project. Yeah. It's that community, it's that shared challenge, and there's a roadblock for all these firms together. And if you can remove that roadblock, it's an accelerant for everybody, and they see that vision.
Right. And oftentimes it really is about a barrier being something that, if you own a proprietary solution, that doesn't solve the problem. Because the problem is multifold, right? And you might only own a piece of the problem within your own stack, but someone else owns a different piece. And together you have to be thinking about all those different facets. And the only way to really solve it in a way, particularly a way that I think is going to be meaningful to a regulator, which is a different consideration, but I think the user should come first, personally. But regardless, in both ways, I think sometimes the only way to do that is really to create this governance system that's going to enable that to happen.
Maybe one comment as a governance geek. I think Wi-Fi comes with some really interesting challenges. With open source, you have the source code, basically. The focus is how to prevent people from tampering with the source code, right? How to make sure that there are no backdoors. That's the main focus. Mm-hmm. In something like DeFi, we still have that, but on top of that, there are deployment. There is a live network. So this morning, a speaker said you can actually clone, the Ethereum repo and have your own private deployment, and then you get to decide the governance for your own deployment. But there's also a public blockchain, right? And who defines the governance for that? I would argue that is closer to something like the internet, and there are lessons that we can learn from that. So in that sense, it's even more complicated than open source. Right. I think we can get some inspiration from open source, especially for the source code side of things, but what about the live network, right? I think that's a completely different challenge.
Yeah, and I think there are reasons that you see such a big movement in DWeb, right, decentralized web, and so many people that have come together around that frame to think about how do we re-decentralize almost the web and go back to sort of the OG roots that I think we're all dating ourselves, but we all kind of are familiar with, and get back to that understanding of how the internet ought to be functioning in order to be most beneficial for users, which again I would argue is what the core approach and the core audience should be in terms of some of these changes and modifications that might be made.
Speaking of communities, Balthazar, your community is the central banks of the world. So what is your conversation with them? What are you building that is open source, and how are you building comfort around it?
Perfect. So first of all, thank you for having me. And yes, I made it quite easy for you to win in the contest of Spot the Central Banker. I'm wearing a tie. Now, open source didn't used to be a part of central banking speak. However, I think we're definitely getting there. You see, I have a wonderful work at the BIS Innovation Hub, and also, by the way, I have to do the standard disclaimers. This is my personal opinion and not policy or opinion of the BIS. However, we are actively doing open source. We're trying to do research and build the future of the future financial system. And pretty much what hangs in the balance is the stability of the worldwide system. And it makes for really interesting work. Now, as we do that, most of what we do is entirely based on open source. Why? Because whatever tools we build, we want people out there to use effectively. So, yeah, if you are in a large jurisdiction with a large budget, you can probably go ahead and buy a proprietary solution with no problem. But if you think about the smaller jurisdictions, they do have a challenge. And it's not only a challenge of economy, it's a challenge of access to skilled resources, people that know how to do stuff. And it's also a question of sovereignty. If you buy, for example, closed source, what gives you the guarantee that no one is going to pull the plug on you on, for example, your payment system? And that is basic systemic infrastructure that we need in order to hold stability. So as we try and build this, we use open source technology mostly to make it easy to adapt and adopt by different countries. But the projects that we create, we are also aiming to share as open source. So right now, any central bank that's interested in the work that we're doing, for example, in post-quantum cryptography or in building faster payment systems or in doing data analytics for example, for green finance, all of that is available right now, as of this day, for central banks to start using. Now, that gives central banks access to source code and to intellectual property. But as you've seen, the key element behind open source is that you need a thriving community. And thriving community is what actually brings this as a possibility for us. Why? Usually you think about central bankers as being extremely risk averse. And that used to be the discussion when you said open source no, because everyone has access to the source code. But I think that pretty much as the rest of the industry, we realize that security by occlusion is a myth. You're exposed to open source even if you're using closed source software. And it is a lot better to go ahead and do transparency in order to ensure security. In cryptography, you actually have the concept of Kirchhoff's principle, which states that you can only be sure of your system being safe if you can make it entirely transparent without sharing your private key, and it still remains safe. So that is what we're trying to do. We're trying to build those really safe systems, but in order to make this work, we need community. And that community is made up by central bankers that are also working with us, other multilateral organizations like the Bank for the Inter-American Development Bank that's also working with us in order to build this community, build the solutions, and start deploying those solutions out there in the market. Now, right now we're sharing this with central banks, but I would definitely love to share this with the fintech community and the private sector. Why? Because you can only ensure that thriving community if you are open to participation. What's the trick? The trick is you need good governance. You can only achieve success in open source if you have good governance. And you know what? Central bankers, that's our middle name. We are very, very big on governance. So if we can actively have a way of developing those communities and adding the governance that we need in order to ensure the safety and the stability of the financial system, we have no problem with open source. Now, not all of our projects will end up in open source. Open source is just one route of graduation of our research projects, but we definitely do support it.
Can I add something also, which I think is really important here? So when you're talking about the BIS, you're talking banking globally. Yeah. The banks in America are very different than the banks in Mexico versus someone up here was from Ethiopia. You get a diversity of ideas and a diversity of approaches and diversity of cultures. So you have the ability now of someone not building software based on his or her perception of what banking is in America, but you can be tailored to what happens in an individual country, and that's valuable.
Yeah.
Very valuable.
But I do think the best governance models are predicated on extraordinary inclusion and really thinking through how could we bring together the broadest set of stakeholders. And from there, you kind of narrow and you morph depending on the goals and depending on the frame of the conversation. But starting with the premise, right, that you're going to be broadly inclusive does not only enable diversity of viewpoints, it means that what you're building is going to be stress tested in ways that you hadn't necessarily imagined or foreseen, which means the whole thing will be more robust, which is ultimately the point.
Yeah. Maybe one quick comment. I think it's important to define what we mean by ecosystem. Because when people say open source, I think developers, end users. But there are repos. There are companies like Red Hat who put all of that in a really nicely curated package that has been properly tested with QA in place. And all of that, I feel, has kind of been missing in DeFi, in blockchain. We don't have the Red Hat of blockchain, Web3. We are not quite there yet.
It depends.
One might argue it's actually us, right? But again, we should not forget that it's not just about the developers. It's not just about the end user, right? In between, there are a number of intermediaries that are needed to guarantee, that no one has tampered with the source code and that the right risk controls have been put in place.
The risk mitigants.
Yep.
I'm afraid I have to cut you off because this is all the time we had. I just want to say one sentence to kind of appreciate what you guys are talking about here. We're talking about dealing with sovereignty concerns by opening up everything. Yes. To a community of to a community of self-enforcing perpetual trust. So it's quite the challenge. But that is all the time we have, and we are the final act before, or the pre-act or the final act of today's session. So thank you very much to the panel, and thank you for the audience.
Thank you.
Thank you.
Well, this is indeed the finale, the final act before the pre-act, with the CEO of the Financial Conduct Authority. Nikhil Rathi, thank you so much for joining us. I know that you've had a very busy day of talks with all the other regulators here in town. We've had a series of conversations, as you might imagine, about global politics, but also U.S. politics. There is an election going around that you may have heard from some of your colleagues. And the conversation, for the most part this week, has been about the degree to which the U.S. political scene politics could impact financial regulation. To what extent do the developments here impact your work and the work of the FCA, and even the sort of the policy posture of the United Kingdom?
Yeah. Well, Chris, thanks for having me. It's great to be here. And I was delighted to get invited to the FinTech Week, but what's really got me here is the JB007 vehicle downstairs to try and get a photo before I leave. We've just had our election a few months ago, and now we in the UK have a large majority government that is very focused on financial services, very focused on FinTech. We saw that at the government's inaugural investment summit a couple of weeks ago. And I think we're watching with intrigue what happens here in a couple of weeks. It does have a huge influence on anything to do with financial regulation. The US is the largest capital market in the world, whether that's 40% of global assets or 50% of equity markets, largest fintech center in the world, and where the US goes on standards has an impact on all of us. And I think one of the things that's really challenging, in recent years is whether that's on crypto or AI or sustainability. It's been a little bit difficult to read whether those standards will stick, including through the court system here. And then we are left as a UK, now we've left the European Union, we're left with the dilemma if the EU does one thing in one direction, the US does another thing or does something different. Where do we position ourselves? So huge impact, and let's wait and see what happens.
Well, clearly nobody here cares or is thinking about the election. What I really found really interesting in that answer is is that it's a political answer, but also, you had mentioned sort of the legal apparatus, the fact that, we do have a court system, the U.S. courts, and even the Supreme Court. We've had numerous conversations even earlier this morning with Chair Benham from the CFTC. It can impact how rules are sort of released here in the United States and whether or not they stick. It's not just a political question, but it's also a legal issue.
One thing I'm lucky to have, unlike Russ, is we don't have to regulate election futures market. So I think we're blessed, and I sort of go home and I say, keep that well away from us. Good luck, CFTC.
Well, yeah, he had mentioned, to that point, he had mentioned just, the challenges, and we came up effectively with the be careful what you wish for kind of question, because, if you want to have those kinds of markets, then you need to build a structure, and that becomes hard. But how, I don't know how to say this any other way, but when you look then at the fact that the United States, our politics are a little bit up for grabs. Our the way in which we do our rules and our rulemaking, is evolving rapidly. Last time I checked, UK has some pretty sizable capital markets too.
Yeah.
Yeah. Last time I checked. So, what does policy making look like practically when there's still those question marks out here in the United States?
I think we have an opportunity in the UK to move pretty quickly and to use the flexibility we have in our institutional system. We work pretty closely with all the different agencies, not just our colleagues at the Bank of England on financial regulation. I chair the Digital Regulators Cooperation Forum. We like acronyms in the UK, DRCF.
Oh, we don't like them.
That is, we bring together, without any statutory sort of underpinning, but just myself, the telecoms regulator, our competitions regulator, which runs the digital markets unit, and our privacy regulator. And we are sitting together and we're talking about how we interface with big tech, how we horizon scan on new technologies. And I think that ability in the UK is pretty unique. We all have our different objectives. We're able to coordinate pretty closely, which enables a fluid policy-making environment, hopefully a rapid policy-making environment. And if we've got issues, we can speak to the Treasury, and they'll be open to legislating to sort them out. So to give you an example, tokenization, we're doing a load of work with our industry on that. McKinsey estimates it could be worth $4 trillion on best case by 2030. Who knows? And we've been working to see how our existing framework can make that work. And any gaps, we can then go to the government and sort those out.
So are there any specific priorities within crypto? Is tokenization one of those priorities, or are there other kind of priorities when you look at the digital asset space?
Yeah, so on crypto, we've been contributing to the chairmanship of the IOSCO group on crypto and digital assets. There's 18 recommendations there about global standards. We've been implementing those on marketing, on conflicts of interest, money laundering, financial crime, all of those important conduct and market integrity issues. That's one thing we want to make sure we get done and get through, both here and around the world. Stablecoin legislation is coming through to provide a regulatory framework for stablecoin. We will do the non-systemic stablecoins. Our colleagues at the Bank of England will do the systemic ones. There's some work going on central bank digital currency as well, where a decision should be taken by 2030. And then, tokenization. We've seen some use cases. We've seen small sort of pilot use cases around fund registers and so on, but nothing yet which has taken up sort of critical mass adoption. But we want to be ambitious here, and so we are working not only with our domestic industry, we've also joined a project with Singapore, Japan, and Switzerland to look at how our laws and rules can interoperate with each other cross-border, because what's clear is if a use case does take off, it's going to need to be beyond one jurisdiction. And I think, going back to your first question about the US setup, I think one of the challenges is there's a big interagency coordination issue, and so sometimes it's hard to know who you're going to talk to coordinate with if you want to get a kind of a firm answer on cooperation.
So, and just in that dynamic, also, right next to you, you do have the European Union, and there is that interagency or coordination that happens there. I mean, is that even though you do have MiCA, obviously, and you do have some a regulatory package, do you view the UK's ability to deliver quickly on solutions as a kind of competitive advantage, even when you think about other jurisdictions, whether or not it be the EU, whether or not it be Dubai and the other countries? Like, when you look at those global frameworks, where do you think the UK is ultimately going to fit in?
Yeah, so we have one of the largest, as you said, global wholesale markets in the world. After the US, we're the biggest international investment management center in the world, around $12–13 trillion of assets under management, mostly for overseas clients. Big wholesale banking center, second largest fintech center in terms of number and scale and quality of fintechs. So there's a huge kind of critical mass, also in insurance too. That means it's imperative on us to be super engaged in all the global fora, particularly having left the European Union, and that's why you see a big presence of UK regulators here this week, right across the piece, engaging on every topic that is preoccupying international discussion. And we can move quickly at times, and we do move quickly. So last week we celebrated the 10th birthday of our innovation services. We were the first regulator in the world to launch sandboxes. They've now been emulated by 95 partner regulators around the world. We have launched a digital security sandbox. We are making synthetic data sets available for firms to pilot and try out different use cases, be that from financial crime to financial inclusion. So we can move quickly, but we can also move slowly and hopefully in a good way. So on crypto, for example, I think we're quite comfortable not having gone first necessarily and followed Mika. That obviously was agreed, but I think it gave us a bit of time just to understand the lay of the land, discuss it internationally, think about where the right emphasis would be for our regulation. So I don't think going first always is the right answer.
So, there is obviously a larger global conversation also on generative AI, AI, both in terms of its uses, risks, opportunities. Philosophically, sort of, what is the posture of the UK when it comes to generative AI? And then more practically, are there any kinds of priorities that's on your list and developments that will be coming to market, so to speak?
Yeah. I think the UK posture is one of really embracing and engaging AI and thinking about it both in terms of opportunities as well as risks. So the previous government convened a global AI safety summit, and obviously those issues need to be taken really seriously cross-border to make sure that our cyber defenses, our national security is protected. But we also have a huge amount of deep AI innovation going on in our universities and in our technology sector more broadly. From the FCA's perspective, I think we have to approach this with humility. I'm very reluctant for us to write rules about things that we don't fully understand ourselves. So we have said that we're not actually rushing to write rules. We have an outcomes-based framework in the UK. We have something we've called a consumer duty, which was a significant piece of regulation we introduced over the last couple of years, setting out very clearly what the outcomes we expect across the whole of retail financial services. We supervise 45,000 firms across consumer and wholesale markets in the UK. We have our market integrity framework, and then we have what's called a senior manager regime, which puts senior managers and their boards on the hook for those outcomes. And we said that should be enough for now. Go and innovate. And indeed, we need the financial services industry to innovate because we see some of the most prolific users of AI to be the serious organized criminals and the financial criminals. And we need the financial services industry to kind of counter that. So we don't want to hold that back. And then within our own organization, we're getting increasing levels of excitement around some of the things we're piloting, whether that is using large language models to interrogate some of our authorizations decisions, interrogate the unstructured data that comes through. We have hundreds of thousands of decisions we take every year, and some of those models enabling us to get to the higher risk cases quicker and faster, whether that is going after scam adverts, investment fraud adverts that we see. So 2 years ago, we intervened 500 times. We've deployed AI and machine learning, scraping the web. Last year, we intervened 10,000 times, with hardly any incremental number of people doing those interventions. And then on the enforcement side, serious organized crime cases, we have millions of pieces of digital evidence, millions that we have to go through for criminal defense disclosure, very laborious using traditional tools. AI could help us if the judges accept that as a mechanism to meet the criminal defense threshold. So there's some huge excitement there to make our work more effective.
Can I ask like a question that I've asked I think almost all of the regulators, which is, you have this new ambit of issues. You have the digital assets issue. You're talking now about some really major soup tech initiatives, as well as the general supervisory work streams. Resources has always been an issue here in the United States. How does that work for the FCA when it comes to an increasing and broadening scope of activities to sort of either monitor or technologies to implement? I mean, is the resource constraint issue the same character that we have here in the U.S.?
I wouldn't want to comment on any other agencies' budgets. They're always lively discussions.
Oh, really?
But yeah, we raise levies from our industry, so they pay for us. We have to explain what we're doing with the money. We have increasingly been shifting the proportion of our budget that's being spent on tech and data. We've hired many more data scientists. We've built the digital delivery hub in the north of England to make sure we're skilling up as we need to. There's no right answer to that resources question. You know, we could double our resources and still say to you that we haven't got enough. So we have to prioritize and we have to focus. We also, I think, have to partner. So we draw in a lot of expertise through advisory groups, expert groups, to help us get to the right answers. We've got a synthetic data expert group, an innovation advisory group. We've done some joint work with our partner regulators on quantum. We're partnering with academics. So we can really tune into all the resources that are out there and get the best.
So I guess the last question is, like, you know, if you're going to say sort of your immediate one or two priority areas facing the FCA, are there any one or two that you would just really want to highlight for a DC audience?
Well, so I think look, we can't get away from all of the kind of focus we need running a high integrity, stable market, from cyber security and operational resilience. If I look at what happened with CrowdStrike and the breadth across sectors of what happened, you know, and then we look at some of the events in August with the Nikkei falling 12% and the scale of pressure on the financial infrastructure, that we may have got lucky with those incidents, that it didn't have the kind of scale of impact that it might have had. But, you know, when these things go wrong in financial services, this has massive impact for the real lives of our citizens. So that has to be front and center. And then secondly, there's a huge number of really interesting things going on in wholesale markets and how you can use AI and opportunities. It could also solve some big social problems. Financial inclusion, big issue. And I think the technology solutions and a digitally inclusive approach to that could sort out some of these issues we have with 1.5 million people not accessing the banking system, people not getting insurance products. So being imaginative around that could actually really contribute to the overcoming skepticism about use of technology and growth in our economy as well.
Nikhil, thank you so very, very much for giving us the finale for today's DC FinTech Week. Super interesting. I've lived a couple of years in the UK, but I'm always learning new things. Thank you so much.
Thank you, Chris. Thank you very much.
All right. So we are now ending DC FinTech Week. There's a bar. Control yourselves. There's a bar out here, as well as the rooftop deck. This is the second year in a row in which we are having amazing weather. Thank you so much. You guys have made this a great event. Enjoy.